used to be the case is that general AI assistants were not very well suited to be integrated into companies and the company workflow, etc. So Anthropic is trying to solve for it, and they're introducing these AI. I mean, the AI agents were there, but these are like plugins which can be integrated. The integration part is crucial into enterprise workflow, etc. So this is across a range of functions: sales, marketing, legal, etc., and whatnot. And that, I think, spooked investors in IT services firms, saying that, well, are these very low-cost AI agents now, easier integration, going to eat into the revenue pool for IT services companies? And that's essentially what happened. Now, the IT stocks, and the data is, I think, about 11%, right? IT stocks weight in the Nifty is around 11, 12, 13%. It's been in that range for the last one and a half years or so. So it's not massive in that sense, the weight. And can it really dampen sentiment on the Nifty? Yes. But you got single stocks in the Nifty with that much weight now. But it's a sentiment thing as well. So keep an eye out with regards to IT services companies. As we start up, there will be a reaction. Now, NASDAQ, it's not as if global markets were sort of higher, but of course it was a reaction function. The reason NASDAQ was down 1.5% is exactly because you had all these companies which also sold off. So, they were pressuring the NASDAQ, and the index showed up with a 1.5% cut. S&P was down about 1%. I was saying this earlier as well. Apple failed to make a move on the upside despite strong results. And something similar happened with, this new company, Palantir, right? Palantir reported numbers. Numbers are like a blowout, and the stock went up 5%. So you have to consider whether global markets themselves, overall, especially in the US, because US has been the leader, clear leader, are starting to look a little weighty. And if that is the case, and on the way up, we did not participate. So on the way down, if there is a leg down in global markets, maybe we will fall less. So relative outperformance, I think, will be there. But you got to be prepared for something. I mean, a bit of a shakeout, pullback. We've seen occasionally those happen, even as growth looks pretty strong. Now, precious metals have all bounced. You've got gold, which was up 6%. You've got silver, which was up about 7% or so. And this is a bounce. Many are still not convinced. And there are serious investors who feel that, well, this is one of those suckers rally which will get everyone in, and then you see another leg down. But this is a space worth closely watching. But for now, we've got a bounce. And this morning in Asia, prices are higher again. Dollar index was down about 0.25%. You've got oil prices which have moved up to about 68, but there were 70. They pulled back, and now we're at about $68 or so. Now, I'll just wrap up the India session, right? So there was buying, large buying. FPI has bought about 5,000 crores worth of stocks in cash market, and they covered about 40,000 contracts in terms of their short positions and index futures. I'm not looking at options, but just the index contracts. And they're still short, about roughly 1.6 odd lakh sort of contracts. So, yeah, the short positioning is large. The covering has been pretty meaningful as well. The question is, will there be a couple of days more of follow-through? I think it's possible we have some more follow-through, notwithstanding the IT news flow. But I just want to say one thing, and this is very, it's easier to see. You just look at the Nifty candle from yesterday, right? We had a very, very large open, 1,200 points higher. The market sold off, and we ended with about 600, 650 odd points in gains. So we got a big move on a big news day, which was unexpected, but we couldn't sort of hold on to gains. And I think that is perhaps a bit of a concern worth watching out as well. Maybe during the course of the day yesterday, there were doubts about delay and whether, whether we know all the information, whether there'll be some walk back, et cetera. None of that has happened, so that's good. Mood certainly has changed across the board for the better. The levels for the Nifty, I mean, of course, 26,373 is the high. And that, of course, is the resistance. It's about 70, 80 points away from where we left off yesterday. And support, there was a big gap, right, between day before yesterday and yesterday's open. That gap area of about 200 points, that's the support zone. 25,450 to about 25,640 or so. GIFT Nifty comes up on your screen, gives you a quick sense of how we're likely to start. We'll pick it up from there. 70 odd points lower is the start on the GIFT Nifty. Nigel. Well,
you remember many years ago, right? There was that song, Baby Come Back. It seems yesterday we were singing that song because the FIs, they came back, and they came back actually after a while. Big cash market buying is what we saw, and that, in fact, is something that was missing. So 5,000 crores in a single trading session, I'll tell you what. The bulls will be very, very happy to see them come and participate with nearly around 5,000 crores. So that's pretty good news in terms of the flows that we saw. Well, the number actually, the FI buy number is the highest that we have seen in the last 3 months. So clearly very, very encouraging signs. Besides that, when you looked at the live data yesterday, both on the Nifty open interest as well as the Nifty Bank open interest, it gave you a sense that there is a short covering bounce that's playing out. Because the open interest was lower, both the indices were higher, and the premium on the Nifty futures as well moved up. That gave you a sense that the shorts were covering out and there was fresh long addition. And that's precisely what happened. Just take a look at the FI data. From being very, very aggressively net short, they came back yesterday. They've covered shorts both on the index as well as on the stock futures, as you can see. And they've added some counter long positions as well. So there was a massive, massive short covering bounce that we saw. Keep in mind, the FI short positions are still at around 83%, which is telling you they are net short, but that's far lower than the 92% odd we saw just a few trading sessions ago. The FIs, they have been covering shorts. If you just pull up the last 3 trading sessions, you'll see the FI short positions, it's come down. At peak, it was around 2.2 lakh contracts. That, I think, was on January 23rd. But even the last few days, the FI short contracts, well, they have come down by close to around 45,000 contracts. But the clients that were long, they have gradually going ahead and they have unwound some long positions as well. So that, that mix actually you like with the FI short and the clients long. But now, in fact, they're relatively less short on the index, though there's still a lot of short covering actually that could play out. Moving to the options data, then the 26,000 call, well, there was clear signs of writing that we saw in yesterday's trading session. However, the 25,500 put, that continues to see some writing, which gives you some hope that the lower levels actually will get defended. So let's get the Nifty levels up for you on the screen. Support comes in at around the 20 as well as the 200 DMA. So the downside levels are very, very important in terms of this range not getting broken out on the downside. However, yesterday's high, the way it got rejected in yesterday's trading session is telling you that the bears would like to defend this high. Remember, Rima just spoke about the tech, the tech trouble that we could have today. So the IT stocks are going to be under pressure. Who can bat for the bulls? I'll be looking at 2 indices. One is the Nifty Bank, and I'm calling Reliance Industries as good as an index because it has 10% weightage on the Nifty. So we'll keep an eye out on both these two. They'll have to offset what the Nifty IT index will do. But I think this market sentiment has changed. So that's why, in fact, till that 20 and the 200 DMA is defended on the downside, you'll want to believe that we have some unfinished business at higher levels. But good going, guys. It's been a while since we saw that kind of FI buying as well as the shots getting squeezed out.
All right, let's get to the equity calls then. It's Surendra Goyal of Citi who says that Q3 results have been largely in line with expectations with an EBITDA growth of 9%. He says at the EBITDA, we've seen largely in line across most of the sectors, barring industrials and healthcare, where there is a significant beat, or utilities and financials, where there are modest misses. India's macro sentiment, he says, is improving tangibly. Major trade deals with EU, US, GST cuts, labour code reforms, manufacturing infrastructure-focused budget announcement, and lower pace of fiscal consolidation versus recent years in the backdrop of low inflation and a 125 basis points cumulative policy cuts. Recent INR depreciation, bond yield increases are areas of concern, but with recent trade deals, some of those should ease. Earnings are on a better footing with recent trends improving. Bottom up, our analysts highlight growth optimism across financials, autos, select industrials, and stable consumer. All right, let's move on and talk about the big rout that we had in global technology names. It spared literally no one, whether it's a Salesforce, whether it's a Gartner down, even across European markets, and the Indian ADRs too saw a very large slump of about 4.5–5%. Moshe Guthrie, Managing Director, FinTech, Tech-Enabled Services, Investment Banking at Wedbush Securities, is here with us on the show. Arvind Sanger, Managing Partner, Geosphere Capital Management, also joining in. Gentlemen, thank you very much for joining in. Arvind, let me begin with you. Your first initial read on the tech sell-off. Is it just because valuations had run up so much, there was so much hype surrounding AI that some of the froth got taken off? Or what we've seen from Anthropic's Claude plugins, the new developments, the new updates, is actually going to put many of the services software models at risk, and therefore there is a real downside earnings pressure and valuations rightly need to be corrected?
Well, the SaaS companies in the US have been for sale for the last several weeks and are coming close to the April last year, lows when we had that major correction in the overall market during Trump's Liberation Day. So they're almost back at those levels. They're reporting good earnings and the stocks are selling off. So this is not about current earnings. This is about concern about future growth, future value. And so finally, I think people have now started worrying about different segments, and IT services, the latest ones to get this concern, because the SaaS companies are going to see, disintermediation by AI and by AI agents and by AI software. Then at some point, people are realizing that, even the software services companies are going to suffer in this same issue of can agents do the work, and how much will be the value of IT services companies in that new, if that's the new world we're moving on into. And again, this may not be a one-year call, but this is a 2, 3, 4-year. There's real headwinds emerging that could be very meaningful.
So today's developments that came over the last few days largely targets the SaaS companies, ServiceNow, Salesforce. But the fear is that in the future, with the way tech is developing, it will hurt even the Indian IT outsourcing companies. Is that the correct way to look at it? Right now, there's no risk to IT services. Today's revenues don't shrink. Moshe, you want to come in? And yeah, go ahead, Arvind.
Yeah.
And
Moshe, no, go ahead, Moshe.
Sure. So it wasn't only Anthropic, it was also Gartner that reported numbers this morning, and they took numbers down for calendar 26. So maybe that's more related to the tech-enabled services kind of sector. But look, Rima, we've been talking about the cannibalization and the disruption of AI for about 2 years now. Ultimately, the proof's going to be in the numbers. I just want to, factually, if you look at most companies reporting in the past few weeks, they've done better than expected. Guidance looked better than expected. So I don't know. I think we've been talking about for 2 years, the disruption has been going on. If we actually get to a better trajectory in terms of revenue growth for this space, I think that'll be, and we should be in an okay shape. The volatility is just insane. I don't know if that necessarily reflects fundamentals at this point. That's my point of view here.
Yeah. Okay. So, gentlemen, morning, Moshe and Arvind. So let me play the devil's advocate just a quick. I've got a couple of questions. So Anthropic is coming up with a large fundraise round. I remember Ken Griffin at Davos from Citadel saying that all these companies have raised hundreds of billions of dollars, and that's one view, and they've got to promise the moon to change the world. Otherwise, they don't get to keep the money. You think there is that element as well? A bit of an oversell? A quick word, Arvind.
I'm not so sure. Anthropic's revenues grew tenfold in the last 12 months. And from what I've read recently, they're talking about another 5 to 10-fold increase. And it's not from small numbers, from 10 billion going to 50 billion. So these are not small numbers anymore. And they're still growing at a dramatic pace. So I don't think Anthropic is the one that is overpromising. I think the thing we have to worry about is, are there going to be some of the legacy companies that are going to be losers in this? And clearly, Anthropic is introducing more and more capabilities that are causing concerns about future growth, not about current growth, but in the next year or 2 years. I mean, just take the Indian IT services companies. They're trading at 20 times earnings for 7-8% earnings growth. And what happens if that earnings growth disappears in a couple of years? So, while I agree with Moshe that right now the earnings are fine, but the pace at which I believe that AI is developing, I think there's a real concern that disruption is around the corner. Now, maybe it takes a little longer than people expect, but the fact is it's a matter of when, not if.
Moshe, the general understanding here in India, I can tell you amongst investors, right, is that Indian IT services companies are going to be indispensable in integrating AI into enterprise workflow, etc. I think what was different last night, and perhaps is essentially because it's not general assistants trying to do everything, right? These are specialized plug-in tools for a variety of functions. So is that thesis that Indian IT services companies perhaps are not the inventors and they don't have the foundational models, but they will adapt and help global enterprises, integrate this system, these AI tools into their workflow? Is that thesis correct or flawed, or is that thesis at risk? Moshe.
Two things. One, I do agree with this thesis, but before that, going back to your question about the bubble and overpromising, we did see throughout calendar 25 that I would say a big chunk of those AI initiatives really missed their target. So the real question here is ultimately, what's the ROI on all that spending? So we're yet to get there. So I'll just leave it here. This is kind of one argument that I would kind of leave it here. The second thing regarding your thesis, we do believe that there's going to be a spending cycle that focuses on integration, on data. In our view, the sector is very well positioned from the infrastructure side of AI, massaging the data, preparing it to basically to get fed into those accelerators. So we do feel that there's a very important role for the sector to fill in, but it's going to take some time until those projects really gain traction and gain critical mass.
Moshe,
so
your view, just to be clear, is that there is, simply put, I know I'm reducing it to a binary, but the sell-off is a little overdone. Is that what I'm just trying to get that out of the way.
I think the sell-off is overdone, especially given what we've seen in the past few weeks in terms of the earnings and in terms of some of the initiatives that companies are actually going through, the repositioning their models. Absolutely.
Moshe, any conversation with investors regarding the Indian IT services companies? Because here, it's not that earnings are beating expectations, like we've seen in the case of global tech majors. So what about the sell-off that we've seen, the underperformance of Indian IT companies?
The underperformance continues to be a function of sentiment, and the sentiment has been negative for 2 years, Rima. I don't think that's changed. And that's why I said the focus will be on guidance for the year. Calendar 26, fiscal 27 for some of the other companies. This is really going to be the proof, and the proof whether these guys are doing better or not. And from what we're seeing, it seems that the next 12 months will probably be better than the last 12 months.
Yeah, Arvind, you've got a view on global markets. Are they? We've seen these pullbacks. All of them have been short-lived. Do you think it's possible we get one more of those?
Well, I think the broader market, today was just a modest sell-off, right? It wasn't anything dramatic. So I think for the broader market, things are still going okay. I think there isn't any cataclysmic or any major concern. There was a little bit of a concern about whether there's something going on with Iran. There was a drone shot down. There were some minor concerns. I don't think the broader market has any smoking gun negative thesis out there. I think, yes, the leadership has changed. So you're seeing, the Russell 2000 outperform NASDAQ. Could that continue for some time? You're seeing the metals and resources start to do well as people are realizing that all this AI spending is going to require a huge amount of resource, usage, whether it's metals or it's energy or what have you. So I think just because the leadership may be changing a little bit doesn't mean that the market is in trouble, but it's just that software has become, or the whole Mag 7 has become such a poster child for people assuming that that's where the market goes. The reality is the equal weighted S&P or the Russell 2000 are actually doing fine.
Well, it's a debate we'll keep having, Arvind, but thank you so much for coming back on after our midnight chat the other day. Good to speak with you. Thank you, appreciate it. Moshe, it's always a pleasure to speak with you, and we'll request you to come back as we track how this story progresses. But good to get a wide range of opinion on this one. We'll take a quick commercial break here. Let me just quickly run you through the stuff which is coming up here over the next 2.5 hours or so. So 8:35, the management of Lloyd's Metal joins in to discuss the third quarter numbers. 9 o'clock, we'll have IT once again, but very much Indian focus. Sandeep Agarwal of Civilo Investment is going to be speaking with us with that view. 9:20, Vinny Samre of DSP Mutual Fund is a market master of the day. 9:30, Bernstein's Venugopal Garre talks to us about the trade deal. He's written an interesting note there. 9:50, we put the spotlight on Hyundai's earnings and speak with the management. Tarun Garg there. Towards the end of the program, Lata in conversation on the CNBC TV 18 Citizens MPC in front of the RBI policy decision on Friday.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. For the time being, I'm running through the list. Pidilite, Aditya Birla Capital, Mankind Pharma, Lloyds Metal, Sheela Foam, V2 Retail, and Restaurant Brands Asia. They'll all be reacting to positive news flow, while tech stocks will get hit. Bajaj Finance and Bharat Coking Coal as well could open up in the red. Take that break, come back, we get into further detail on all of these names. Welcome back. Let's get straight to all the stocks that we're tracking for you. Our research team comes up on the screen. They're joining in with CNBC TV 18's top list of stocks for the day. Rima, you'll take center stage. Well, just revise the news.
Well, just to refresh the kind of tech wreck that we had across US markets and European markets overnight, just look at that. You had legal stocks because Claude came out with a legal update, Anthropic's Claude, and therefore you had names, like there's a company called Relex, which underperformed. LegalZoom was under pressure. Reuters was down 15.5%. Even SaaS companies like ServiceNow, Salesforce had a decline of nearly 7-8%. And names like a PayPal, Gartner, FactSet, Morningstar, all down between 10 and 20%. So deep in the red for these companies. And the Indian IT companies were not spared. ADRs of Infosys, Wipro down 5%. Accenture and Cognizant, which are seen as proxies for the Indian IT services companies, also sold off close to about 10-odd%. 1.5%. And the fear is that is the outsourcing model going to be at risk eventually? If not today, but maybe down the line. So keep your eye on IT News.
All right, so tech will be under pressure. We'll be looking at some of the banking and financials names to bat for the bulls. However, Bajaj Finance, I believe, is not on that list. Gaurav, the numbers a little bit weakish.
Well, yes, if you look at Bajaj Finance, there are two things that we need to understand first. First is that Bajaj Housing Finance is a company, subsidiary company, where Bajaj Finance sold its stake and they gained around 1,400 crores. Along with that, in this quarter, they have also created accelerated provisions worth ECL, worth 1,400 crores. Now, this 1,420 crores worth of gain is not in the PNL because it is still the holding company for Bajaj Finance. And that is the reason, if you look at the profit number, that has declined sharply. So let's look at the numbers first. Net interest income and PPOP both increased by 20%, but because the provisions were higher and it was not offset by the gains, if you look at profit, that declined by 6% and it was 20% below the street's expectation. Now, this was a weakness in the result. Apart from that, if you look at ratios, now definitely credit cost that increased, but if we adjust for this one-off impact, the credit cost was actually in line with the street's expectation. Now, going ahead, what happened is that even the management commentary, it wasn't that encouraging to say in terms of the ECL provision specifically, because what they said is that they wanted to ensure the balance sheet and PNL to be shock-proof, and at the same time, one of the reasons why they took provisions accelerated is because of the customer leverage which is rising. That is something which can hurt the stock, and that is the reason why going with red in Bajaj Finance today.
Okay, thanks very much for that. And this is the story we'll come back to because it's important for the NBFC space as such. Pidilite is the next one we're going to tackle. Mangalam is here with details. Mangalam, morning.
Good morning. So consistently good numbers coming in from Pidilite. Here's a company that, consistently delivers double-digit revenue growth, 12% EBITDA growth and 12% net profit growth. That's what happened in the third quarter as well. And that's what the street was expecting too. The revenue was over 3,700 crores. The street was expecting a similar number. EBITDA at 894 crores. The street was working with a number of 890 crores. And the net profit as well, 624 crores. The street was working with a number of over 600 crores as well. Overall volume growth at 9%. The street was working with a range of 8 to 10%. This time around, the positive is that it's been led by the consumer business, where the volume growth has been near 10% versus expectations of 7 to 8%, whereas B2B volume growth has been slightly shy of expectations. And the company attributes this to lower exports of industrial products, which I believe will improve once the US, there is some certainty around the US-India trade deal. So all these factors point towards green for Pidilite.
Right, thanks very much, Mangalam, for that. Let's move on to AB Capital now. Gaurav?
Well, as AB Capital, the numbers are actually good. Net interest income and PPOP both grew almost by 22%, while profit increased almost by 28% on a year-on-year basis in terms of their NBFC business. Apart from that, if you look at ROAs as well, they have expanded, and now management says that the ROAs will be in the tune of 2.5% in the next 4 to 5 quarters, which leaves another 20 to 30 basis point of further headroom for ROAs. In terms of their NBFC AUM, that also increased almost by 24%. Now let's move on to other businesses. Housing finance. Now this was in focus because we recently saw the deal happening. And if you look at AUM growth, there also it remained very healthy at around 48% with ROAs of around 1.96%, and company also anticipating ROAs to go even higher in this segment as well. Looking into AMC business, if you look at the growth, 11% growth is what they have delivered, and they are also saying that the fundraising is underway because of one of the funds which they have been actively looking at. So all in all, a very good set of number from the company. Commentary remains positive, so we may see some positive uptick in this counter today.
Thank you very much for that. Ekta, how did Mankind Pharma's numbers look?
Well, in line for Mankind, so revenue was up around 11.5%. Margins came in at around 25.8%, but the profit was a little below expectations. Domestic business was up 11%, which is basically the bulk of their business. Within that, the consumer health business, which is a part of the domestic business, was up around 5.2%. It was down 10.2% Q-on-Q, and exports were up around 14.1%. So both domestic business as well as exports did well. Overall, an in-line quarter for Mankind.
Okay, all right. Ekta, thanks a lot for that. Well, I'm tracking two companies. One is Lloyds Metals and Bharat Coking Coal. Lloyd Metal, actually, the numbers look quite good. They enhance EC limits for iron ore, faster ramp-up of the pellet plant, and improve sponge iron volumes. All of them put together led to a surge in the top line. Margins as well improved because higher value-added products is what they're focusing on. Pellets, the commencement of the slurry pipeline as well has helped them report very, very robust margins. Now, the EBITDA numbers come at around 1,750 crore rupees. I recall a time when in the full year they were doing 1,500 crores. Now, on a quarterly run rate, they're doing this sort of a number. So it's looking quite good, with margins at around 35%. The guidance should come up for you. They've been aggressive. Since they've got EC limits, the iron ore volumes will ramp up, pellet as well will ramp up, and they'll be moving into a steel company as well. And we'll see glimpses of that in FY27. So that's a stock expect to open up in the green. That's already corrected 20% from the top. BCCL, that's the other one we're looking at, the newly listed company. It listed with a premium of more than 90%. The stock has come down since then, but the management actually had told us that things were soft in the past quarter, but they expect things to improve from here on. So we'll have to track how exactly that happens. For the past quarter, the offtake is down by close to 10%. Realizations is down close to 14%. That's why you're seeing the top line degrow, which has flown down further into all the other numbers. The receivables as well have gone up. So BCCL float is limited, but expect the stock to open up in the red. That said, let's go back to Mangalam. He's highlighting some more earnings. Mangalam, run us through the list.
A bunch of numbers and all of them green, Nigel. Let's start with Restaurant Brands Asia, basically the owners of Burger King India. Good performance coming in, 12% consolidated revenue growth. The EBITDA has actually grown by nearly 30%. Margin expansion, losses have narrowed. And remember, this is just a reported loss because the company's cash profits are higher on account of higher depreciation. They report that loss. SSSG in India is at 4.5%. That's a positive. They've added nearly 67 stores. And the big trigger for them, obviously, during this quarter, where Everstone sold their stake, and there is a new change in their ownership. So these factors should play out in the positive for Restaurant Brands Asia. V2 Retail as well. Performance, solid performance coming in. 57% revenue growth, 55% EBITDA growth. Net profit nearly doubled, and the company's opened about 35 stores in this quarter. Reported SSSG for 2%, but if you account for the festive season shift, it's actually a near 12% SSSG growth that the company's reported. And they've also announced a board decision to split the stock from 1:10. And finally, Sheela Foam, the Kurlon acquisition, finally doing well for them. Overall revenue growth at 11%, EBITDA grew by about 30%, and the net profit on a very feeble base grew from 20 crores all the way up to 50 crores. So all these factors doing well. Mattress volume growth of 11%, foam segment grew by 20% for the company.
Thank you very much for that. And a lot more companies came out with numbers like Nazara Tech. You can keep watching that ticker. Kansai Nerolac profits went down by 82%. Before now, let's talk about gold, because gold is back above $5,000 per ounce, and lots of updates coming through in crude and copper. Manisha?
Oh, well, absolutely. Pardon me. I'll start with gold first, because 6% of gains in the overnight market. We are trading at around $5,050 an ounce. This is the biggest one-day gain that we've seen since 2008. And that's the kind of volatility that you're looking at in case of gold and silver, making records on the way down and on the way higher as well. Having said that, it really is about the geopolitics that the markets are keeping an eye on right now. So even as US and Iran are slated for a conversation on Friday, the US forces have downed an Iran drone in the Arabian Sea. There also are reports that Iranian vessels have challenged a US-flagged oil tanker transiting the Strait of Hormuz, and that really seems to be keeping not just the gold and silver prices in the positive, but the crude oil prices, which also gained nearly 4% in the overnight market, so much so that we are back above $68 a barrel for the Brent there. Also supporting the crude prices is the U.S. crude inventory declined by 11 million barrels. This is the biggest decline that we have seen coming from the month of June. And then there also are reports from OPEC Plus suggesting that the global oil demand will pick up from the month of March or April, and it would be in the first week of March that OPEC will decide on further output plan. So various statements, much anticipated, and then of course you have the Chinese Lunar New Year holidays coming in as well, and ahead of that there is some restocking in metals. That also seems to be quite supportive.
Manisha, we'll come back to you. Very interesting. Thank you very much for that. We take a break. We're back. Rajat Rajgaria of Motilal Oswal Equities is going to be with us on the trade deal and markets ahead. Stay tuned. Welcome back. Rajat Rajgaria is with us, MD and CEO at Motilal Oswal Institutional Equities. Rajat, good morning. Great to have you with us here. Rajat is someone who has the pulse of what foreigners are doing, what large investors are doing here in India. Rajat, and I want to ask you exactly that, because people are all, there's only one question. The mood's changed for the better. There is no slip or any walk back on what was announced with regards to India, US in the last 24 hours. There was some concern yesterday, but nothing. So all good. The question is there going to be follow-through over the next couple of days? And is the FII, the FPI, back in a durable way?
Yeah, hi, Prashant. I think very quick response. If you look at India, I think we were an outlierish underperformer last year and the first 30 days of this calendar year. I think this deal transforms that. We have a lot of catch up to do in this whole global rally of last 15 months. This event is big enough to do that. You will see follow-up not just for a couple of days, but I think we believe the trend reversal has happened. You will see foreign flows being very strong. They sold $35 billion over the last 15 months. You will see a very large part of that money which will come back over the course of next few quarters.
$4 billion, Rajat, was sold just this year after the $30 billion last year, right? So how much, I know it's not an exact science, Rajat, but how much do you think in that sense comes back? And this is feedback you're getting. I know that you speak every day to some of the largest investors out there, and that's the feedback you're getting. People are ready to come back. Discretionary money.
Well, Prashant, if you look at the EPFR flows, the India funds have been receiving inflows every week for the last few weeks, but the market flows have been negative. I just think that a reallocation within the existing funds itself will be large. But more importantly, moving from the highest tariffed nation to the lowest tariff nation. Let the good news sink in, let corporates start planning it out, and you will start seeing some order announcements happening from the global companies to India, which had probably stopped over the course of last 1 year. This is very big news. It will play out slowly, but for surely.
Rajat, hi. So what will go up? What is likely to do better? Will it be the large liquid names, the ones where FIs can take large positions, HDFC, Reliance, some of these IT names? Or is this a time to look at mid-cap and small cap? Since there is such a discernible change in the sentiment, many of these small and mid-caps have been beaten out of shape.
Absolutely. You know, in your own channel, I think every day you get guests, someone who favors small caps, someone who favors large caps. We look at every stock on its own. I think 3 buckets of stocks you can think about. First, the very direct beneficiaries of this US tariff deal, but largely it will center around small caps. You can't put big money into that. I think second, big sectors which are second derivative plays. I would think lenders, financials are a very large segment of second derivative plays on this whole tariff deal. And I think third, the poor sentiment led to a lot of valuation correction in large mid-cap franchises. Some of these stocks are down 30, 40% from their highs. Maybe the highs were also not justified. But post this big correction, those third bucket of large mid-cap franchises becomes more attractive.
Got that. Rajat, you also have such a strong view and on the supply which is lined up, right? That's the other point. As soon as the market starts to look healthy, there is a ready supply book on the other side. So is it, and it's a very large pipeline. So very quickly it'll realign, right? Let's hit it now. What's your sense?
Look, the pipeline is very large of IPOs, QIPs, secondary market blocks. And if markets go up, you will see a lot of these pipeline getting activated. Already in the last 2 days, I think you are seeing IPO launches with firm timelines being announced. I can already see 3 to 4 IPOs being firmly launched up for the next couple of weeks. A lot more are going to come. But, you know, the important thing is the markets will align both on supply and demand on this. You are not just going to see a frenzy activity. You will see good quality paper, reasonable prices, and maybe curbed sizes before you start seeing large scale foreign flows. As I mentioned, the intensity of foreign flows will decide how big a pipeline will get built, because FII flows would need liquidity, and for best is to match through a lot of the primary market supply.
Yeah. You began by saying trend has changed for the better, right? I mean, so downside kind of now is protected, that 24,500 kind of levels, and upside, I mean, we'll have to see depending on supply and where that matching happens, Rajat. Is that a fair way to paraphrase what you said?
Yeah, I think downside is protected, but please note three more things. While we put a lot of focus on the budget in this government, you have been seeing budget announcements
Through the course of the year, yes.
Reform announcements continuing throughout the year, right from the government to the RBI.
Absolutely.
A lot of other regulators. But they kind of got sidelined because of this tariff wars and the FII selling.
Yes.
Once you have clarity on these two,
yes,
I think the intensity of stock reacting to good news will be a lot more today than what you saw in the prevailing 12 months. So I think, if the markets keeps touching 26,000 Nifty every 6 months, it's not the same valuation. We have been stuck in this range for last 15, 17 months. We will decisively break this if these trends persist.
Rajat, it's such a useful conversation, punchy, short conversation, and we'll have you back, request you back on soon again. Thank you very much for that perspective and what you're picking up here and now. Let's go across to our first corporate conversation. Nigel, I think we have the Lloyd's management with us.
Well, that's right. We have Mr. Rajesh Gupta, the Managing Director at Lloyd's Metal and Energy, who joins us on the show. Hi, Mr. Gupta. It's been a while since you joined in on the show, so good to see you in. Numbers look quite good, and you've been moving from strength to strength. Let's get a couple of numbers out of the way, going by the kind of EBITDA you're delivering now on a quarterly run rate, which was actually what you were doing on an annual run rate earlier. Now you're guiding for iron ore production, I think, of around 25 million tons. Pellet production, you're talking about around 6 million tons. If I just extrapolate the EBITDA number from the EBITDA per ton that you're doing, between these two, you could do around 7,500 crores of EBITDA in FY27?
Good morning, Nigel and CNBC team. Thank you for having me back. You have touched upon two of our products, pellets and iron ore. Iron ore will be around 26 million tons next year of production and around 27 to 28 million tons of sales next year, because we would have a carryover stock from this year. Pellet would be around 7.5 million tons next year, with the second plant also being commissioned well in time. Our other products would include copper, which would achieve 10 to 12,000 tons next year. And Triveni itself, which would have a top line growth of around 15% to 20% overall, with volumes increasing in non-boiled iron ore by 40%, sorry.
Yeah.
In coal, NTPC coal by around 15%. And of course, the gold mine revenue would also start coming in.
Okay.
There will be some degrowth in Triveni in Indonesia and maybe in barite operations as well. So with all this, we expect a very good bottom line, maybe crossing what figure you just mentioned. But I wouldn't want to venture against that's a factor of so many other things apart from our performance.
Yeah. Mr. Gupta, just to focus on both those aspects, the production number we have got of both production and sales, and I just think there'll be some carryover both on pellets as well as on iron ore. Now, the EBITDA per ton that you're doing currently, it'll be more or less sustainable. Is that correct?
I would expect more, not lesser than that.
Exactly. So that means EBITDA of both these two segments itself will be around 7,500 crores mathematically. We'll get to that point in just a bit. What about the scalability of Triveni earth movers, and also the targets on Geo-Mysore gold mining MDO? That's another small part of the business, but that is scaling up as well. Could you tell us, I think you mentioned Triveni will grow 15%. On the EBITDA front, that could do around 1,800 to 2,000 crores next year, just this entity?
It would be around 2,800 to 3,000 crores, because 15% growth on top line means exponential in bottom line in Triveni being a service business. And in terms of Geo-Mysore, which is our gold mine company in Andhra, that is now already started production. The MDO has been awarded to Triveni, and we expect a very good bottom line from that operation as well. The mine itself is already producing gold of around 50-60 kilos has been produced, and 600-700 kilos will be produced next year.
Okay, got it. Just to...
Picked a mine after maybe 30, 40 years.
Okay, got it. You're at 62,000 crores of market capitalization, and the street wonders a company that's doing only 1,700 crores of EBITDA on a quarterly run rate, which is actually a big improvement. Now, going by you're saying that Triveni will do 2,800 crores of EBITDA next year. And if I put in there the iron ore as well as the pellet EBITDA, in FY27, the EBITDA number should be looking like 10 to 11,000 crores. Would there be a fair estimate as of now? Some analysts are factoring that in. That's why I just want to understand whether they are on the right path.
Nigel, our top line this year, 3 years back, is equal to our bottom line this year.
Correct. That we have, sir. But what about the path ahead?
And we hope to repeat this performance over the next 3 years. For the coming quarter and current year, I would rather not hazard a guess. That's more best left to the analysts. We are working in the company in management for decades, breaking up our performances and our operations over the next 3 years.
Yes.
And I just mentioned the target that we hope to achieve there.
Correct. So the analysts but are not very off when they're talking about 10 to 11,000 crores, right, of EBITDA, mathematically.
Everybody has the same kind of calculator, I'm sure.
Okay. All right. The copper business, you're looking at de-risking your business. You've gone ahead and bought 50% in an overseas entity. And I think you mentioned 10 to 15,000 tons. Now, mathematically, if I put that in, what could you do? I think the top line will be close to around 2,000 crores from that entity. So you could another 500 crores of EBITDA from that entity in the coming year?
Probably a little better, but yeah, in that...
5 to 700 crores of EBITDA. Would that be fair?
I would... You are wanting to pin me down on projections. I don't want to do that.
Yeah.
But again, the mathematics is known to everybody.
Okay, we would have liked to ask you also about the deals with regard to what you'll have done with Tata Steel, but that discussion for another day. We appreciate you joining in. You've given us a fair bit of color. The outlook looks pretty positive going by what analysts are estimating. And it seems that you more or less, agree that those calculations are not very, very far off. All the best. And thanks a lot for joining in.
Thank you, sir. Thank you, sir.
Okay, well, time to slip into a short break. We'll come back and we'll have our technical experts, Mitesh as well as Sudarshan, are waiting for us. Welcome back. We have a terrific Tuesday yesterday, but what does Wednesday hold for us? Mitesh Thakkar, President, Retail Research at Bonanza Portfolio, and Sudarshan Sukhani, Proprietor of Technical Trends, join us on the show. Good morning, gentlemen. What do you do? Yesterday, a 600-point finish is what we had, but at one point of time, we were up close to 1,200 points. Mitesh, what are the levels you're looking at on the Nifty, and what would the trade be?
Good morning, Nigel. I would want to prefer to start with the bank Nifty. See, the Nifty kind of opened near the earlier highs and tapered off and closed much lower than the highs. But the bank Nifty, and let me highlight this fact that the bank Nifty has tried to close above 60,100, 200 zones on 5 separate occasions in the last 4 months, and it's failed. And yesterday also, while it opened at highest ever levels, the closing was below 60,100, 200 zone. So I think, it's very close to those levels. I'll keep a close watch on the Bank Nifty. In case the Bank Nifty is showing strength to close beyond 60,200, I think that will be a fresh breakout. And then we can look at the Nifty trying to regain and retest levels of 26,000. In case the Bank Nifty fails to do that, it could be a quiet day with, some intraday decline happening during the day, which could be a buying opportunity on both the indices.
Okay, got that. Sudarshan, what about you?
Yeah, good morning. Well, we had that big rally yesterday, big gap up. Shall we call it the father of all gap ups? But whatever it was, the markets should now cool down. These gap ups, these large breakouts invariably lead to a period of consolidation. I would expect the Nifty to slowly come down to a support level, which is between 25,400 to 25,500. That's an approximate range. And that's the location where I would suggest buying. That may not happen today, but the idea is that we should see a slow slide to support levels.
We'll take a break. We'll come back with specific trades from both of you. Stay tuned, coming up in just a bit. Welcome back. 9 o'clock, and we are running into market open 20 points lower on the Nifty, about 370. But this is, of course, the first couple of seconds of the pre-open. Things will settle. Let's get the trades out of the way. Mitesh and Sudarshan are with us. Gentlemen, morning. Mitesh, what do you have?
The list of all buy-side trades, assuming that any intraday dips will be bought into. So a buy on Bajaj Finance with a stop at 949 for targets of 995. Bandhan Bank is also a buy. Keep your stop at 152. Look for targets of 162. A buy on Dixon Technologies on a mild decline, it's around 10,950. Keep your stop below 10,600. Look for targets of around 11,500. And DMart is the final buy call. That's a buy with the stop below 37.49 for targets of 38.40.
Sudarshan, hi, good morning. Which stocks are you looking at for trade today?
Yeah, good morning. It's a buy on dips opportunity here also. Granules is a buy with a stop under 560. Jubilant Foods is a buying opportunity with a stop under 495. Indigo is a buy with a stop under 48.50. And LIC is a buy with a stop under 820. It's an all buy list. While the Nifty is expected to come down, that's what I think. There will be stocks which will be worth buying on any small dip.
Okay, all right. Well, gentlemen, thanks both of you. And I liked it, Sudarshan, what you call it, the father of all opens. But the point is the close was a bit kiddish, right? It was not very fatherish. We came off quite sharply. But hopefully, moods turned and prices will stay turned as well. Thank you both. And we'll talk again soon. Sandeep Agarwal is fund manager at Sovilo Investment Managers. Sandeep, good morning. Good to have you with us here. Big sell-off last night in IT services companies. Overdone or not?
Hi, good morning, Prashant, and thanks for having me on the show. So I think, as far as the sell-off which has happened, ex of Indian IT services, in my view, you will see consistently, the multiples for all those players will continue to come down, and there'll be a slow, what will happen is while earnings will not see immediate impact, but the multiples will keep on getting de-rated. And this is our view for last, more than a year. We continue to believe that, it is super hot. So we don't believe that they can sustain this kind of valuation and multiples. Although in case of Indian IT, we have slightly different view. We don't see that there'll be a sharp impact on the actual fundamental numbers immediately because we have most of the contracts which are long run 5-6 years. So
right, Sandeep, let me just you started the thesis that P multiples will keep compressing is for that view is for IT services companies across Indian and otherwise.
Yes, absolutely.
Okay.
That is what my view is.
Okay, because you start by saying, well, X of IT service. Okay, but the actual impact may not be that large. Fundamentally, that impact, at least in the foreseeable future, in terms of earnings, etc.
So that is what I meant by ex-Indian IT services. So in ex-Indian IT services, the fundamental impact will also be quicker and sharp, and the multiples will also compress. But for Indian IT services, I don't see fundamentals will come down sharply quickly because we have long-run 6-7 year contracts. So every year you will have only 2-3% negative impact. So you have to go and find that new business. So, but yes, we are in a space where, low growth for a long time for large cap Indian IT companies is definitely going to be there.
Sandeep, just getting back to basics. Now, agentic AI is not new. So can you simply explain that what was it that Anthropic's Claude, the agent, what were the developments, the updates, which actually spooked the street this time to this extent?
So, I'm surprised, honestly, by the move because, this technology is not something new. It was always there. It has just been repackaged and launched. So, to that extent, now it is people are now seeing it as a threat while it was always there. It has been now given in a more user-friendly way, and that is the reason people are spooked. Also, remember that, the first impacts will be where there is a lot of data to refer to, so legal services and similar other services. So I don't know, whether that should seriously spook so much for the Indian IT services also because we will have second line impact and not first line impact. So as I said earlier, also we are running 6-7 year contracts most of the cases. So you will have limited impact every year, but yes, we will be low growth for a long time. That definitely is there. So maybe multiples will derate over a period of time. But I don't see, this something new. This is just one day when it has happened. Let me put it this way. It was there for quite some time now.
Yeah. Got that. Sandeep, so what's the thing to do then now? I mean, I'll tell you, many sophisticated investors were of the view that maybe IT services sector is the sector of the year, dark horse, whatever you want to call it. because it's been ignored and shunned and et cetera, but you think it'll play out that way? And from an actionable standpoint, what should one do to protect and to make money?
So Prashant, I will tell you what will happen in the sector now, where the stocks will be very tough to give a call. But let me tell you this, that, there are two fundamental changes which has happened. People are comparing this IT disruption also with any other past IT disruption, which is grossly wrong in my opinion, because, this is the first disruption where efforts are going down by 20-25%. So definitely it is not like past disruption. You have to find that, compensate that 20-25% effort in future. Second, on the positive side, this disruption will be over a period of 5 years because our contracts are for 5 years. So whenever they get renewed, you reprice it. The efforts get reevaluated. So not sharp impact immediately, but long 4 or 5 years, we are 5-6% growth industry. Now, what multiple you want to assign for that industry, X of rupee benefit, is something which investors and the fund managers and the people who are managing the assets will have to decide. We are very clearly of the view that, the small caps will do better than mid cap and mid cap will do better than large cap. Having said so, we still don't believe that, any of these segments have a good peg ratio to invest right now. We have been very, very negative for last more than 12 months on the space. We continue to be so. I believe that, after 12 to 18 months, probably both, some correction in the price and some correction in the multiple will happen. And because of that, you may find some good opportunities in some of the spaces. But as of now, I don't see the sharp fall in fundamentals, but I do see that low growth for long term is what will happen.
What about ER&D companies, Sandeep? You were excited with their growth prospects, but KPIT numbers were not anything very exciting. What's the current view now on ER&D companies?
So, ER&D, I continue to believe that will do better than IT services. But as I have said earlier also that, they are obnoxiously priced. So even after the correction which these companies have gone through, I think they are very, very super priced, very, very overvalued. I would buy, even ER&D companies at maybe 15-18 times forward earnings so that, I can make some money on that. I will not invest in any of the ER&D companies at the current level. So our view is very clear. The large names, 11, 12 times forward earnings and mid cap at 15-18 times forward earnings is something which gives us some comfort to make money. Otherwise, we will wait for our turn for the right prices to be there.
Quick word, Fractal Analytics IPO opens next week. They're looking at a market capitalization of about 15,000 crore rupees. Now, this was a data analytics company, and just going by Anthropic's Claude developments overnight, that's the segment which stands to get disrupted. What is your view on Fractal?
So I won't comment on a specific company, but let me put it this way. There is very, very fast developments which are happening in the space, in the AI side and the analytics side. So, you can be a big beneficiary, so it can play out either way. So we generally will, we have a philosophy. We generally don't invest in loss-making companies and companies which are yet to turn profitable. So for us, it is not an investment space. And we will definitely watch it for next 4-6 quarters. If we get reasonable, better, it is fairly valued, we probably may be interested, but not at this level.
Okay, all right. Sandeep, thank you very much for that. Good speaking with you. Appreciate your time here on CNBC TV 18. Well, I think that's a very useful conversation and framework to sort of listen to and have as you approach markets in this particular space right now. 9-10 calls. Sudarshan and Mitesh are back with us. Sudarshan, what do you have?
It's granules. Buy granules with a stop under 560.
Okay, granules is a buy. And what about you, Mitesh?
I'll go with the buy on Bandhan Bank.
Bandhan Bank is a buy. These IT companies, IT stocks, as you're seeing them open up in the pre-open, actually, the pre-open has ended. Anything, Nitish?
So yesterday we had a call on Coforge. I think that's a stock which is bottoming out. That apart, I think, what I like is Tech Mahindra. That's one of the strongest stock in terms of performance and could do well if it starts getting past 1750 again.
Okay, all right. Coforge perhaps bottoming out. Tech Mahindra, the strong name in that pack. So that's the view. Mitesh, thank you very much and speak again soon. Bajaj Finance, want to revisit the numbers and the pain and asset quality. Gaurav, take it away.
Well, yes. But for Bajaj Finance, we need to understand two things. First is that they sold some stake in Bajaj Housing Finance worth 1,420 crores in this quarter. And at the same time, they also created accelerated ECL provisions worth 1,400 crores. Now, what is happening is that because Bajaj Housing Finance is still a part of consolidated Bajaj Finance, it is not considered in the P&L, the gains, I mean, they are considered in the net worth. And that is the reason, if you look at profit, the number actually looks lower than the street's expectation. So, net interest income, PPOP, both remained in line, grew by 20%. But when it comes to profit, that declined by 5% on a year-on-year basis and 20% below the street's expectation. Now, what management is saying is that the ECL provisions, the accelerated ECL provisions that they have created is specifically to make sure that the balance sheet and P&L remains sound and shock-proof. And at the same time, they also said that one of the reasons why they have gone ahead with this accelerated provision is the customer leverage and the increased competition that they're seeing. Along with that, on the flip side, on the positive side, what they're saying is that despite this accelerated provisions, the credit cost in next year are going to be in the range of 165 to 175 basis point. Now, if you look at the overall outlook from management, at least in terms of growth, they say that the growth will be in the range of 22% versus the guidance that they have given up 22 to 23%. So again, for FY26, we may see the growth being at the lower end of the guidance, but going ahead, we may see some kind of increase in the growth. All in all, what is happening in Bajaj Finance is that given that the valuations are still higher than all the peers, above 5 times price to book, and we have already seen 6% rally in the stock, it is really important to see how investors take these comments as well as the accelerated ECL provision into consideration. But in terms of numbers, if we exclude that ECL number, the numbers were more or less in line with the street's expectation for Bajaj Finance in this quarter.
Okay, thank you very much for that. We're watching for Exide this morning because Nomura has upgraded the stock to a buy. Their target price stands at 398. Q3 numbers were largely in line with expectations. So auto growth was healthy. Industrial, according to Nomura, will recover. But what they say is that Exide has corrected by nearly 20% in the last 3 months. So it's underperformed the Nifty, which has fallen by 3% in the similar period. And therefore, valuations after this correction have turned attractive. Now, about 3 months back, when they came out with their Q2 numbers, Nomura argued that the stock is trading at 13 times core EPS. Core EPS is excluding their holding in HDFC Life. Remember, they have about a 4% holding in HDFC Life. Even their lithium-ion cell capex. If you strip that out, stock 3 months back was trading at 13 times. Now, after the correction, it's trading at 10 times FY28. According to them, that's attractive. The EPS of this company is likely to go up by 17%, and therefore they've upgraded the stock to a buy with a target price at 398.
All right, absolutely. Rima, thank you very much for that. We'll, quickly recap things here for you. And the stocks that we covered since the morning. So on your screen now, Pidilite, Aditya Birla Capital. You've got, what else? Mankind, which is coming up with 1.6% gain. Lloyd Metal is up about 7%. We had the management with us earlier. Sheela Foam is coming up with gains as well. V2 Retail and Restaurant Brands Asia, the other names which are up there as well. Nifty IT Index is down 4%. And that's the sector we've highlighted and focused on from 8 o'clock this morning. So we've got a couple of seconds to go for market open, and we will take it from there. We'll look at the indices and the heat map, and then we'll get down to individual names on the big wall. What do we have? First rates, the bells gone off, and 120 points, 25,600. That's 140 odd points lower. The Nifty Bank is down about 80 points. Sensex is down about 500, and the mid-cap index is down about 500 as well. About 1% lower is what you have coming through. So yeah, I mean, 1,000 stocks are higher, about 700 stocks are lower. That's the advanced decline ratio. So broader market still more up than down, but this is a bit of a bite out of the big gains that we saw yesterday. The heat map, perhaps before we do anything further. Okay, I don't think we have the heat map. So let's go across to Nigel now. He's on the wall with what's happening. Nigel, over to you.
Well, market's cooling down after the big run that we saw yesterday. So the Nifty should come up for you on the screen. Well, that's pulled back a little bit, close to around 70, 80 points. But I'll tell you what, the first tick actually it was down 150 points. The Nifty Bank, that's the one that's actually trying to bat for the bulls because the tech index, well, that's lost its way. Tech has got slammed in today's trading session. The Nifty Bank, well, that's taken onus on it and saying, let me bat for the bulls. Also pull up Reliance Industries because let's see what that one's doing. If in case we need to offset what the tech index is down, that's down close to around 2,200 points as we speak. Reliance Industries and the Nifty Bank, they'll have to do bulk of the heavy lifting. But keep an eye out on this number. This is the advances number at around 1,000 stocks. Well, by the end of today, I'll want to see more number of stocks advancing than declining. Yesterday, by the way, it was a bit of a record that we were at around 2,500 stocks that were advancing. Tech is getting knocked back, so all the frontline names should come up for you. Whether you look at Infosys, TCS, or even Tech Mahindra, all of them are lower in today's trading session, so they are seeing some selling pressure. Bajaj Finance, well, that stock has opened up more or less flattish the last time I checked. For the time being, I think let's pull that one up. I think it was March in the green. Now it's in fact down close on 1.3%. And Gaurav had highlighted that there were some concerns on that front. Stocks that went up yesterday, they are seeing some follow-through buying. So you have Gokul Das. That stock is building on those gains. Yesterday 20%, today up another 10%. Kitex Garments as well. That's the other stock in there. That's up and about in today's trading session. It's a good move is what we're seeing on both these two names. Sheela Foam, the numbers look quite good. So a couple of good earnings reactions. Whether you're looking at Sheela Foam, whether you're looking at Lloyds Metal, both of them are up close to around 7 to around 10%. I think Lloyds Metal now is up 10%. Sheela Foam up close to around 15%. So good going out there. Add to the list V2 Retail as well. The numbers look quite good, 4% higher on that stock. But there are some losers as well. So you have BCCL. Remember, the stock listed at a premium of around 90% in comparison to its IPO price. However, a bit of a shocker now, because from around 45 rupees on the day of listing, stocks come down to around 36, 37 rupees, but the float is very limited. JK Lakshmi Cement, the numbers look quite weak, particularly in the realizations. We require some clarity on that front. Stock already 20% down from the top. Now it's down close to around 4% as we speak. And Aarti Drugs as well from the broader markets. That's another stock that's down close to around 6.5%. Dam Capital is the other name that comes in there with some losses. And since it's that sort of a day where you have a lot of stocks that are declining, Dam Capital is down and Latent View as well, seeing some selling pressure. But as we did that, that quick check on the markets, take a look at what's taken place. The Nifty, that when I started off was down close to around 100 points. That's fought its way back. And now, in fact, it's trading more or less flattish. The Nifty Bank, Reliance Industries, both those two big boys, they'll have to counter what the Nifty IT Index is doing in today's trading session. Because tech is under pressure. Prashant, back to you.
Yeah. Nigel, thank you very much for that. Vineet Sambre is with us, head of equities at DSP Mutual Fund. By the way, the Nifty IT Index is down 5.5%. That's a very large fall coming through on that index. Almost 6% now gone. And we'll have all these names. We have persistent, but let's put 5, 6 of these top losers across the board at the bottom of the screen. Vineet, good morning. Great to have you with us here. Thank you very much for joining us. Just your view. Do you own this space? Are you market weight, underweight? And what's the view from here? The news, of course, is this Anthropic AI agents and in a plug-in form, which kind of helps in integrating with enterprise workflows in a much better way. And of course, stocks sold off last night. Accenture, Cognizant, EPAM, Globant, and we're seeing that here as well.
So good morning, and I think clearly these are very difficult times, and things change very quickly is what it looks like. But before I start, so let me say that we are broadly either equal weight or overweight in our IT sector across the portfolios, including my own portfolio. I think here the thought is that we have seen the commentaries from some of these companies globally, which has caused the panic. But I think before we react to this news, it is important to understand, from our companies that what exactly could be the earnings impact, if at all, from this development. And if the companies believe that eventually, while there is a deflationary impact overall. Because of the AI is very well known, but also in terms of the quantum of volumes of work which can grow because of the modernization of applications eventually, which has to happen, and how is that going to help our company? So maybe I'm biased because of the ownership, but I think it is important to get deeper into the analytics to understand how exactly the earnings are going to be impacted for the companies out here. And if there is a threat to the earnings in a big way, that's the cause of concern. Otherwise, some of this news also maybe creates more opportunities over the medium to long term period is what we are thinking as of now.
It's interesting, right? The Nifty IT Index is down 5.5%, 6%, and the Nifty is still in the green. And perhaps one reason why it's being held up, of course, is also Reliance. If we can pull up Reliance, RIL's weight in the Nifty is what, guys? Mangalam, hi, morning.
Morning.
Is 10, 11%.
9,
10%. So, and that's up 1%. And the Nifty IT stocks weight in the Nifty index is about 11%.
Yeah.
So
it's outweighing each other. In fact,
it's playing off. Let's just actually look at the what's moving the Nifty. I think that'll give you a sense of why, with that kind of a fall, the index is actually flat, but actually higher a little bit. And I think it is a reliance to a large degree. We'll do that. Vineet, so markets though from here, how does the view change after the India-US deal? Sentiment is a little more upbeat. There's been no walk back, no slips in the last 24 hours from what was announced initially. So durable turn in sentiment, you think?
Yeah, clearly, I think this was one of the important, events which actually turned the sentiments, most importantly from the foreign participants last year when we had this additional 25% tariff. Now, with this change, I think in the region, we become the most competitively placed as far as the tariffs are concerned. While, there are nuances and conditions which have been put, for this tariff to, stay effective. But at the moment, it looks like, the sentiments should turn. And more importantly, what was causing the panic, as we understand, is anyways, the growth is something which is lackluster from the earnings perspective. And the rupee was also in a constant kind of a pressure, in a constant pressure. So I think from the sentiment perspective, if we have some kind of control on the rupee, I think that itself should be positive from the investors' perspective. And anyways, the results are coming out. I think the downgrades in general, they have sort of now we have seen a downgrades season generally getting over. And as the earnings momentum maybe catches up over the next 1 or 2 quarters, we should see the markets also, picking up from there.
Okay, all right. When you just hold on to that thought, Prashant, Reliance Industries has around 8.5% weight on the index. But besides Reliance Industries, you have a couple of other heavyweights. Bharti Airtel, well, that has close to around 4.5% weightage. That's up close to 100%. And Mahindra, that's in there with around 3% weightage. That's up close to 1.5%. So all those boys, they're saying there is trouble. Let's go in there and play a good knock today, and help the Nifty out because the team requires a good innings. Reliance is doing the heavy lifting. You have the Nifty Bank as well. That's top of the pops. And, the middle order is batting around the top order. What do you think, Mangalam?
I take that point, Nigel. The middle order is batting around the top order.
Needs to back by
tail. I don't know which tail you're talking about, Arya. But, the good part from a bull standpoint is that this Claude-related decline that was there was a godsend for those who were waiting for a dip. Because yesterday you didn't get that opportunity. It was a 1,200-point up move that we saw immediately. And from there was understandable profit taking. We ended about 600 points higher. For those who wanted to enter after that sort of rally, they had to wait for a dip. And that dip came by and those guys lapped it up. The Nifty's moved higher, up around 30 points as we speak. And it will be very interesting to see how, the mid-cap index also does. Because while at an index level, it's been buoyed down by a lot of these mid-cap IT names, the broader markets tell you a completely different story. 1,600 stocks which are in the green for about 900 stocks which are in the red.
And Hormuz is on top of the game. He says that 5 IT stocks have lost 1.2 lakh crore in the first 5 minutes of trade. So that's the kind of market cap erosion we're seeing on some of these IT names. By the end of today, you'll want the IT index to end at least, higher than what it is starting off, down close to around 5.5%. But let's get back to the chat.
Yeah, well, let's get back to the chat with Vineet. Vineet, you did say that, sentiment has been improved because of the announcement of at least a resolution for the India-US trade. There was the budget as well, where there were no obvious negatives from an economy standpoint, barring the hiccup that was there on the STT front. So sentiment is usually what drives the broader end of the market along with earnings. You say that earnings are, now beginning to, the downgrades are beginning to end. Sentiment is looking a lot better. Prices are still 30-40% off highs. You think that correction will be undone over the next 6 to 8 months? What is your sense, especially for someone like you who specializes in the mid and small cap names?
So I think clearly the valuations now are looking much better versus what we had maybe a year and a half back, where I think there was a lot of froth in terms of the valuations, which was also one of the big pushbacks as far as the investment is concerned. So now, from the perspective, I'm actually seeing that a lot of the segments, maybe capital goods, power equipment, all of these sectors have really seen meaningful correction, and maybe not exactly very attractive price points, but they are still palatable in some form of fashion. And now what is lacking is maybe a clear, signal of earnings directionally moving up. I think if that also, comes across, then I think we'll have the market's momentum again picking up. So my thought is that the valuations look pretty okay versus what it was maybe a year back. And in terms of the budget also, a big amount of change has been done outside the budget last year with the GST, income tax, interest rate. I mean, all those should sort of feed into the growth momentum eventually is my thought. And budget, like you mentioned, Mangalam, it has not been negative, so that itself is a big positive in my case. They have taken care of the capex across different sectors. So I think it's a pragmatic one, I would say.
So what did you not buy earlier because it was expensive and are now buying because you think it is attractive? Is there anything new?
Yeah, so as I mentioned, I think the whole engineering and most importantly the ancillary businesses which are linked to the power as a sector, because power has seen demand has seen turnaround, and anyways the investment momentum is sustaining out there, and the stocks have seen correction. So I think that's one new segment beyond the others. What we anyways keep looking at, where we are actually trying to find ideas, because we had gone underweight in that category over the course of last 1 year. And that's where we are trying to look into.
All right. Hi, Vineet. Good to see you. And as always, Vineet, the last couple of days, luckily we got some good news from Mr. Trump, that we have got a deal going with him. The devil will be in the detail, but as of now, at least it's a positive. Stocks that took a sharp knock when the tariffs went to 50% were textiles as well as chemicals. What is the exposure you have to both these two spaces? And incremental money, will you be looking to allocate to either of these two?
So Nigel, actually, I think we have a decent exposure, and I keep talking about chemicals, not so much textiles, but chemicals is something which we have an exposure into. And in general, I think for that segment, this is a good news because it removes some of the barriers for them. But there's not a broad-based kind of a sector outlook changing with this event. I think this is, as I mentioned, a bit of a sentimental change. But I think from the other impact perspective, these are some sectors which also has large amount of labor being employed there, and that has ramifications on some of our other segments like banking and all. So I think from the overall perspective, that holds good. My outlook on chemical sector continue to remain positive, because we are still in the low cycle. I don't see any of the matrices changing for positive in a big way right now, but because we are in a low cycle, it is okay to hold, is my thought. And textiles, I think we don't own as much now. Earlier we used to own, but not looking at it to at the moment because of the change in the US tariff.
Okay, we'll leave it there. Thank you very much for joining us. And appreciate your time here as always, Vineet. See you soon.
Thank you so much.
Venugopal Gare is with us of Bernstein. Venu, welcome back. Thanks very much for joining us. We spoke pre-budget, not post-budget, but I think now we're speaking post-budget and post the India-US deal. After the EU deal, you wrote that very provocative note, mother of all deals, but for who? What's the view post the US deal? Yeah, go on, and then we'll come back to you. Go on. First thoughts.
Yeah. So firstly, on the in the EU deal versus US deal, I guess there is a bit of a difference, and part of it is because EU deal I felt was not relevant from a point of view of actual impact, because the average tariffs that are broadly applied on India from a point of view of Europe, our exports to the Europe, is roughly around 3 to 4% range. While I look at top 15 products that we export to Europe, it's less than 3%, right? There are certain sectors probably are at 9 or 10%, but I didn't really feel that going to 3 to 4% average tariff is a meaningful number. And number two, EU has a lot of FTAs and treaties and other things with different other countries. So what it means is that you're literally competing with a China or a Vietnam or a Bangladesh or any other country. So in that sense, incrementally didn't really seem like a game changer, or I would probably not call it as a mother of all deals by any measure. Now, India-US treaty, I guess we don't know the contours of it, as you know. All of it is just based on some broader social media communication. But the reality is that a 50% tariff on an average going down to 18% is a fairly meaningful change, and it brings us much closer to where ASEAN is in terms of broader trade tariffs. So at least to one extent, you're not being punitive. And more importantly, my broader philosophy has been that it is better to be closer to a developed country, which is a big consumer like a US, so that you don't really get damaged in the medium to long term, and probably also position yourself as a relevant alternative to China as a balancing power in Asia. Look, all of that is more from the long-term perspective, but I would probably still categorize an India, EU, US thing slightly different from India, EU, broadly from that lens.
Got that. Venu, this one thing, right? This $500 billion number, many people are coming back with that. That, this is much bigger than the size of our bilateral trade. So then we are supposed to buy $500 billion from US? So how is this good news? Now, my pushback is it's just a number. Who's going to count $500 billion 5 years later? And this looks like for the domestic audience for President Trump there. So is that the right way to look at it?
See, these commitments typically tend to be multi-year commitments, right? So it's not like you're going to spending $500 billion.
It's 5 years, but even 5 years, India imports $150 billion of oil every year. Our imports are $41 billion from the US. So 500, even over 5 years, is too big. My point is, it is just a number. I mean, and we've seen what's happened with South Korea and other countries, etc., right?
Right. See, I'll put it in a more simpler perspective. Look, I would not go to this perspective saying that it's just a number and probably nobody's going to count it. As long as Trump is there, he's going to count a lot of things. So what does it mean? It means that, look, if you're assuming your volume of exports to increase to the US, US would also expect the volume that they are selling to India to increase, right? Now, somewhere down the line, the one single measure to look at is the trade deficit or trade surplus. Right? So the India enjoys a trade surplus over the US, especially in the manufactured goods side. The point is that is a monitorable number, even if volumes increase. So if, for example, our trade surpluses increase with the US, then US will say, hey, what's the advantage of the treaty? You're actually benefiting from that perspective, right? So don't expect trade surpluses to increase materially from an India to US perspective. That's a way to look at it. Absolute volumes go up is a different argument altogether. It'll go up for imports as well, right? It is going to be an even balance treaty, so I don't think this is meant for, this is not like India is being isolated as a China plus one play, or saying that you are the only one and I'm going to basically import a lot from you only and I'm not going to import from China because I want you to strengthen against China. I don't think this is anywhere, close to that sort of an arrangement.
What are some of these goods that the US, you believe, would be, rushing to sell into India, which it wasn't so far on account of higher tariffs? What could those categories, sectors be, and what could the quantum of that be?
Yeah, so, I mean, if you were to just look at the broader things that US would do, of course, it will be broadly things like energy, right? They would want to sell their energy products into India, which is basically crude as well as other energy value chain. That's one pet project. The second thing is, I guess, agri side, they would be probably wanting to make some pathways into India from a point of view being able to sell certain things to India. Now, how much of that is a part of treaty, we need to see, because I guess India would also resist and not open it up completely. But that's the second area, which is very critical for US. The third thing is, of course, broader electronic products and things we've been anyways importing from the US that will probably continue and go up. Quantum-wise, US wants us to import a lot of defense products. And remember, this is a very critical and a very interesting situation right now, is that when it comes to India's own defense complex, we are pretty much embedded with the Russian value chain. Now, if we are being asked to stop procuring oil from Russia, what will happen if we announce 10 days later that we're going to be buying $5 billion of Russian defense products? So will this treaty hold good at the point of time? So it means that it is not just about oil, in my view. India has to rethink their entire defense arrangements as well. It's a pretty big call that India needs to take. So defense is another area. They would want to push auto and auto components into India. But look, the reality is that I really don't think, pricing wise, it's going to be material enough to really move the needle, because they'll be super premium in terms of pricing. And auto products really need distribution value chains in India, which are not existing for US companies. So I won't really be bothered about that. But bringing down a duty is a great thing, because anyways, they can't sell much into India, right? So these are the broader areas that I would sort of broadly classify.
Yeah, which is what I would imagine as well, because, the things that US definitely wants to send to India are some of its consumer products and some of its consumer brands, along with retail brands as well, and agri products. We don't know whether that's part of the treaty or not, or whether that will ever be part of the treaty or not. But Nigel.
Well, Venu, good morning. Good to see you, Vin. What about the other big event? Budget 2026. We had spoken before that, and I recall you telling us that you wouldn't mind a little bit of a slip on the fiscal deficit. They have stuck to that, actually. They're holding at, the guided path. Capex spend was, I think, as good as what you were working with, and defense spend as well, pretty much in line. You were telling us that defense spend should be that 15-18%, I think, so which has come about. However, the sentiment negative was that increase in STT. Put everything together, how would you rate this budget? The revenue estimates actually are pretty realistic. So your take.
I broadly gave a title calling it as an academic budget. And I didn't want to call it as a bad budget because my original thinking was that there is very little policy flexibility the government has at this juncture. They need to juggle next year or the year after even wage revision. So there isn't much they can do unless they increase fiscal deficit from 4.4 or keep the fiscal deficit intact, right? So I was at the camp that theoretically government should look at increasing deficit or keeping the deficit. Of course, they cut down the deficit a bit to ensure that bond markets are in shape and currency doesn't get impacted and people view us, as a bit more careful as a country with respect to debt and things like that, right? So we have followed the script in a pretty nice way. All metrics that you see from an annual perspective from capex, which is actually 9%, on the previous budget and 12% on revised budget, or subsidies which are growing, which pretty much could have been contained, but nevertheless they gave some bit to everything is the way I put it. See, the thing is, a lot of things announced in the budget with respect to tax ops around, let's say, data centers or things like allocations for semiconductors. These are all, interesting but pretty long drawn in nature. So don't expect anything to materially transform or impact the economy in the next 12 months or 24 months, right? So allocations also were not there for a lot of these new initiatives. So I'll put those things aside, but it's a slightly more longer term budget in terms of how they want to reshape the economy and sort of give benefits to newer areas. So neutralish, I would probably say, doesn't really impact the economy this year incrementally positively.
Right. Venu, and 28,100 target, right? By the end of this year, calendar year.
Yeah, see, my target doesn't change. I still say neutral on India with the 28,100 target, but the only difference is the market did fall in January, right? So that increased my return expectations without changing the target from 7.5% to something like 11-12%. So the idea for me is that I'm broadly expecting the market to retrace back to 26,000 plus, which is 4-5% return, which is a short-term rebound, which we wrote in a report yesterday post the US trade treaty. And that's basically where we are at this juncture.
Venu, thank you very much for joining us. Great speaking with you. It's a pleasure. And we'll look forward to our next chat. We take a break. We're back. The Castrol management on the other side with us to talk about their quarterly numbers and the outlook ahead. Stay tuned.
Welcome back. The stock that's been doing well over the last couple of trading sessions is Eternal. After a big decline that it saw post its results and the management change, we've actually seen the stock claw back some of those losses. So from its 52-week low, we've seen a decent pullback. Over the last, I think, 3 or 4 sessions, the stock is up around 7 to 8%, currently at 283. But let's focus on Castrol India. The company reported a decent set of numbers that came in. Revenues were up 6%, EBITDA was down, and the margins also were at around that 25.5% mark too. The net profit impacted by the labor code by about 22 odd crores. The new MD, the new leader of the company, joins us now, Saugata Basu Ray. Thanks a lot, Saugata, for joining in. Congratulations on your elevation and appointment. And this also comes at a time when there is so much uncertainty around what takes place at the globe, right? Because the deal of the parent has been done. And what we understand is that Stonepeak in the past, whatever sort of acquisitions that it has made, it's gone ahead and delisted those entities. And that was one of those reasons why, as soon as the deal was announced, the next couple of days, the street was betting on something like that to perhaps happen at Castrol India as well. Whether that happens or not, there is uncertainty. But what have you heard of the change that has taken place?
Hi, good morning, and thank you for having me. Let me first address our fourth quarter numbers, if that's all right, and then I'll respond to your question. First of all, I'm very pleased to say that it has been 8th straight quarter of volume growth, and volume growth ahead of the market, which has resulted in share gain. And this has come on the back of us as company executing the strategy that we had signaled earlier. We are building out our business in terms of reach into rural India in a big way. We are scaling up our industrial business, and we have had a lot of product innovations we've introduced through the year, which has enabled the core business to grow. And we are quite pleased with the results that we have seen at the end of the year. You are right in terms of the EBITDA margin. We had signaled that our EBITDA will be in the range of 21 to 24%. We've actually come ahead of that. We are up of beyond 25. There are some one-time charges in quarter four, but overall, I would like to reassure that the quarter four operating parameter of the business remain very strong. Strong balance sheet, very strong cash flow, which allows us as a business to respond to the environment very proactively. Stonepeak announcement has happened. It's a deal that is subject to closure, which has various regulatory things that will happen. As and when that closes, I think as a shareholder, they would announce whatever is next down the cards. But in the business at Castrol in India, we remain focused on executing our strategy, which is to go big into rural, scale up the industrial business, and we're also seeding in our services business.
Okay, all right, Saugata, but have you heard any kind of inkling whether or not there will be some action for the Indian entity? There's always that buzz, right? I've heard it for many, many years, actually. But now there's this fresh news that's come in.
No, we are not involved in those conversations. As an operating team, we are focused on our business.
So let's focus on business then, Saugata. As you indicated, we'll focus on that. Now, volume growth, I think, was close to around 88%. For this year, what kind of a volume growth are you looking at? And also, if you could help us out with how much contribution comes in from EV fluid sales. How much is it and where is it headed?
Right. So look, I think for the volume growth, to talk about volume growth, one has to look at the perspective of the market. Our estimate is the market is slated to grow anywhere between 3.5% to 4.5%.
Got it.
What we aim for is to grow the top line, volume-driven top line of this business at 1.5 to 2 times of the market.
Got it.
And through that, therefore, gain share. And we are doing that by going deep into rural India because different parts of the country are growing at different rates. Different segments are growing at different rates. Our strategy is focused on tapping onto those opportunities and build the business to get, track growth as and when the market opens up. So that's what we are doing. To your second question on EVs, it's a growing part of the business, but small. Yeah, but we are positioned to take advantage as and when the market expands. In two-wheelers, for example, less than around 10% of new sales is EVs. In cars, it's less than that. But we have got good partnerships with most of the OEMs, and we have products in the market which are ready to be distributed as and when there's demand for that.
All right, so 3.5 to 4% is what the market is expected to grow. With your 1.5 to 2 times, you expect to grow between 6 to 8%. That's the inference that the street makes. EVs, yes, it is small in the overall scheme of things as well for the industry right now, notwithstanding the chatter around that. But industrial segment, you said that that's about 12 to 15% of your business, and you expect it to grow over a period of time. If you could give us a sense on what sort of targets you've earmarked yourself for the industrial business.
So I'm very pleased to say that the industrial business grew double-digit last year. Okay, and that contributed to that 8% growth that you have picked up. We maintain that kind of guidance, which will be ahead of the average growth rate of the market. And because it's a smallish part of our business, it will grow much faster than core business. We are focused on executing a strategy which is about growing into segments such as aerospace, cement, steel, where typically we had been underrepresented. And we have a team which is today going around the country, introducing Castrol to customers in this segment, because that's what Castrol has not traditionally been associated with, and we have seen success on that front.
So do you think the industrial business grows 2x of your core growth, which itself will be 1.5 to 2x of the industry growth?
So that's the kind of range that the industrial business has been delivering, and I expect the industrial business to sustain that level of growth.
Got that.
Okay, all right. Saugata, you've also indicated that, you all are developing products for the data center business. Are you all in talks with hyperscalers, other big clients as well globally? Give us some color on this particular aspect.
You're right, and thank you for the question. Yes, we are in talks, and some of these are global accounts. As you can imagine, hyperscalers are businesses that set up data centers across the world. And there are trials that are happening in India, the trials are happening in different parts of the world. We are also putting innovation in those products and working through on what would be the next cycle of products that will enter into the market. So very much engaged. Again, a small part of our business and a small opportunity today, but positioning us for growth into the future.
From a data center standpoint, what proportion of their, BOM would be the product that you sell? We just want to understand, because by and large, the opportunity is huge. Everyone talks about that. But what kind of value chain benefit would accrue to players like you?
Look, early days to estimate that, because the technology itself is evolving quite a bit. Yeah, and there are different kind of cooling technologies in play. Their core business is not about manufacturing and producing something. So it's really about serving the requirement of removing heat so that the data centers operate at a high degree of efficiency. And we have got products which enable that particular outcome.
All right. Take that point. Thank you so much, Saugata, for joining in and giving us, your business outlook for the near term, though the street will also await what takes place in, the global parentage, the change that happens, and to the stock by and large. So that's the management, Nigel, of, Castrol. From a car engine oil maker, let's go to a car maker.
Well, that's right. Hyundai Motor India. That's the next management on the show. Remember, the auto major reported a mixed set of numbers. The revenue growth came in healthy, but margins did miss, and volumes have largely been flattish. We have with us Mr. Tarun Garg, the MD and CEO of Hyundai Motor India, who joins us on the show. Hi, Mr. Garg. Always a pleasure having you on the show. Well, in January, the volumes rose by close to 12%, with the highest ever monthly sales. Could you tell us how is Q4 shaping up so far?
I think it's a very, very positive sign, and we can see positive momentum everywhere. Thanks to GST 2.0, we saw October to December quarter also a lot of retail momentum. And what happened was, because we were able to make space in the network inventory, so January also started on a very positive note. And we are seeing a growth across segments. For example, Aura clocked the highest ever sales. The new Venue has received a great response, almost 80,000 bookings and the highest ever sales again. Creta continues to be very strong. So I think we can be much more positive about Q4. I don't really like to put a number to it, but as things stand now, the momentum seems to be very strong.
Right, Tarun, but most brokerages, they've raised their PV industry outlook, especially post the recent volume up move that has happened. What's your own estimate for the industry, not particularly for you? What's your own estimate for FY27?
In fact, now we are already at the end of FY26, and it's better to talk about even FY27. And we had a SIAM conclave where all the auto OEMs were present, and consensus was about 5 to 6% growth for the industry. I'm sure as Hyundai will like to beat that. And like I said, the year has started, the calendar year has started on a very positive note. And we believe that because the growth is everywhere and the maximum growth is coming in the compact SUV segment, where the new Venue has received a great response. And we are looking at avenues to increase the production further because we have a great backlog of orders. So I think we can really sustain this kind of momentum going forward in fiscal 26-27 also. And as we already announced in the Investor Day, our new model cycle has already kicked in with the Venue, and more models will come in. I think all that should help us to carry this momentum to the next fiscal.
Mr. Garg, you reported an increase in realization of around 3%. I assume you've taken a price hike. If you could give me some clarity on that particular aspect.
So yes, actually, if you see the last quarter, because in January 25, we had a price increase of about 0.7%. And obviously that effect has helped until December, October to December quarter. And obviously we had some very strong cost optimization measures. Yeah, as you know, we have a very strong quality of growth strategy. Even post GST, we were very disciplined in our discount levels. Which remained less than 3%. So all in all, I think all these factors have helped us to kind of have a growth in EBITDA margins and a growth in top line as well as in bottom line. Exports also helped. We had a 21% growth in exports growth in the last quarter on a year-on-year basis. And I think export continues to be a very strong pillar in HMI's quest for volume and profitability.
Since you spoke about profitability, let's talk about the margins. So will it stay around this 11.2, 11.3% sort of band despite commodity inflation?
So look, we have already, during our investor day, we have already given a guidance that our EBITDA margins will stay between 11 to 14%. And we are fairly confident to meet those expectations going forward as well.
Yeah, Mr. Garg, is there another price hike on the anvil?
So look, we don't want to do price hikes, and we always try to do cost optimization. So we'll watch the commodity prices, we'll see what are the pressures there, and we'll take a decision as and when required. But obviously the endeavor is always to avoid price hikes as much as possible and to do cost optimization and all the other measures, in terms of saving cost or localization or the trim strategy, the quality of sales strategy. So I think that will continue to be our endeavor going forward as well, unless it becomes imperative to pass on some of the, cost to the customers. But let's see. I mean, we will watch the commodity prices. The volatility is so high. You have seen how things are moving, especially precious metals and all. So I think we need to have a close watch on that.
Okay, all right, Mr. Garg, exports has been a growth driver, and you've briefly mentioned about it in the past. Could you tell us what's the strategy with regard to exports from here on?
So look, I think as you know, that now we have a headroom because of the additional capacity in the Pune plant. And so we have accelerated on the exports. We are HMC's hub outside of Korea for the emerging markets. The new venue is produced exclusively in India. I think this will present some really new opportunities for us. Middle East is doing very well in exports, Latin America as well. Now, so far, of course, Exter, it was only RSD. Going forward, we will see in case we can have the LSD, and which can again help us, going forward in terms of increasing exports. New model cycle is kicking in. So we look at all those models also, helping us in exports. And in the midterm, all these FTAs are also very exciting. And we still need to go through the details, India, EU, whether there is any opportunity there. So I think we'll be very, very open and positive. I think the demographics of India and a very strong structure for our plants and a very high level of quality puts us in a very, very good position to continuously look for opportunities for increasing exports. And Hyundai has been very strong in India in terms of exporting. Since the time we set foot in India, on a cumulative basis, we still hold the position of being the #1 exporter. And I think last 12 to 15 months, the exports have been a great driver. Already we have announced that from the current level of 23 to 24% contribution of exports to the overall production, we intend to go to 30%. So the plans are very much intact, and we are fairly confident that exports will only go up from here.
All right, since you spoke about increased capacity and that helping your exports, could you tell us what your current capacity utilization is, and when do you get to this 30% contribution coming in from exports?
So if you see the current capacity is now almost 824 in Chennai and 170,000 in Pune. So 994,000 is our capacity. So we have enough capacity now. And that 30% is, of course, for fiscal 30. So that is a long-term plan to reach 30%. Current level is about 23 to 24%. And so this is where we are.
Mr. Garg, and lastly, could you talk to us about the strategy behind the foray into commercial mobility segment, sir? I mean, what are you literally driving at here? What's the aim?
So I think this is a very interesting segment, and we have seen the segment really grow, especially post-COVID in the last 3 to 4 years when people are looking for shared mobility. So I think Hyundai, with a strong brand and very strong product, along with the CNG, factory-fitted CNG option, both in the hatch as well as in the sedan segment. So we've introduced it in January. The initial response is very, very encouraging. Like I mentioned earlier, especially in the sedan segment, that has helped us to have clocked the highest ever Aura sales, and all across, because the products are very reliable, and we have had a very comprehensive strategy. It's not only about the product. Our dealers are ready. We are tying up with the financiers. The service packages are there to give a comfort to the operators. So we are fairly confident that we will be able to make a very strong mark in this segment where the competition is not very strong and very few players, have a right product to tap this kind of a taxi segment.
Thanks a lot, Mr. Garg. Always a pleasure having you on the show. Wishing you all the best for the fourth quarter, and we look forward to chatting up with you rather soon. Well, before we go to Nagaraj Sethi, let's get a quick check on the IT index. That's down more than 5% in today's trading session. But I'll tell you what, from the frontline names itself, there is some kind of bottom fishing that we're seeing from the lows. If you pull up Tech Mahindra, HCLTech, and even Wipro, all of them have come off close to around 1.5% from the low point of the day. So there is some kind of recovery from the lows. They were down close to around 6% or thereabouts. There is some kind of recovery there. The problem is it's not replicated in the IT index because the largest weight, which is Infosys, that's actually taken a leg down. That's down more than 6% now. So hopefully that one as well sees some kind of recovery. Then we'll see that reflecting in the IT index. For the time being, down 5.5%. Let's get in Nagaraj Sethi, Senior Technical Analyst at HDFC Securities, who joins us on the show. Hi, Nagaraj. Good morning. Good to see you win. First, your view on the tech index. Where are we headed from here? Are we at crucial support levels, or do you think we can move deeper from here?
Hi, Nigel. Good morning. The IT index, surprisingly, it was moving. IT sector was moving. That news came down sharply. The overall picture is like showing some sign of tiredness at the higher levels. The way it has declined, I think some more weakness is likely. I'm not expecting a big decline from here onwards, but some more consolidation, some more weakness is likely in the near term before showing bounce back from the lower levels.
Nagaraj, what would you do in terms of specific stocks?
Yeah, I have for Nifty, if I speak a couple of seconds for Nifty, now way the Nifty has reacted from the lower levels, it indicates that 24,550, the eventful budget day, that is going to be an important bottom reversal. And the way it has formed a gap of around 400, 450, 500 points gap, which is still open, upside gap, is indicating that there is a higher possibility of Nifty moving ahead. Around 26,000 is going to be the initial resistance, initial target, and eventually Nifty could reach up to 26,300, 350, which is ultimately the upside target for the market. And I have two stocks from the long side. First one is MRPL. This refinery stock has been in an amazing run over the last couple of weeks. We have seen continuous up run, higher tops and higher bottoms. After a smaller dip in last session, it has bounced back very well. Currently trading around 188. I'm expecting this to move further. One can look to buy around this market rate around 187.70, 188. Upside target would be around 200, and one can place a stop loss at 182. And in the second one is the Rain Industries. The chartically Rain Industries has been in a sharp uptrend recently after a small consolidation, currently placed at the edge of a decisive upside breakout. Now trading around 166.50, one can look to buy at this point of time. Immediate target of around 166, 176, and one can place a stop loss at 160.
Okay, all right. Thank you very much, Nagaraj, for that. Appreciate it very much. Well, after the India-US deal announced yesterday, US Trade Representative Jameson Greer spoke exclusively to CNBC. He says India is going to cut tariffs on a vast variety of goods, agri included in some cases, to 0%. He added that they will basically finish the paperwork on the deal soon. Listen in.
Remember April of last year on Liberation Day, and then we remember the announcement of all the trade deals as they would come, and we'd be waiting and waiting. We were always waiting, it seemed. And some of the other president's men, Howard Lutnick and others, would talk about India and whether we were getting close with India. Is this that same deal that we were talking about the entire time finally coming to fruition, Mr. Ambassador?
Yes. Yes, this is it.
the time has come, and now we have the deal. We'll finish papering it, but we know the specifics, we know the details. It's a very exciting opportunity. On the one hand, we'll continue to maintain some level of tariff against India, 18%, because we have this giant trade deficit with them. But they've also agreed to reduce their tariffs for us on a variety of agricultural products, manufactured goods, chemicals, medical devices, et cetera. It's an exciting opportunity for both countries.
Because I remember, Jameson, that we got things done with certain countries where we thought it wasn't that egregious the way we were being treated. There was a notion that India was one of the worst actors in terms of protectionism for their own stuff and tariffs. Is everything going to zero? It sounds too good to be true. That's kind of what the president indicated, and we're staying at 18 for what we tariff Indian goods. Is that really what the trade deal stipulates?
So with India, right now, today, for industrial goods, their average tariff is about 13.5%. That's going to go to zero for virtually everything. When I say virtually, I mean 98, 99%. On the agricultural side, there's a vast array of agricultural goods that will go to zero. India, like every country in the world, including the United States, has some protection around some certain key areas. Well, they'll continue to control that, and we'll continue to work on access. But for a variety of things, tree nuts, wine, spirits, fruits, vegetables, etc., they're going down to zero.
But
this is a big win.
And you got the oil concession, which it just seems like a lot of things. The non-trade barriers are being significantly reduced by India as well.
Yes, the non-tariff barriers, as you know, Joe, if you get rid of a tariff, that's one thing, but often the non-tariff barriers pose problems. So we have an understanding and agreement with the Indians as well on a variety of technical barriers to trade, areas where they have not accepted U.S. standards. We know American goods are safe. We know they're effective, et cetera. We have effective regulation in the U.S., sometimes too effective. So we have an agreement with them on a process for recognizing certain U.S. standards. They obviously have their own political considerations, and they have their own processes for accepting those standards, but that's a key portion of this trade agreement that should open up this market of over 1 billion people to U.S. goods.
How much are we talking about in terms of displacing Russian oil for use by India? How does that work exactly? And some of it could be Venezuelan that they would get from us, some of the 50 million barrels that the president talks about all the time?
That's right. So remember, India, prior to 2022, 2023, really didn't import Russian crude. They took advantage of a situation where Russian crude was trading at a discount because they couldn't get it to any other countries because of sanctions. President Trump very accurately put the Indians on notice that we viewed this as supporting the Russian war effort. And starting early, at the end of last year, the Indians started winding down their purchase of Russian oil. We've been monitoring that. They've been diversifying purchases of energy from the U.S., not just oil, but also gas, propane, other things. That's been going up. We'll keep monitoring that. Obviously, they want to diversify from other sources too, whether it's Venezuela or the Gulf, et cetera. There are a lot of opportunities to do this. The Indians are making the right choice.
All right, interesting conversation there. What we'll do is take a short break with the news that the market's doing well, actually. The Nifty Bank is perked up. It's currently at the high point of trade along with the Nifty, which is moving towards that 25,800 mark. On the other side, Manisha Gupta puts the focus on all things commodities. Stay with us.
Fly Emirates, fly better.
Welcome back. Equity markets in a good space. Actually, we're up close to around 170 points from the low point of the day in the Nifty itself, and the Nifty Bank is the one that's doing the heavy lifting. But let's take a break from equities. Let's go across to the commodity markets. Manisha Gupta joining to tell us what's going on there. Manisha, take it away.
Well, yes, I'm back to precious metals because we are looking at very, very strong gains coming in for this one. Take a look at the gold prices. It really seems to be making record numbers on the downside and on the upside as well. So overnight, we've seen 6% of gains come in. It's trading back above $5,050 an ounce. And this is the biggest single day gain that gold prices are putting forth since 2008 there. Well, a couple of geopolitical reasons really for the gold prices to be coming like that. It is about U.S. forces downing an Iran drone in the Arabian Sea. And there also are reports that the Iranian vessels have challenged a U.S.-flagged oil tanker transitioning in Strait of Hormuz. Now, even as U.S. and Iran are slated to have a conversation on Friday, this does not augur well and is adding some geopolitical premium in case of gold prices. Anyways, with the kind of sell-off that we saw in 2 or 3 trading sessions, there is some opportunity buying as well coming in on the lower side for the gold prices. And then it is about the strong demand estimates, which are also supportive. 2025 has seen the best gold demand ever in any year. $5,000, 5,000 ounces is what we've seen in sense of demand coming in into the markets there. If you look at the year-on-year number in sense of that, we are looking at very strong numbers on ETFs. Those holdings grew by 801 tons. This is the second highest year on record in sense of ETF buying in case of gold as well. With the kind of numbers and with the kind of run-up that we saw in gold prices, all of this demand stands quite strong. So bars and coins, that demand continued on the stronger side, the highest in 12 years in 2025. The central bank buying, which has been hitting 1,000 tons in last 3 years, also saw a buying at 863 tons. So the higher side of range coming in for this one as well. But the overall demand is a number that you should be looking at. 5,000 tons in 2025 is an all-time high that gold has seen in sense of demand ever. 2024 was 49.61, 2023 at 49.44, 49.61. So we've seen constant gains continuing into those markets there, as you can see on a year-on-year basis. And 5,002 tons is a record high in sense of demand there. Interestingly, even with the kind of volatile moves that we have seen in case of gold and wherever the prices stand right now, it is the $6,000 an ounce forecast club that really seems to be buzzing right now. In the last week or so, even as the gold prices have been very volatile, you have seen a report come in from JP Morgan talking about $6,300 an ounce of a possibility by the time this year ends. Deutsche Bank in a report yesterday talks about 6,000. Bank of America is talking about $6,000 an ounce by the time it is spring season. UBS has put out a number of $6,200 an ounce. Jefferies, $6,600. You have Yardeni Group putting out $6,000 an ounce. So that's a 6,000 club, really. They believe that all-time highs are yet to come in, and this year could be looking at gold prices at higher highs before the year ends.
All right, Manisha, thanks a lot for that. Higher highs before the year ends. That's on the precious metal space. But meanwhile, don't lose sight of the market. 25,800 on the frontline index. A lot of these oil players doing extremely well as well. ONGC, obviously, Reliance is a play out there. Big weight on the index, and Oil India spiking. With that, we'll take a short break, come back on the other side. Lata speaks to the Citizens Monetary Policy Committee, CNBC TV18 Citizens MPC, to discuss the roadmap ahead for the RBI and how the macros have changed after the India-US trade deal. Stay with us.
Welcome back to the Citizens Monetary Policy Committee discussions. We did have our discussion on Monday, but the massive US-India trade deal came on Tuesday morning or Monday night, and that's game-changing. The rupee itself went up by about 1.7% this week. And since our MPC members are top-rung economists, I thought we should ask them if the trade deal completely changes the ground for the Reserve Bank and for the Monetary Policy Committee. Let me welcome our members, Sonal Verma of Nomura, Sajid Chenoy of JP Morgan, Samiran Chakrabarti of Citi, Shaumika Ghosh of State Bank, and the chairman of the Citizens MPC, Dr. Pranab Sen. Gentlemen, and Sonal, I'm deeply grateful that you all have agreed to come again and oblige me. Let me start with the lady. Sonal, now that the deal is signed, two top things that changed for the Reserve Bank.
Things change actually significantly and much for the better for the RBI. I would say there are mainly three ways things change. One is with this deal in place, it does add some upside risk to FY27 GDP growth projection. I think the biggest positive will be in terms of sentiment and flows into India, but also less trade policy uncertainty, improved exports. So there is some upside on growth. Second, this should actually enable better policy transmission, because in the last few months, managing FX and rates has essentially, undone some of the policy transmission. So with an improvement in flows, better liquidity, this should enable policy transmission going forward. And third, inflation in India, of course, was already quite benign, but to the extent that we do not see further currency weakness, any upside risk to inflation from weaker currency should also be offset. So it does make the growth inflation dynamic much better and enable better policy transmission for RBI going forward.
Okay, that sounds like even more Goldilocks, Sonal. Let me get on the budget. Samiran, do you think the change for RBI in terms of managing this 17.2 lakh crore borrowing program gets any easier because of the trade deal and likely dollar flows? Or is that still going to be a big point in the upcoming MPC?
I think I'll just extend the point that Sonal was making. I think the debate is between how much MPC will focus on being slightly hawkish because of the higher growth expectation versus how much dovish they can become now that there is less pressure on the currency and there is going to be better transmission of any future rate cuts. And that's where our bias is towards the latter, where we think that the MPC could turn a bit more dovish now compared to where they would have been if the deal was not in place. So from that perspective, the challenge for the bond market is twofold. One is that dovishness might, in the policy rate direction, might help the bond market. But on the other hand, these flows that are coming in would imply that RBI will have to do less amount of OMO, which is a negative for the bond market. So it will be a bit of a tussle on the policy day for RBI to balance this, that to what extent they're going to guide on the rate front versus to what extent they can still continue to signal a large amount of OMO. I think that's where the big debate is going to be, that can RBI on February 6th again announce a massive amount of OMO, or would they be now somewhat more, I would say, cautious in their announcements?
Okay, you suspect they may not announce such a big OMO. Actually, I'll come back to you, come back to the others on this, because after the budget, Samiran, I remember you telling me that it's not that 17.2 lakh crore, it is just that the demand side is very weak at this point in time. As you point out, let's discuss that later. But I'm even more worried about not just US trade deal. The thing that has changed this week, Sajid, is the global backdrop. I mean, the swings we have seen in dollar itself, in commodities, and now in the AI stocks, or even the next rung of IT stocks. It's volatile, I won't say chaotic, but volatile global scene. How does that impinge on the MPC?
Absolutely, Lata. Good morning. I think, even though the trade deal is very constructive for India's outlook, we must be very mindful that the global backdrop remains very precarious. I think there are at least two tensions that the global backdrop is seeing. The first is that, for the longest time, we've seen the threats on US exceptionalism, and that's caused the dollar to weaken. And because of that, commodity prices have actually gone up because there's this inverse correlation between the dollar and commodities, which then also stokes inflation pressures in some economies. But what we've seen over the last week is the fact that underlying growth in the US, and in fact in large parts of the world, remain very resilient. And I think that's the tension, that US growth is holding up very nicely. Chairman Walsh, who was appointed by President Trump, is much more mainstream than was feared. And with this growth inflation, and inflation in the US is sticky, there is a growing belief that the 50 basis points of rate cuts that markets have priced in for the Fed will not happen in 2026. And so the longer that belief continues, the more the pressure on the dollar to regain some of its losses. And that's what we've seen in the last week, that the dollar has begun to rebound. And if that process continues, that will put more pressure on emerging market currencies. So we're not out of the woods just as yet. The second tension, as I mentioned, is the AI tension. Yes, technology is doing very well in December and Jan. Tech exports are still doing well. CapEx is doing well. But there is now a growing belief every month that has this rally been overdone? Are we approaching bubble territory? And as 2026 goes on, those questions will only get more acute. So I think we have to be mindful here that the global backdrop is very precarious. If those Fed rate cuts get priced out and the dollar were to strengthen, that will put more pressure on emerging market currencies. Conversely, if the dollar were to continue weakening, then commodity prices go up, and that creates pipeline inflation pressure. So, there is no free lunch here.
Oh, yes. I'll ask you about the Asian inflation or disinflation in a bit. Soumyakant Ghosh, I wanted your view on the currency. When we spoke on Monday, we were worrying whether it come to a point where the Reserve Bank has to announce even some NRI bonds or resurgent India bonds. Now, what is the view? Will RBI actually move to stop appreciation? This is not an MPC question; it's an RBI question. Do you think they will have to stop appreciation? Will it come to that?
No, thank you, Lata. I think the larger debate is that the US trade deal is very positive from the currency perspective. But I would just like to add one thing, that we have to be cautious enough, because the things actually globally has not changed anything fundamentally in the last 2 days, or not it is going to change in the next month or so. The global debt levels, they become precarious. The movements in US dollar could be sideways. It could either appreciate or it could depreciate. And we have seen in the past that the rupee actually has been depreciating along with the dollar, which has been never happened. And while this news of US trade deal has actually created a positive sentiment in the market in terms of a rupee appreciation, but I think that given the precarious uncertainties, the uncertain nature of the dollar movement, and also of the capital inflows, I think the central bank will get a very well-meant reprieve in terms of not thinking about the liquidity, that impossible trinity at this point of time. But my sense is that we have to be cautious, because the volatility in the market is not yet done yet. So if your specific question that the RBI should actually stop appreciating, I think the time has not come. Okay. Maybe the central bank could look through the data in the meanwhile and then take decisions accordingly.
I take your point. It's too early, but there is that expectation in the market whether Reserve Bank should stop appreciation. That changes the arithmetic even for how much currency, how much reserves are available in the system, the liquidity in the system. Dr. Sen, if you can bring all this together, sir, for the MPC member, post this deal, do the growth inflation dynamics become easier to manage? You would be less worried as a central banker.
Not necessarily, Lata. Let me just try. One thing that we seem to be not putting enough focus on, as far as the trade deal is concerned, is we've talked a fair amount about what it means about our exports. But there's going to be a huge amount of rejigging of our import.
Yes.
On the import side.
Yes.
Now, that is going to have monetary consequences. We don't know how large or how strong this is going to be, but given the fact that we've been running a large trade surplus vis-a-vis the US, what this is going to mean in its essence is we're going to have to import a lot more from the US. And that means that we will be diversifying our basket of imports across the world. Now, this has consequences not just for the Indian economy, it has consequences for an already uncertain global economy. And that becomes problematic.
Yeah.
So as far as uncertainties are concerned, one major source of uncertainty is gone, which is what we had talked about the last time we met. But the uncertainty is still very much there, simply because now you're going to see us changing the way we trade with the rest of the world. Now, this is something that one has to be a little careful about.
I take your point.
And in the context, one has to keep in mind the movement that was happening towards moving to a BRICS currency kind of arrangement. That is going to be taking a bit of a setback as of now. Which means that, again, we really now need to, in a sense, batten down the hatches, look internally, because the rest of the world is still going to be volatile. We will not know how it's going to change. And we have to look for internal sources of growth. And therefore, to my mind, at the moment, the trade-off is that growth imperatives have become more important than they were earlier.
Oh. So
not the other way around.
Okay, sir, that's very, very interesting. Actually, we should invite you all for a separate discussion on this import rejig that we will have to do and the potential impact it can have on current account deficit. It's early days yet, we don't know. But, you know, we have a MPC coming up. And so first, lady and gentlemen, let's take up your pens and do the first vote. What will the MPC do to the repo rate on February 6th itself? Sonal, I'll start with you.
On hold.
On hold. Samiran?
On hold, but a bit more dovishness than expected before.
Okay. Dovish, pause. Soumya?
No change.
Sajid?
No change, on hold.
Okay, all of you are on the same page. Dr. Sen, you want to change your vote?
Hold.
Hold. Okay. So by a majority, by a unanimous vote, no change. But we will have to ask you a lot more questions about the new CPI basket, the new GDP number series that we will have, and you know, a host of other things that the MP that will bother the MPC. Those questions after the break. For Bazaar viewers, at the moment it'll be Chartbusters.
You're watching us here on Chartbusters. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me as always, Nigel D'Souza. After a big up move yesterday, we had a big down move on Wall Street. That playing out in the IT stocks this morning, but more importantly, the other parts of the market are more than undoing the impact of the IT stocks, and which is why the Nifty, despite the IT index being lower, is absolutely flat. The IT index down 6.2%. But look at the other offsetting factors. We have the Nifty Bank, which is up by about 0.25%. We also have an up move coming in on Reliance and some of these upstream oil plays, the likes of ONGC, Oil India. So by and large, a very good day of trade despite the weakness that we're seeing in the IT pack, especially after a 600-point up move that we saw on our frontline indices yesterday. But Nigel, a bunch of stocks, a bunch of companies on our radar.
Well, Welspun Corp, that's one of the numbers that were pretty good in the past quarter. And to help us out with the past quarter and the way ahead, we're joined by Mr. Vipul Mathur, the MD and CEO who joins us in the studio. Hi, Mr. Mathur. Always a pleasure having you in the studio. The numbers look quite good. But before we get to your numbers and the outlook, particularly in US business, which is looking up, let me ask you about the budget. Budget 2026, the Jal Jeevan Mission. They have allocated close to 67,000 crores. Last year, for various reasons, which we should not get into, is that the spend was relatively lower under this particular scheme. Do you think that the spend is good enough for you? And what kind of a pipeline and what kind of market share can you pull with regard to this JJM scheme?
First and foremost, good morning, Nigel. Always good to be back on your show. As regards JGM, I think so. We know that in the last year, the spending has been relatively low, while the allocations were in place, but the spending was low. I think so. There were some process issues around that. That's what we understand. Looks like that is behind us now. Looks like now in the new budget, significant allocation has been made. I think so. The schemes at the stage they are at this point in time, they need to be done. This project, we have all the reasons to believe that will be pulled through for the next 2 or 3 years' time. I think so. It's a fairly welcoming move that the Honorable Finance Minister has made that type of allocation. Okay. And we are very, very confident that we will really see the money now trickling into the in this Jal Jeevan Mission in the coming financial year.
Is there a tender-based bidding that takes place? If you could tell us when is the next big tender for this particular JJM, if you could help us out with that. And also the problem in the past is not just ordering activity slowed down. The payments are not coming. So what is the total outstanding? And you mentioned in your press release that it's gradually coming in. So how much is coming in?
So it's typically this under JJM, these contracts are on a EPC basis. So the large EPC companies pick up those contracts. We are a supplier to them. In the last financial year, because the payments got stalled, the payments were trickling down slowly. So the EPCs have stopped their work or have slowed down their work. Now then the payments have started coming in. I'm sure that we will see a lot of traction coming in that process. All these EPCs have large contracts. They are only in place. They only have slowed it down. It is not that there is no business. The business is they are flooded with business. They have large contract with them. Just they were calibrating it because the funds were not coming in. Okay. Now the funds will start flowing in. I think so. Things will start coming back on track. 1, 2. As regards our exposure in Welspun Corp, it's relatively very small. I think so, and that is all under, and most of it is like whatever the exposure, some 50, 70, 100 odd crore rupees exposure, what we have is directly with the government. It is not with the EPC. So that is also a secured sort of an exposure what we have. Thirdly, coming to your point that, we have started seeing that amounts have started trickling in. Yeah. And I'm sure that by the first quarter, probably everything should get sorted out.
So less than 100 crores?
Less than 100 crores. Yeah.
All right. And what about business then? We've spoken about Jal Jeevan Mission and the outlook that the government's put out in the budget. I'm looking at your first 9 months numbers. Your EBITDA is, very close to the 1,800 crore mark. This compared with your guidance of 2,200 crores. Just, extrapolating these numbers, this year you should end with about 2,500 crores on the EBITDA front, which is above your earlier, guidance. Is that a possibility?
Definitely, it's a possibility. There's no doubt about it. See, today, standing here and saying that, we still will be close to that. I think so. The way, the last 3 quarters have been good. The run rate has been fairly nice. And I think so. The fourth quarter booking and the fourth quarter execution, we are already into that. I think so. It's absolutely on track. I think so. It's very fair to assume that, we will definitely be surpassing our.
That's a foregone conclusion.
Yes.
The question is now, FY27, do you do 3,000 crores?
See, if you see, a little too early to commit to that number. But if you see, typically in my previous interactions with you, I have very clearly said that there are certain guardrails in which we operate, right? And one of the mandate and in the investor call we have said that our growth has to be 15% on a year-on-year basis on the EBITDA basis. I think so if we are ending up with the numbers what you are suggesting in this particular financial year, it's absolutely reasonable to assume that, next year is going to be even more stronger. And it is completely backed by, see, it is not that it is a hypothetical analysis, it is completely backed by a very, very strong order book in America, a very strong order book in India, and a very strong business visibility what we are seeing in the coming quarters.
Okay, I think, Mr. Mathur, what I would request you to do is next year give a more realistic guidance. I'll tell you what, because last few years you've been beating that guidance. So, challenge yourself a little bit for FY27 because you're going to be beating it this year only by close to around 10%. Going by the arithmetically, you're doing 600 crores of EBITDA on a quarterly run rate, and quarter 4 is the best. That argument for another day. Let's focus on two aspects. One is Sensex. The ramp up actually has been quite slow. It's not been up to expected lines. For the coming year, what can you guide? You've been ballpark 600, 650 crores on an annual basis. So for the next year, do you think you can grow by 20, 25% on that sort of a base? And will it be margin positive? That's on Sensex. And on Welspun Specialty Steel, we spoke about it in the past. That's turned around well. Do you think for this year it can do, say, 1,100 crores and high single-digit margins? Run us through both these two.
Okay, so Sensex, Sensex, again, to repeat, iconic brand, strong brand recall, blah, 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 everything. See, Sensex is also got slightly impacted on a growth front because of the, it's predominantly into the water space.
Right.
And the building construction space. Both of these sectors in the past few quarters were under stress for reasons known to us, right? Now, when we are coming out of this, I'm sure that traction and that velocity will come into the Sensex part of it. This year, probably we will be 600, 700, whatever that number might be. But I think so the next year, if all things go as per the plan as what we are expecting that, I think so Sensex will be a sort of a turnaround story the next year. There's no reason of doubt as around Sensex.
So 1,000 crore possible next year?
Possible. 100. It is possible. Even. It is definitely possible.
Because you had said that 1,000 crore when it happens, we'll think about whether we want to unlock value out there by listing it separately, etc.
That's a separate discussion, unlocking value. See, at the end of the day, we have to fundamentally believe into this particular brand.
Correct.
I think so we, as Welspun, we are absolutely convinced. We go with absolute strong conviction about the brand, this what it is. And anything and everything what we would like to push is absolutely going to unlock value for our investors. There's no reason and no doubts in our mind whatsoever.
So 1,000 crores of revenue and it breaks even. We have got that out of the way. And the other
I'm very confident about that.
Welspun Specialty Steel, the smaller listed company.
I'm so glad that it is being recognized that it has been a turnaround story. It is actually a classic textbook. At some point in time we'll teach in management colleges around that. It's a turnaround story. I think so the company is doing extremely well. The sector is doing phenomenally well. I think so the way the growth is now looking is incredible. And especially if you see the defense allocation, the allocation into the nuclear sector, the allocation into the power sector, and the government of India making the story that, coming up with Atmanirbhar Bharat and the amount of quality control orders they have been putting up. Yes. I think so this is a company in a turnaround make, and I am sure that this company has one of the brightest future in our group.
So 1,100 crores next year possible with high single-digit margins?
Wait till Q4. I think so we'll give you very clear guidance about it, but possibly it looks like that.
And it stays a separate entity.
It stays as a separate entity.
Got it. All right, Mr. Mathur, not out of questions, but out of time. Thanks a lot for joining in. You seem to be on a solid wicket. Next time around, we'll wait by for your guidance. And also, in the next 2 years, maybe Welspun Corp, the EBITDA number, can it do around 4,000 crores? We'll ask you that the next time around.
I'll come prepared for that.
Thanks a lot.
Thank you very much.
Thanks
Appreciate
a lot for joining in.
Thank you. Thanks.
Well, let's focus on a couple of other names. HCL is under pressure. Ria joins in to explain exactly why. Ria?
Well, yes, HCL has actually been knocked out of the race to develop India's 5th generation stealth fighter jet program, which is the AMCA fighter jet program. Now, these are industry reports that have been confirmed by analysts. And up until now, HCL was believed to be the front runner for this program, which is why today the street is reacting so negatively to this. Now, HCL had bid for this program with 2 other smaller firms. And in fact, this will also be the first time that HCL will not be involved in one of the country's most significant military projects. Now, in terms of the other bidders that have bid for this project, that includes Tata Advanced Systems, Adani Defence and Aerospace, along with MTAR Technologies, L&T, BEL, Bharat Forge, as well as BEML and Data Patterns, among some other companies. And as per reports, 3 of these companies have been shortlisted now, and the final project winner is to be declared within the next 3 months. In terms of the details of the AMCA project, the prototype development cost has been valued at roughly 15,000 crores, and the total project cost has been valued at roughly 1.5 to 2 lakh crores. This will be a big project. For the impact on HCL, it is said to be sentimentally negative for the company, and analysts do not expect any material impact on the financials of the company. Remember, the total order book of the company as of the end of FY25 stands at 1.9 lakh crores. So they already have a very strong order book, and at the end of FY26, this order book is expected to go to roughly 2.5 to 2.6 lakh crores. But nonetheless, the stock is down in today's trade, roughly down by 5.5% to 6% today.
All right, thanks a lot for that, Ria. We'll take a short break on that note. Come back on the other side. Another management rating by Nitesh Mittersen, who's the joint MD and CEO at Nazara Tech, joins in to discuss their third quarter numbers. Stay with us. Welcome back. You're watching us here on Chartbusters. The market's mildly in the green right now. A moment ago, it was slightly in the red, but it's finding buyers at lower levels. That's a positive. But Jio BlackRock has launched personalized investment advice, a digital advisory platform with plans starting as low as 350 rupees per year. The idea, the company says, is to pitch institutional-grade portfolio advice to everyday Indian investors. Shilpa caught up with Mark Pilgrim, who's the MD and CEO of Jio BlackRock, and started off by asking him whether this could prompt a pricing reset across the wealth management industry. Listen in.
I don't think it will force a reset. And I'll go back to what I was saying before. You've got different types of advisory, and people have an appetite for different levels of products. Some clients still will want to have a high-touch model and are ready to pay more than 350 rupees or 0.35% on the AUM base over 1 lakh. Some people are very price conscious. And so I believe that the offering is very different, that the interaction model is very different, the client experience is very different. Now, it's interesting that even though this is designed for mass affluent, we've seen an adoption of this model by high net worth in other parts of the world. I think that it helps with rethinking the industry and making sure the industry adapts to the client needs and requirements. But I think as to a whole repricing, I don't believe that's
Fair enough. And what products will you be investing your clients' monies in? Do you have anything already drawn out?
The most efficient way of creating this alpha is by using mutual funds, very often index mutual funds. Now, because we have this priority of making sure that our price point remains low to make it accessible to as many people in India as possible, we're using, first and foremost, index mutual funds. So that the overall total cost, if you take a look at the AUA, the advisory is 35 bips over 1 lakh. If you add the implementation element, using some of the asset managers that we have pre-selected, if people want to implement with us, you're at around 13 to 15 bips. So that's under 50 bips.
All right, so that is about Jio BlackRock Finance. Let's talk about Nazara Tech. They reported their numbers. Nitish Mittersain, who's the joint MD and CEO of the company, joins us now. Thanks a lot, Nitish, for joining in. Now, if I look at the reported numbers, obviously there are so many ifs and buts out there. The overall revenue, reported revenue is down 24%, the net profit down 64%. EBITDA is fairly strong, but a large part of that has to also do with the deconsolidation of the sports business and some of the acquisitions that you've made over the course of the last 1 year as well. So let's keep it very simple. Organically, X of all the acquisitions and deconsolidation, on a like-to-like basis, what has been the revenue and profitability growth for you?
So revenue growth is 10%. Profitability growth would be upwards of 25%. But just to take a step back, I think the revenue decline at the headline number is basically because of the Nodwin deconsolidation.
Yes.
I think our focus on core gaming continues to progress very well. And as you will see, our EBITDA margins in this quarter have increased significantly to 16.8%. So I think we're very much on the right track. We are executing what we said we will execute. And the numbers are tracking what we expect.
Okay, all right. Hi, Nitish. Good to see you. And as always, one of the positives was with regard to Kiddopia and the resumption of subscription subscribers. I think there were many quarters where we saw a decline, and now that's perked up. What's the outlook from here on? Does this addition continue? And would you say the worst is behind on Kiddopia business?
Fundamentally, since the last year, we have created these centers of excellence in user acquisition, in data analytics, in artificial intelligence, and product. What these centers of excellence are doing are supporting each of our games and our studios to enhance the way they're operating. And the first positive impact and tangible impact you can see is in Kiddopia. As you know, we were struggling on adding subscriber base for quite some time. And this quarter, we've been able to do a net positive impact. And the best part is that our cost per acquisition has come down from $37 to $35.4. So we've been able to spend more, but at lower costs, which makes us feel very excited that we can get growth going quite strongly in the coming quarters. We've also grown in this quarter.
Totally. That's an important factor, the customer acquisition cost in a business like yours, which was impacted earlier, but now it's on the mend. So that's positive. Just again, keep it very simple in terms of the investments that you're making in the business so far. What has been the total dollar value of investments that you've made in the company so far? And will you be making more? Are you looking at some sort of shareholder fundraising?
Yes. I think we are continuing to invest organically in our existing businesses. That is very important. If you see any of our games like Animal Jam has been launched on Roblox. We've signed new licenses for TV shows like Creators globally. We recently launched a Big Brother game. So there's a lot of investment that's going into existing business and growing the existing business. We are also actively pursuing new acquisitions of gaming studios and continue to be in advanced talks with a few. So that may happen. I think we will continue. And these new centers of excellence that we have created, the part is that they will really support all these studios that we acquire, add a lot of synergy and value to them.
No, I get that entirely, but still the dollar value of total investments that you've made in the company so far, because organically it's growing at around 10%. The sense one gets is that you'll be raising funds for funding growth going forward. So you will be using shareholders' money to buy growth. That's the short point here. So if you could give us that dollar value of investment.
So we, in the last year, look, because over many years we would have invested a lot of capital, but in the last year we did two key acquisitions. It was Fusebox Games and Games. Between the two, we invested capital of about 500 odd crores, less than 500 crores. Currently, the company has about 700 crores of net cash on its balance sheet. And if we require additional capital, we will raise capital. What we are very focused on is to ensure that if there is any capital base and there is dilution to the shareholder, the accretion in terms of cash flows from the businesses that we acquire and the prospects are far more rewarding than the dilution, right? So we are very conscious of that. We will execute. If the one metric we are looking at is cash flow per share, right? It's significantly improved by any action that we take.
Okay, all right. And if you're doing a dilution, what could it be to the tune of? Will it be a 500, 800 crores, 1,000 crore kind of dilution that you're looking at?
If we do, perhaps in that range, but there is nothing.
Which one? 500, 700 or 1,000? 1,000?
I mean, it's a range, right?
So 700 to 1,000 crores, I'm guessing.
But there's nothing final at this point of time.
Okay, all right, Nitesh, we'd like to push you a little bit more, but I have to tell you that the funky monkey, is a bailout for someone like me with two little kids. When you need to work, go to Funky Monkey, let the kids play and you can continue your work. So that's a bit of a bailout. I think Mangalam's getting there as well.
Yeah, so for me, it's not Funky Monkey. For me, it's Smash. And that's a bailout for myself. So if the kids need to do something, they can be at home. I'll go and play a couple of balls.
You'll get there, Mangalam, as the baby starts walking. All right, Nitesh, thanks a lot for joining in. We look forward to chatting up with you, discuss more about business and those inorganic plans as well. We'll track that. Well, time to slip into a short break. On the other side, we'll get you more on markets as well as on stock-specific action. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Well, the Nifty is continuing to hold in the green. The Sensex is trading more or less flattish. The mid-cap index is well flattish. But the big boy is coming and taking on the IT index. The Nifty Bank, it has a larger proportion in terms of weightage on the Nifty. And that's holding one end up, while the tech index is seeing some selling. We'll wrap up on this edition of Chartbusters. You stay tuned. The team of Trading Hour is coming by next.
Good morning, you're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. As always, it's me, and along with me, Hormaz and Ritu. Good morning and thank you for joining. You know, the one thing I have to say is
yes.
I've been around right from the time of the market was almost 100 points, and now we've seen a recovery from there. We've moved closer to that 25,800 mark and holding on into the green. That's a win. Because of the 600-point up move yesterday, one wouldn't have ruled out some profit taking and the kind of decline that we saw in the IT pack today, 6% down for that index. And the Nifty is flat. You take that. The bulls would take that.
Well, you're quite the optimist saying the 600-point up move yesterday. It was also a 600-point loss in trade yesterday. But that said, yes, it is a cautious start to trade today. And, you're seeing on one side the IT index pulling the broader markets down. And then you have the others trying to pull them back up. It's a push and pull in the markets
proper
today.
tug of war, isn't it? And it's reliance on one side along with ICICI Bank, Mahindra and Mahindra, L&T. They are the ones that are trying to keep the bulls in play, and all the other IT names are seeing a bit of a sell-off in today's session. Not a bit, but quite a bit of a sell-off in today's session. The first couple of hours, we've seen at least 1.5 lakh gone, at least in the 5 IT names that are listed on the Nifty 50 index. And the shares of Infosys are now at the lows of the day, 7.5%, Wipro down 4%, TCS down 6%. The market cap of TCS has now slipped below the mark of 11 lakh crore. So it's been a selling across the board for these IT names. eClerx is also down 9%. Persistent Systems, Coforge, all of them. The mid-cap IT is also taking a knock on the chin in today's session. So at the lows of the day is eClerx. So it's IT versus the rest in today's session.
It is IT versus the rest. But let's get back to some better news we had at the start of the week, and that is the US-India trade deal, the much-awaited deal that has finally come through. And remember, it's bringing the sparkle back in the gems and jewelry export segment, which was one of the worst hit, from near zero tariff to, 10% or so, and then all the way to 50%. And now, of course, the deal is flat 18%. Let's go across to Rajiv Anand, the MD and CEO of IndusInd Bank, to get us their view on how the bank's book was impacted. Because, among the gems and jewelry lenders, IndusInd is one that has a little more sizable portfolio perhaps than some of the rest. Mr. Anand, why don't you start by telling us that? I mean, about 3% of your book is gems and jewelry. But, overall, if you look at how much of the book is exposed, to US exports from the MSME side, and the gems and jewelry book, how large it was, and given the, impact of the tariffs, and we're seeing numbers of how the exports have come down, what was the flow through you saw in the bank's asset quality, disbursement trends?
Thank you for having me, Ritu. I think broadly speaking, the numbers that you had of about 3% of our book is in the gems and jewelries business. Like you rightly said, the headwinds in that sector have been quite strong over the last 12 to 18 months. Really, one is the whole tariff issue on one side, and the fact that really post-COVID, buying from the Chinese had significantly come off as well, and so therefore to that extent, given the fact that we deal pretty much with the largest players in this space, we don't have a SMA 1 or 2 at this point in time. But it's a given the fact that the business itself has been relatively muted, the book has not really grown over the last year or so.
So about 9,500 crore, 3% of your book, would that be the total number? And what about the other MSME book that has exposure to the US markets?
Yeah, I think if you look at the MSME, we've actually done some work around tariffs, before all this, in terms of to see whether there was any impact on any of our customers, and we found that the risk that we were running on the MSME portfolio as a result of tariffs was relatively muted, and I think we've seen various players having multiple strategies, looking at diversification of their buyer base and so on and so forth. But obviously, all those headwinds will now turn positive, given the fact that we're moving from 50 to 18, while the gems and jewelries industry is waiting to see, some of the fine print at this point in time. I think clearly both the EU transaction as well as a reduction in the US tariffs is certainly very positive for the gems and jewelries industry. This is not just positive for gems, but for diamonds as well, because lab-grown diamonds is a big market in the US, and that should have a positive impact for some of our customers as well.
Just to clarify, Mr. Anand, none of these accounts had even slipped in the SMA part of your book, and had you at all increased your provisions given the tariff threat, and does that now come back down? And going ahead, what kind of a disbursement growth do you see in this book now that that tariff uncertainty seems to be behind, at least for now?
Like I said, there is no SMA 1 or 2, so the question of provisioning doesn't arise. I think it's still early days I think market participants themselves are trying to assess, looking at the fine print as far as the whole tariff issue is concerned. But I think it's fair to say that the industry should look much better, from here, both because of the EU transaction as well as what we've seen on the Indo-US trade is concerned. And therefore, if the underlying industry does well, I think we should see some growth in this book. Too early to call, how much that will be.
Mr. Anand, in that case, now that all of these things are, at least for now, appearing to be falling into place, would you look at growing this book, since you mentioned that the book has remained flat? Although there have been no SMA 1 or 2 assets, but there hasn't been any growth either. Would you be looking to grow this book right now, or would you wait and watch for a couple of more quarters to see how things unfold and then take a call on what needs to be done?
These are relationships that the bank has run for decades, and so therefore, to that extent, we will partner with our clients, and we will have to assess the situation through conversations with them, and we will assess how much we want to grow going forward based on those conversations. Too early to call, I think.
Okay, too early to call how much the book will grow, but no stress flowing in there. Mr. Anand, quickly, since we have you here, there's been a bit of an organizational restructuring, streamlining, at the leadership level. We've seen quite a few new appointments, including a new chairman. There's been reports in the market from Piramal Finance. We've seen a few top-level exits. Are they heading the IndusInd Bank way? And, how many more new appointments should we expect in the coming quarters?
Ritu, we have a regulatory obligation which we take very seriously. Wherever and whenever senior people have joined us, we have made the statutory obligations, statutory disclosures to the stock exchanges, etc. As soon as and therefore we will continue to do so as new people join the organization.
Any plans on raising further capital, Mr. Anand? Is there a requirement, 1? And 2, has there been any conversation with the promoters with regards to them looking to infuse more funds into your bank?
At this moment, our capital adequacy is adequate at 17% at a CRAR level, and CET1 are at about 15.8%. So currently, we are very comfortable as far as capital is concerned. So therefore, to that extent, we don't envisage a capital raise in the near to medium term.
It was more from a confidence capital raise point of view, Mr. Anand. We, of course, understand there's no requirement with the kind of capital adequacy you have. It was more from, raising confidence capital, and we understand you've held talks with some sovereign funds.
At this point in time, like I said, there is no fundraise plan on the table at this point in time.
All right. Thank you very much, Mr. Anand, for joining us here today. And we hope to hear more from you in the coming quarters as and when some of those plans materialize. But let's step into a short break for now. Up next, we're going to focus on the bond market with Manisha Gupta.
Welcome back. Shifting focus to the bond markets. Manisha is here to tell us more on just that. Manisha, morning.
Thank you so much for that, Hormuz. On Bond Street today, we're talking about the kind of issuances that we're looking at in the Indian markets right now. To begin with, let's go with the statement that RBI came up with, that 14 states have raised nearly 380 billion rupees therein in sense of bond auctions, and this came in yesterday on Tuesday, that is. But there are various bond issuance that we're looking at likely to hit the Indian private placement market in the very near future. Today, actually, you have Poonawalla FinCorp, which is looking to raise nearly 5 billion rupees. This is through 10-year bonds, and they are seeking bids absolutely today. You also have Veritas Finance. They're looking at 2 billion through 4-year bonds, rather, and they also are seeking bids today. Then it is about Tiruchirappalli City Municipal Corporation. Well, they're looking at 1 billion rupees. This is through Feb 6, and they're looking at this via bonds, and they are seeking bids for this one on Thursday. And then you have many more coming in as well in the very near future. For example, there is NHPC. They're looking at 20 billion. This is via bonds. And REC Limited is also looking at 1.5 trillion via NCDs in one or more tranches therein. Prestige Estates is the next one on my list there. 20 billion rupees is what they are looking at via NCDs. JSW Steel also is on a list which they are looking at 50 billion via NCDs. Torrent Pharma, by the way, is looking at 30 billion via NCDs. And then you have Axis Bank also looking at 350 billion via debt market therein. Finally, it is about Bank of Maharashtra. 100 billion is what they are looking at in sense of issuances. This is via infra bonds for FY26 itself.
All right, Manisha, thanks very much for taking us through the hectic activity that seems to be ongoing in the bond markets. On that note, we'll slip into a short break. When we return, more on the markets. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back on to Corporate Conversations then. Joining the management of Acme Solar to discuss the road ahead for the company, Nikhil Dhingra, the CEO of the company, joins us. Nikhil, good morning. Thank you for joining in. You know, you have had a higher other income this time around, and your net debt has also seen a bit of an increase compared to last year. Could you attribute the reasons as to why this has happened, and do you see this as a one-off and the numbers trend down in the quarters ahead?
Right. So for us, other income is a core part of our income, because we have a lot of cash flows at the from the power sale, which is there in the SPV. So there is an interest income which is there, because we can take out money only once or twice during the year. So we had a 54% increase in the revenues and similar increase in the EBITDA. So the increase in the operational capacity resulted in the increase in the cash lying in these SPVs because of increased power sales. So that resulted in other income. And of course, this has been at this level for last 3-4 quarters. So, and that is because of the operational capacity increase. And in terms of the debt to EBITDA, we are at 4.2. It's a very healthy level. If you look at all utilities, comparable utilities, our net debt is close to 10,000 crores, and EBITDA is close to 2,500 crores. So debt, of course, we have around 80% of debt from the operational assets, which we have got refinanced, and weighted average cost is around 8.5%. But of course, the under construction debt is, we have moved on the execution of the projects that has resulted in the increase in the debt. And we are doing capex. As you know, there is a large capex happening. So a lot of execution planned for this year. Around 1.5 gigawatts of execution planned, which is essentially this. We are adding the same amount of capacity which we have currently. 1.5 gigawatt translates into around 3 gigawatts of operational capacity, which will be executed in this year. So that's the reason that the capex has happened. The debt has increased. Of course, it will result in EBITDA in the year next year.
Right. Nikhil, you know, the story for the company is pretty simple. With the existing capacity that you have, you've announced a big capex as well. It goes to about 10 gigawatts by 2030 is what we remember from what you had said to us last time. And as you keep on adding capacity, you've also signed a lot of PPAs. So it's basically a simple, you know, capacity being added and generation being increased, and all of that flowing down to your overall performance. So if you could give us a sense on how the prices are at right now for all the new PPAs that you're signing versus what was what was earlier. The sense one gets is it's trending downwards. That's point number one. And secondly, what's the kind of capacity that you've added over the last couple of quarters? What's the outlook?
Yes. So it's an important question, because you rightly captured that our business is dependent on getting new capacities, building those capacities, and running them efficiently. That's the whole business. So we have around 2.6 gigawatts of signed PPAs, which we are currently constructing. And all these 2.6 gigawatt has a weighted average tariff higher than 3.4, which we currently have for our 3 gigawatt operational capacity. And they have a higher CUF also, which is basically the utilization factor. So it's a revenue per megawatt is much higher. And the generation per megawatt of contracted capacity is also higher. So 2.5 gigawatts is the signed PPA number. We have 1.4 gigawatts of unsigned PPA, which we are expecting to get signed in couple of quarters. So these PPAs which have got signed were won by us between you can say 6 months to 12 months kind of a period long back. And these are all FDRE and hybrid projects. So their tariff gets locked in when you win the bid. So what you are seeing is, you are right that the tariffs have come down, and they have come down primarily for the plain battery bids, which we have not participated much, because that does not involve, you can say, around the clock power installation with a mix of wind, solar, and batteries. Right. So there the tariffs have come down, which we have not won. The recent bids which we have won in 3 months, where we have got railways and we have got that MP project, that has some that will get signed in let's say next 6 months, 3 to 6 months. But these PPAs which have got signed, they have a tariff higher than 3.4, which is our existing tariff. In terms of the capacity operationalization, so our capacity on a year-on-year basis is our revenue is up by 54%. That is because of the increase in the capacity in the last 12 months we have done. So in the next year, we are planning to operationalize 1.5 gigawatts of additional contracted capacity, which is around 3.3 gigawatts of solar DC capacity and around 4 gigawatt hour of battery. So that's the key installation which is going to happen in this year.
So with this kind of capacity addition that you are doing, Nikhil, what does that do to your financial performance in FY27? How much are you planning on growing your top line, your EBITDA, your margins, if you can give us targets for all of these metrics for the next year?
So what I can give target for is the capacity addition and the tariffs, like I mentioned earlier. So we have 3.4 is the average tariff, and the tariff is higher than this for the upcoming capacity of 1.5 gigawatt in this year. And EBITDA is more or less around 90%. This quarter we did around 91%. It has been hovering around that number for last 4 quarters, and that's because there are no variable costs in this business. It's almost fixed cost. So in terms of the so that's the broad numbers, and as revenue per megawatt will increase, so that's the key, and the because of 2 reasons. One is the higher tariff, and also because of the higher generation, because we are now building plants which have capacity utilization factor of 50% upwards, whereas the solar used to give a capacity utilization factor of between 25 to 30%. So that's where the 1.5 gigawatt will almost give, you can say, a similar effect as our current operational capacity of 3 gigawatts.
The envelope calculations do suggest 3,000 crore of EBITDA and 6,000 crore of EBITDA in the next 2 financial years, FY27 and FY28. That's a possibility, or are we far off from those?
So see, there is as you know, in terms of the capacity, there is a run rate EBITDA and there is an actual EBITDA versus the financial year closing. So when you basically operationalize a project, it gives revenue during the next 12 months, right? So when you operationalize capacity during FY27, so it will happen in phases during the year. Then, of course, it will keep on, it will give the full 12 months revenue starting from, let's say, that particular time when it is installing. So I would not be able to confirm or deny the numbers you are mentioning, but in terms of the PPAs are a fixed rate tariff for 25 years. The EBITDA is 90%. So I don't have the numbers to ratify, but these are the sort of capacities we are. It's a pretty simple business.
But they're not far off from what the estimates are, right?
Estimates would be yeah. So estimates would be around. I don't have that handy, but yeah, you can maybe you can check the numbers. I can't confirm or deny these numbers.
All right, we take that point, but we'll let the brokerages do those estimate analysis. I'm looking
please.
at a note coming in from a couple of them. They are targeting about 3,000 crores next year, with around 5,700 crores the year after as well. Thanks a lot, Nikhil, for joining in. Always a pleasure speaking with you. But if you look at the markets right now, it is, even Stevens, the tug of war that everyone's been talking about, right? So it's fairly steady. The frontline indices, if you look at it, you'd call it a resilient market despite the kind of downward pressure that the IT index has been putting on the Nifty. So you have the Nifty, which is down just 25 points, so the IT index down 7%. That's because the Nifty Bank and Reliance are doing the heavy lifting. The volatility index has cooled off despite the pressure that we've seen on the markets from the IT index. So that's a positive. The other positive is that your portfolios would be feeling a lot better. Advanced decline is firmly in favor of advances. The reported mid-cap index number is lowered only because of the mid-cap IT weightage on that. The Nifty is now flitting between the 20-day moving average and the 50-day moving average. 20-day moving average is at 25,500 and the 50-day moving average around the 25,800 mark. So that's the range after the big up move that we saw in yesterday's session. And bulls also need not worry because the PCR is stable after an up move. You would have expected it to go towards the overheated zone of almost 1.2, 1.3. That hasn't been the case. It is stable. VIX down, the Nifty flat, and the PCR absolutely stable with more stocks advancing than declining is perfect for a bull standpoint. If you look at the range that the option writers are playing for, 25,700 put writers fairly active, 150 rupees premium, telling you 25,550 thereabouts would be the support, and 25,800 call writers, 131 rupees on premium, around 25,950 is where the resistance comes in. A lot of long positions added on these upstream oil companies. So Oil India is one which is fairly well bid. And some of these PLI players are, what do you call them, ER&D players, seeing a fair amount of short covering. Dixon, PG Electroplast, even Amber is fairly well bid today. We'll take a short break on that note, come back, the management of City Union Bank on the other side.
Welcome back. Let's get you a quick check on the macro signals for the day. The markets for now in the red. It's been a volatile day. The Nifty now trading with cuts of about 25 points and the Sensex trading with cuts of 170 points. The Bank Nifty holding up though with gains of 126 points. That's where we're at as far as the market is concerned. The rupee, after that gain of about 1.25% that we saw yesterday on the back of positive sentiments from the US-India trade deal, today it's weaker because of some renewed dollar buying that's happening from large corporates, now trading at 90.48 against the dollar. The 10-year yield, that fell by about 3 basis points yesterday. That was good news. Again, optimism around that trade deal getting announced. Today, again, it's trading further lower. And of course, on Friday, we'll get the RBI monetary policy. So more cues from that. For now, at 6.7% is where we're at on the 10-year. Oil prices, again, we saw a bit of a gain, 67.81. That's where the Brent is at. Escalated tensions between US and Iran. You saw, the Iran ship not attack, but posturing against the US. So all of that weighing on the sentiments, and that's where we're at as far as the macro signal is concerned. We'll get you more on the markets and, a chat with the management of City Union Bank when we return after this short break. Welcome back. Shares of City Union Bank are trading in flat today, even though the bank posted a pretty strong third quarter earnings. N. Kamakodi, the MD and CEO of City Union Bank, joins us now to give us more on what went by in the quarter and what the year ahead looks like. Mr. Kamakodi, thanks very much for being here. Starting with your guidance, All right, Mr. Kamakodi, do hold on. We have the SEBI chief speaking, and let's take a look at what he's saying.
सर जो चर्चा चल रही थी कैश मार्केट को डीपन करने के लिए मार्जिन्स कम किए जा सकते हैं और एसएलबीएम फ्रेमवर्क को भी स्ट्रेंथन करने के लिए एक वर्किंग ग्रुप था सर उस पर अगर कुछ अपडेट
तो दोनों ही प्रपोजल्स हमारी बहुत एक्टिव रडार में हैं ट्रेडिंग लिक्विडिटी इंप्रूव करना हमारे जो मार्केट में कैश मार्केट में वो बहुत इम्पोर्टेंट ऑब्जेक्टिव है हमारे लिए क्योंकि उससे बहुत सारी जो लिक्विडिटी की इश्यूज लिक्विडिटी टर्नओवर बढ़ने से मार्केट की जो स्ट्रक्चर है वो इम्प्रूव होती है तो इसलिए हम दोनों चीज़ों बहुत एसएलबीएम फ्रेमवर्क में हो या फिर मार्जिन के इश्यूज में हो उसमें हमारे कंसर्न कमिटीज़ और हमारे कंसर्न ऑफिसर्स हैं वो सब स्टेक होल्डर से बातचीत कर रहे हैं और उसका आप रिजल्ट शॉर्टली देखेंगे और दूसरी बात ये है कि जहां आप एसटीटी की बात कर रहे हैं उसमें भी थोड़ा सा ज़्यादा डिफरेंशियल भी क्रिएट हुआ है बिटवीन द कैश मार्केट एंड द डेरिवेटिव्स मार्केट
तो सर एसएलबीएम में ब्रोकर्स की ये भी मांग है कि सेबी अगर वर्किंग ग्रुप बना रहा है तो जो मेन एजेंडा है जिसमें अगर एक लेंडर है तो उसका भी उसके भी सारी डिटेल्स एक तरह से सेटल करने के लिए जीएसटी जो लगता है सर उसके ऊपर कोई प्रपोजल है कि वो एक लेंडर के लिए ना जरूरी हो अगर एक डिटेल आ रहा है जैसे मैं ही अगर ले लूँ एसएलबीएम का पार्टिसिपेशन इफ आई डोंट हैव अ जीएसटी नंबर देन हाउ विल आई बी पार्टिसिपेटिंग इन दैट
देखिए आपको थोड़ा इंतज़ार करना होगा वो लोग सब तरह के इश्यूज की बात कर रहे हैं तो क्या उसको कौन से बैरियर्स होल्ड कर रहे हैं वो सब बैरियर्स को आइडेंटिफाई करके हम उचित कार्यवाही उस पर करेंगे
Sir, money bonds, despite several efforts, it has not yet picked up. What could trigger this?
You are talking of bonds?
Municipal bonds.
हाँ म्यूनिसिपल बॉन्ड्स में देखिए सबसे पहले तो उसमें एक अवेयरनेस का इशू रहा क्योंकि म्यूनिसिपल बॉन्ड मार्केट के लिए इशूअर्स जो हैं वो म्यूनिसिपैलिटीज़ हैं और म्यूनिसिपैलिटीज़ एक लोकल बॉडीज़ हैं और उनको बॉन्ड के बारे में और करने में समझने में भी टाइम लग रहा है बट ये अब प्रोसेस इस स्थिति में पहुंचा है कि बहुत सारी म्यूनिसिपैलिटीज़ आगे आई हैं मैनी म्यूनिसिपैलिटीज़ हैव कम फॉरवर्ड to issuing the bonds and 12 such bonds have been issued and there are many cities which have come out with the bonds. Secondly, there is a great deal of budget announcements are clearly indicating that the government support will be forthcoming for the municipalities who will be issuing the bonds. So therefore, this municipal bond market, right now, I agree with you. At this moment, it is very, very nascent. Very nascent. It is next to negligible compared to what we need for urban infrastructure. But it has got a very big potential because once every state starts doing it, and we have doing outreach program with all states, when every state, some key municipalities start doing it, then there will be a greater, because they have now started understanding what the market is.
All right. We were hoping to hear more from Tuhin Kanta Pandey on the STT hike, but not much there other than the differential between the cash and derivative market, he said, has increased. But let's get back to earnings. And Mr. Kamakodi is still here with us from City Union Bank. Mr. Kamakodi, apologies for that cut-in, and thanks very much for staying back on. You've given the street a guidance of growing in the mid to high teens, 15 to 20% kind of a growth. What will drive that? And specifically in unsecured, how much of a headroom do you have given some of the asset quality pressures that lenders have been telling us seem to have abated?
We have always concentrated more on the secured front, starting with the MSMEs, commercial trading, and we added secured retail, particularly housing loans, loan against property, rental discounting and all. So these over the period of, in 2024 onwards, we have started building up the team, and around the end of 2025 calendar year, we were able to see the growths improving, and the machineries are by and large set. So we had our 21% growth for the third quarter on year-on-year basis. And we have not gone into, like say, in a significant way on the unsecured retail so far. And that strategy will stay for many more quarters to come before we set, if at all we see on that line. But as of now, we are going purely on the secured lending on MSME, commercial trading, gold loan, and agriculture, along with now the secured retail of, let's say, housing loan, LAP, and other things. So we feel we are spending some time on setting up the team, and we never had a concept of sales team in our bank in the past. It's only in the last couple of years we have been verticalizing these sort of business lines, and like say the sales units and all are now set, and they have started delivering. In fact, we said year before last, it will be, like say last year, it will be making some loss, and for the financial year 2026, it will start making break even, and then from next year onwards, it will start adding to the profitability. In fact, it has started adding to the profitability this year itself, slightly ahead of whatever we had anticipated.
So we take that point, Mr. Kamakodi.
Given us confidence that.
Right, we get that. 21% loan growth doing very well, mid to high teens. You are confident that this sustains. The margins, that was a key positive of this result as well. How much of that is sustainable? Because parts of that is because of your gold loan, making it fixed rate. How much of the repricing there is left? And even deposit repricing, that's something that you've done. So if you could give us a sense on margins, basis all these factors.
See, basically, as you rightly said, we started the fixed rate gold loan year before last, and the entire gold loan portfolio has by and large converted into a fixed rate portfolio already. So we don't expect any shock. At the same time, the repo rate cut passing on, it has happened only towards the end of the quarter. So the impact because of that will be slightly higher in terms of reduction in the yield and advances. At the same time, it will get compensated by we have, as we discussed it in the con call and all, another 2-3 quarters going forward, whatever term deposits which is maturing and repricing happening at a lower rate, we will be getting the benefits to compensate for whatever yield reduction happening on the asset side because of the repo cut. So overall, we are confident that the whatever margin we currently have is sustainable with the plus or minus 10 basis point.
All right, the margin is sustainable. In a quick word, sir, the CD ratio at 86%, are you comfortable with that? And your guidance for what kind of deposit growth you would have in just a sentence, sir?
See, the deposit growth will definitely be in tune with the credit growth so that there won't be any, like say, stoppage in the credit because of non-availability of the deposits. Consistently, we have maintained that we are comfortable with the CD ratio of about 85 to 86%, and we are in that range only currently.
Okay, comfortable with the current range, and that's where you hope to say, Mr. Kamakodi. Thanks very much for joining in with that. Pleasure speaking with you. On that note, we'll just slip into a short break. We'll get you more on the markets when we return.
Fly Emirates, fly better.
Well, the bulls are still fighting to hold 25,700 even as the sell-off in the IT stocks continues to extend. Infosys is now down 8% as we speak. The market cap erosion of the top 5 IT companies has now reached 2 lakh crore rupees. Take your leave on this edition of Trading Hour. From Ritu Mangalam and me, thank you for watching. Halftime report on the other side.
Stocks swing between gains and losses as IT drags, but real economy plays in energy, utilities, consumer durables and metals offsets the impact. In fact, advances after outstrip the declines in today's trading session, keeping the positive sentiment intact.
Anthropic's latest plugins for cloud co-work that automate data analysis trigger a slide in IT stocks as disruption fears resurface. Analysts see lesser impact for Indian IT services but suggest some derating.
Fractal Analytics is eyeing a scaled-back valuation of near rupees 15,000 crores for its IPO. This comes after it trimmed the IPO size by over 40% as initial expectations of a rush for India's first AI company offers temper.
Gold posts its biggest single-day gain since 2008, climbing 6% overnight and rushing past the $5,000 mark. Rising US-Iran tension and continuing demand for the physical metals, including from central banks, aids the rebound. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal's Oswal studio. I'm Sonal Bhutra. With me as always is Vinny Motiwala. Well, a lot of cues that we've been tracking overnight. The big fall that we've seen in IT names, that will continue to be the big story that we'll be tracking through the course of the show as well. But for now, markets have recovered from the lows. It's a 160-point recovery from the lows of the day. After that, it did see some fall, and then again, there was some recovery from the lows. So it's been quite volatile since the word go. But yes, that recovery is something that we should be considering the fact that IT is a big weight on the index, and despite that, it is in the green or at least flattish as of now. The contribution chart that should come up for you on the screen. Despite that 7% fall in Nifty IT as we speak, there are a couple of names which are doing well. We have the oil and gas space, which is surging. That index is up around 2%. We have the CPSE basket, which is doing well as well. So the banking names, Reliance Industries, these are the ones which are contributing to the gains from the lows that we are seeing. We do have only IT names which are the biggest draggers in trade today. We do have infra, auto, consumption, metals index. They continue to do well. And mid caps and small caps today, they are outperforming the benchmark, which has not been the case for a long time.
Has not been the case for a long time. Sonal, good afternoon to you as well. So yes, surely mid and small caps, that's where the outperformance. On that note, let's look at the advance decline ratio, right? Because that's clearly in the favor of advances versus decline in today's trading session. So more of the green on the screen versus the red. IT, clearly Sonal mentioned, is what is under pressure. Some of the bright spots that I do want to highlight as well, some of these names coming in from the cap good space, whether you look at the Siemens Energy, GE, Vernova, they're managing to hold on to good gains in today's trading session as well. When you look at it in terms of other names, EMS players like Dixon, Keynes, they also are managing to hold on to gains. Let's watch out for that. But that's what the market setup is looking like. What's on the show for you all today? We have a very exciting lineup, right? We're going to put the spotlight on Fractal Analytics IPO, which opens up for subscription on February 9th. Then we'll bring you a conversation my colleague Rima had with the management as well. Now, we'll also speak with the management of Office Spaces Solutions and Mahindra Life Spaces on the back of their Q3 earnings. And in our Commodity Corner segment, Manisha Gupta will speak to the World Gold Council's Sachin Jain on the rebound seen in gold prices. Okay, but on that note, let's talk about HAL. That's the one that is in focus today, and it's a bit under pressure. And this is coming as reports are suggesting that the company is knocked out of AMCA race. Now, what does... Okay, so we'll go back to Ria, but we have Piyush Goyal, who is speaking as well right now. Let's go cross and listen to what he has to say.
दोनों पक्षों के महत्वपूर्ण और विविध हितों को देखते हुए यह स्वाभाविक है कि दोनों पक्ष अपनी अपनी अर्थव्यवस्थाओं के महत्वपूर्ण और संवेदनशील क्षेत्रों की रक्षा करते हुए सर्वोत्तम संभव परिणाम सुनिश्चित करना चाहेंगे। इन वार्ताओं के दौरान भारतीय पक्ष अपने संवेदनशील क्षेत्रों विशेषकर कृषि और दुग्ध क्षेत्रों के हितों की रक्षा सुनिश्चित करने में सफल रहा है। अमेरिकी पक्ष के भी कुछ ऐसे क्षेत्र थे जो उनके दृष्टिकोण से संवेदनशील थे। लगभग एक वर्ष तक चले कई दौर के विचार विमर्श के बाद दोनों वार्ताकार दल द्विपक्षीय व्यापार समझौते के कई क्षेत्रों को अंतिम रूप देने में सफल रहे। 2 फरवरी 2026 को प्रधानमंत्री जी और अमेरिकी राष्ट्रपति डोनाल्ड ट्रंप ने द्विपक्षीय और अंतर्राष्ट्रीय महत्व के कई मुद्दों पर फोन पर चर्चा की।
Okay, all right. That's the word coming in from the Commerce Minister on the timeline for the US-India trade deal. We'll cut back if there are more details which are available. For now, let's go back to what's happening in the markets. Of course, US-India trade deal, the nitty-gritties of that deal continue to remain the big focus point. But we do have HCL, which is under pressure. Reports suggest the company is knocked out of the AMCA race. Ria's telling us more on this one. What does this mean? And what has the company said about it? Ria?
Well, yes, HCL has indeed been knocked out of the race for AMCA, and this is as per industry reports that have been confirmed by analysts, and this is why the street is reacting so negatively to the stock today. Now, HCL was expected to be the front runner for the program up until now, and they have bid for this had bid for this program with 2 other smaller firms. Now, this will also be the first time that HCL will not be involved in one of the country's most significant military projects, and the other bidders for this project include Tata Advanced Systems, Adani Defence and Aerospace, as well as MTAR Technologies, L&T and BEL, and even Bharat Forge in partnership with BEML and Data Patterns among some other companies. Now, as per reports, 3 of these companies have been shortlisted for the project, and the final project winner is expected to be disclosed within the next 3 months. Now, as far as the details of the AMCA project go, the total development cost for the prototype has been valued at 15,000 crores, and the total project cost will be between 1.5 to 2 lakh crores. So this is quite a significant project that HCL has now been knocked out of the race for. And in terms of the impact for HCL, as per analysts, this will only be sentimentally negative for HCL, and they do not expect any material impact on the financials of the company. Remember, the total order book of the company stands at roughly 1.9 lakh crore rupees as of the end of FY25, and FY26 is expected to be closed at roughly 2.5 to 2.6 lakh crores for a total order book for HCL. So they already do have a very strong order book, but nonetheless, the stock is down roughly 5.5 to 6% in trade today.
Okay, Ria, thank you so much for that. But on that note, we're going to step into a very short break. After the break, we'll come back and connect with the management of Office Spaces. Stay tuned for that conversation.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're still tuned to Halftime Report. Let's get some corporate conversations going. Amit Ramani, who's the chairman and MD at Office Space Solutions, is joining us now. Reported a good set of numbers this time around in Q3. If we look at the numbers, their EBITDA was up 30%. That's on reported basis. Even normalized EBITDA was up 18% after adjusting for Ind AS. Amit, always a pleasure speaking with you. Thank you so much for joining us today. And you know, you have ended 9 months on a strong note. Can you give us a sense of what the FY26 outlook is looking like? And if now you have more clarity on FY27 as well, because we're almost done with FY26, what kind of seat additions, revenue growth and margin outlook are you looking at?
So the guidance for our FY26 continues to remain what we had given originally, about a 30% growth for the overall business. As you see in the 9-month period, actually the co-working and allied services grew much faster at about almost 38%. And for the quarter as well, it grew at about 32%. So continuing to see great growth momentum in our co-working business. Also for FY27, at this point, I wouldn't like to comment. We will give that guidance in the Q4 results because we are still planning our annual operating plan there. And the sector overall seems extremely bullish. As you can see, the growth in every sector related to GCC, as well as if you look at now, even with the budget, with the AI and the data center companies and the solutioning that is going to provide tax holidays is only going to help and improve the sector.
Okay, that's going to help and improve the sectors, surely. Just wanted some numbers. Right now, I think you have 152,000 seats, right? When do we expect this number to double from here, Amit?
I can't comment on when it doubles, but you know,
I'm sure you have some internal target at least. Yeah, you're aiming for yourself.
No, so we last year added about 40,000 seats. This year, our seat addition is about 32,000. And that's specifically because, you know, I mean, we are at the highest cycle of the commercial real estate in terms of rentals. So we've been a bit cautious about it. And again, our growth targets remains the same, but we were a bit cautious. So 32,000 for this year. Next year, we will provide that guidance in the next quarter itself.
Okay, so since you said you are at the highest level of commercial rentals, even volumes and pricing are going in tandem, right? So I wanted to understand what would the risks to some of the big opportunities that there are in the industry currently? Would it be pricing decline? Would it be volume decline? How are you seeing the industry shape up going forward, since we've seen a big surge already?
So I think the industry bases a lot of things that have gone in the macro environment, right? I think the trade deal happened. The budget was very supportive of foreign investments coming in. The GCC boom. I mean, if you look at the GCCs, there are about 2,900 GCCs. Every quarter, we are adding 25 to 30 new GCCs. Projection is by 2030, we would have close to about 4,500 GCCs employing 2.8 million people from 1.5 million today. So I think the growth engines and the drivers for co-working, overall for commercial real estate, are very strong. I think for co-working, it's the first port of call, especially for the first-time GCCs. They do not have their teams in India, and as a result, co-working and Flex provides a great solutioning. Today, we have been able to do 12 GCCs, first-time GCCs, 11 more on pipeline. If you look at the overall revenue, 21% of our revenue comes from GCCs, which is about 80 plus companies in our portfolio today. So I think very bullish overall for the sector and as well as for our own growth.
So quickly, if you can tell us, how long does it take for a new center to break even, Amit? And considering that, since Vinny spoke to you about doubling those seats, 32 to 40,000 on an annual basis, do you think next 3 years we can look at 3 lakh seats for office?
Well, we would want to obviously, grow in that direction. But I think there's a very clear, approach that we are taking where we have to balance the seat addition with the growth and the profitability at the same time. If you look at our numbers, we did about 22 crores of, PAT at this point. And we are almost for the year or 9-month period, we are almost 50 crores of PAT. So I think for us, balancing the two, a decent amount of growth, 25-30%, while balancing seat addition is very critical. If you look at our even today's seats that we have added, it's enough for us to demonstrate a 25 to 30% growth for FY27. Exact guidance we will give, but today we still have seat capacity to fill, which will allow us to grow at that pace.
Okay, already enough seat capacity addition. Hoping next quarter you give us guidance, but as of now, 30% guidance for FY26 is what you're talking to us about, as well as going forward 25 to 30% in FY27 as well. Amit, thank you so much for joining us on the show as always and speaking with us in terms of your numbers. But yes, that's the management of office spaces for you all on the channel. But let's move on. And AI, that's what we'll be talking about. We always talk about that. Today we've seen IT stocks that are seeing a bit of an impact coming in here, but we have an IPO that's coming up as well. Fractal Analytics, India's first pure play enterprise AI company. 2,833 crores of IPO, which they're looking to raise, will open up on February 9th. It will be a combination of fresh issue as well as OFS. In fact, Rima caught up with the top management of Fractal Analytics and began by asking about the Anthropic new AI tool and how it could impact their business model as well. Listen it.
There are many companies that will come in that will leverage the power of AI to solve specific problems in a more effective way and therefore build out a great business of theirs. So Anthropic is doing in a few areas, Fractal is doing in a few areas, and other companies will do it in other areas as well.
But they have multi-billion-dollar R&D companies. So today they're doing it in a few areas. Tomorrow it'll be in all the areas, including the spaces that you operate in, like Vedya for healthcare. Isn't there going to be a market share erosion risk or risk of pricing?
Across the world, they will see this is such an evolving space and such a large space. There'll be multiple players, multiple winners doing multiple things. And so Fractal's focus is enterprise AI, which is the hardest part of AI, is translating enterprise AI excitement into enterprise performance. The biggest companies in the world that have complex software structures and databases and so on, and hundreds of thousands of users driving decisions inside companies using AI. That is a space that is currently not yet taken off in a very significant way. So that was also, in that terms, there are very few companies in the world that understand it. Even Anthropic and OpenAI, etc., don't have a full understanding of how enterprises really work because they have not solved those kinds of problems. So Fractal is well placed.
So no risk of disintermediation, no risk to the business model field.
We are the disintermediating or disruptive force that's saying that your existing technology stacks don't do a good job. Use AI to power decisions directly using these models. So we feel we are the disruptive force right now.
Has anything that Anthropic's Claude released which directly competes in the space you're operating in, any of the 11 plugins?
Not today, but we do use Anthropic, OpenAI, and our own reasoning models in order to drive this. And so therefore it is a way in which we get better.
Okay, let's get back to business then and numbers. Now your FY23 to FY25 revenue growth was about 18%. Now, considering you positioned yourself as an AI leader, you're an AI company, shouldn't growth have been higher?
Our growth, yes, it can be higher. And we expect, see, the big change that I am saying is that consumer adoption of AI has been phenomenal, right? For example, ChatGPT, 800 million weekly active users. It's been one of the fastest adopted technologies ever in the history of business. When it comes to enterprise, this hasn't been the case because of a very good reason, that AI excitement does not automatically translate into enterprise performance. Like I said, enterprise systems are very complex. They have thousands, hundreds of thousands of databases and the data sources, and a lot of that is structured data. So most of the AI progress has happened on unstructured data, which is video, voice, and text. When you bring it to structured data, that things that can be in rows and columns and spreadsheets and so on, that's where you don't see enough AI progress. So what Fractal is doing is bringing that AI and going into enterprises and driving that adoption. As enterprise AI adoption takes off, which will happen in the next 2 to 3 years, we expect accelerated revenue growth.
So FY25 growth rate was 25%. I mean, can you, in the next 2 to 3 years, keep at this 25, 30% kind of revenue run rate?
Look, we'll be disappointed if we don't grow that fast. Okay. That is the opportunity is huge. We have to obviously execute, but the opportunity in the AI space is mind-bogglingly large.
FY25 margins were about 17.5%. In the first half of the year, adjusted margins were 15%.
Yeah.
What are the steady state normal margins for a company like yours?
Yeah, if you again look at our historical performance, margins have improved considerably over FY24 versus FY25 was significantly higher. And again, if you look at the first half of the year, it was 15% versus 15.9%. So there's always a little bit of seasonality between first half and second half of the year, as you can see, versus the last year.
So what are the steady state normal margins for a company like yours? What is the long-term aspiration on margin?
Yeah, see, our gross margins are in the 46% range. And Cogentic, which is our enterprise agentic AI platform, there the margins are significantly higher. So as Cogentic becomes an increasing share of our overall revenue, our margins will trend upwards. Even in the rest of Fractal services, we see that our margins are actually trending upwards. So we expect margins to go up, and you'll be happy if it is in the 50+ range. And the gross margins are in that range. That's where we're taking it.
So margins should trend up, and the key driver for that will be increasing contribution from your agentic AI platform, Cogentic. And that will drive gross margins from the current 45% to 50% plus. So let's talk about Fractal Alpha, which is your incubation platform. While it's growing very fast at the top line, it's still making losses. What is the internal target for turning it around? When does it EBITDA break even?
So it's already improved significantly in terms of profitability. We're already seeing some of the elements of Alpha businesses starting to break even. So we expect that to happen in the very near future.
Next 1 year?
Next 1 year.
Technology obsolescence, that is a real risk for you, right? How much do you spend on R&D, and how does it compare with global peers?
So we spent 6.1% of revenue on R&D for the last 6 months, for 6 months of this fiscal year, and we expect it to be higher. Now, typically, product companies, the best product companies in the world, spend about 14% of revenue on R&D. Services companies spend 0% of revenue on R&D, 0 to 0.5% of revenue on R&D. We are at about 6, going to 7, and potentially higher. We will expect it to be going up, not just on its own, but also as a fraction of our revenue. It'll go up. And this is important. We want to be the most innovative AI company out of India, and we want to make sure that our R&D spends are reflective of that.
Let's talk about valuations. Market capitalization is 15,500 crore. Your adjusted profit for the first half of the year is 143 crore. Which means if I annualize it, I'm getting a PE of close to 50 times, even accounting for the dilution on account of the fresh issue, or price to sales of 4.8 times. Who have you modeled the valuation on?
We haven't modeled the valuation on any one company. I mean, there are a bunch of companies out there that one can look at. Palantir is a great example, who is trading at phenomenal revenue to market cap ratio, more than 100 times forward revenue of. So we expect that some of that kind of transformation we can show at Fractal as well. Fractal today is, for example, Palantir did an amazing job of growing their revenue significantly without increasing their headcount over the last 2 to 3 years. We expect to,
So that's the company you emulate globally, Palantir?
Yes, Palantir is a company that we do think of highly, very highly.
All right, that's the word coming in from Fractal Analytics. The IT space continues to be in focus, a big downtick in the entire space. Time for a break now. On the other side, we'll focus on the F&O action with Mangalam after this short break.
Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty is at 25,750. Recovered from the day's lowest point, back in the green as of now. But we have Mangalam, who's at the FNO desk, to tell us what are the important cues in terms of the world of FNO that he's keeping an eye out on right now. Mangalam, good afternoon. Okay, yesterday we did see that run-up coming in. Today we are managing, just around that positive, negative. Nothing to complain there.
Well, the word to describe the market would probably be resilient. And why do I say that? Two data points should come up for you. The Nifty is marginally in the green or absolutely flat, despite the Nifty IT actually having fallen nearly 7%. So that's the kind of pressure that one big set of stocks is, putting on the frontline index. And the market's resilience is actually defined by the kind of up move that we're seeing or support that we're seeing from the other players, the likes of Reliance and Nifty Bank. So these factors are keeping the market fairly resilient. After a 600-point up move yesterday, we are holding on to those gains, so that's not a problem. Volatility has cooled off. So despite the tug of war between the IT and all the others which are supporting the market, the volatility index has cooled off. So that tells you that bulls aren't particularly, unhappy about the kind of decline that we've seen in the IT pack, and they believe that sooner or later this will improve. At the same time, the advanced decline on the broader markets is doing a lot better. Even though the mid-cap index at an index level is in the red, that's buoyed lower by a couple of these IT names. If you look at the crisscross lines, for most part of the day, including right now, more number of stocks have been advancing than the number of stocks which are declining. That tells you that the health of the broader markets are also fairly good. And if you look at, the put-call ratio as well, which is at around 1, which is fairly stable. On a day like yesterday and today, it could have easily gone to extremes of around 1.2, 1.3. So that's a positive. And the Nifty is now between technical moving averages, 20-day moving average and 50-day moving average. 25,500 is where I see support, and 25,820 is where I see some sort of supply coming in from a technical standpoint. And that's what the option writers are playing for as well. If you look at the active options, we're at 25,750 thereabouts. So 25,700 put writers are fairly active. They expect support at around 25,550 to 25,600. And 25,800 call writers are equally active as well. So after a big move up yesterday, the market's set itself to a much higher range than what it was trading at earlier. But a range-bound move and resilience is what we're seeing more than anything else.
Okay, range-bound move. That's what the markets are at. Thank you so much, Mangalam, for getting us all those details from the FNO markets. Time for another break. On the other side, we'll get Manisha Gupta joining with Sachin Jain of World Gold Council. Stay tuned for that conversation. You want to know what happens with gold prices from here on. This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Joining us now is Sachin Jain from World Gold Council. Sachin, hi, thank you so much for joining in. And just so much happening in this market right now. And I have various questions to put out to you. But first of all, on the volatility, the last 3 or 4 sessions have been nothing short of creating records on the higher side, on the lower side. And then, of course, with the kind the markets are moving. How are you reading into all of this?
So first and foremost, Manisha, a big thanks for getting us on the platform. And I always look forward to your conversations because they're insightful and detailed. So, if you look at what we had talked about, and we always have been talking about the long-term sort of strength of gold and the pillars on which gold is built on, which is strongly in favor in the current geopolitics environment, in the de-dollarization environment. And I think what has happened, not just in the last week, but the last almost 15 days or 18 days rather, has been unprecedented. And it's very high volatility. It's very short-term thinking. A lot of games getting played. But as World Gold Council, again, I'll reiterate the point that please look at gold as a long-term diversifier. And currently, in the current context, the strength that gold has displayed on a perspective of being liquid as an asset, from a safe haven, all those elements continue to stay very strong. And what's structurally happening across the globe is what we're witnessing, and also the results of 2025. We've seen that the core reason why it's also happened is the global debt, and the reason why US economy is printing a lot of currency, and hence as an outward, the confidence on gold as an asset class. And that will continue to happen.
Oh, well, absolutely. Sachin, the kind of asset class that we look at gold at, a movement of $200 in a matter of a day, with people shorting, gaining, institutions getting in, retail buying in, ETFs getting in. Is this a panic mode? Is this froth? Is this speculative money? What's your sense?
Well, actually, let's look at a lot of what's happened globally, and there's a lot of profit booking that we witnessed in the initial part. Also with stock markets and very important stocks, including Microsoft, that had a negative impact in the trading sessions in America. We believe that a lot of profit booking happened in gold to suffice for the margins that were required in those markets. Now look at India. January, the growth on ETF have been a historical high. We've seen a 15-ton AUM increase in January alone. But when you look at those numbers in the last week, those assets have sticked on. So I think the confidence on gold is far different than what's happening globally vis-a-vis what's happening in India. And Manisha, we've been talking about the growth of ETF. In the year 2024, about 15-16 ton was the total growth that we witnessed across the year. And now we're talking about the AUM growth of 15 ton just in a month. And as I said, we've seen stickiness. We've seen, again, a bit of long-term play in what we see as investors in India.
Oh, totally.
So we'll see.
Sachin, I was also reading the World Gold Council report for the trends that we saw in 2025. Various records being created there as well. In spite of record numbers, we're looking at record demand for previous year.
Absolutely. And I think it's been very interesting and a very strong year for gold, not just purely because the prices of gold have gone up, but also sectorally things have moved. Also, geographically, things have moved. And maybe if I can give you a small scope as to broadly what's happened globally. So the demand for gold crossed for the first time 5,000 tons, so totaling to 5,002 tons in 2025. And interestingly, of course, the largest lever or the largest growth area we saw was investment demand, totaling to about 2,175 tons. And actually, the very interesting fact that I like to share to your viewers is that gold, the investment demand transaction of gold in 2025 crossed $6 trillion. And what that really means in INR terms is 18,70,000 crores worth of gold that moved on a daily basis, if you average out across the year, through the year, which makes gold the most liquid asset on planet Earth. We saw jewelry demand at 1,542 tons. We saw a consistent growth in the technological demand. And lastly, on the central banks, we saw a consumption of 873 tons. Now, that's lower than 1,000 ton that we saw in 2024, but still strong. And if you see the long tail of central banks that have bought, smaller countries, smaller central banks that have become active, we'll see what happens this year. Now, if you look at the similar time of 2025 in India, our demand for gold was 711 tons, which is almost 11% lower than 2024. However, in terms of value, it's about 35% up. If you look at sectorally, jewelry demand was about 24% down in terms of volume. But again, value-wise, it's 13% up. And I think it's a very important note to understand that jewelry demand reflects on the budget of consumers that they have. And consumers, of course, didn't increase the budget the same way the gold has gone up, but their interest in gold is an all-time high, and we believe that once there's more price stability, consumers are going to come back. We saw investment demand increase by almost, historically 73% in terms of value that has gone up. And very interesting fact has been that we track the recycling of gold that happens. And when I say recycling, I'm talking about gold getting converted to cash. And that has dropped by 19% in 2025, which again is a very interesting element of a find, because that truly reflects the confidence that consumers have in gold. And people have traded gold to gold, but the
Not gold to
exiting
cash.
of gold to other asset class or cash has been down by 9%.
Rather down. I have one final question, Sachin, and this is about the US-India trade agreement, and that really seems to be bringing a lot of cheer to various segments. And I've been talking to GJPC, where they tell me this is second Diwali for them, and they're looking at higher exports back to US. What does it mean in sense of how are you looking at the trade going up, and what does it mean for global gold buying and India as well?
I think from a Gems and Jewelry Export Promotion Council and from India's perspective, it's the best news we could hear. There are two further elements that will happen, which I think will amplify our exports. There's a lot of efforts that we're doing on making India as an exporter to the world. And I'm talking about gold jewelry right now, which today we export primarily to the Indian diaspora. And I foresee that with this trade agreement, it also opens up doors for us to be more competitive than, for example, Shenzhen, China, Hong Kong, various other markets. And Indian entrepreneurship will take lead in this time. And I foresee that India is not going to be just a net importer of gold, but also a net exporter with value addition, and US being the mother of all markets. And what's happened is that with gold prices going the way they are, there's a lot of emotional connect of the high-end consumer or a luxury consumer that's happening not just in India, but globally, and an inclination to consume high-end pieces of gold. And I think I again salute to the leadership of our nation, and what we've come out is great. And I think that over the next 1 or 2 years, you'll see great amplification of Indian exports. Of course, we were leaders in diamonds, but I also foresee us become leaders in gold.
Sure.
Right.
Sure.
It's a very, very bullish Sachin on your screen there.
Absolutely, and an interesting conversation. Net exporter of gold also is what we're keeping an eye on now. Sachin, thank you so much for joining us. Manisha, thank you so much for taking us through that conversation as well. That's all about gold in the trading session as well as going forward. But on that note, we're going to step into a very short break. Up next, we'll connect with the management of Mahindra Life Spaces and discuss their Q3 earnings. Stay tuned in.
Welcome back. You're still tuned in to Halftime Report. Mahindra Life Spaces, that's the stock on our radar, reported a good set of Q3 earnings. Their bookings, the volumes, collections, they were up on a YOY basis. Let's get in Amit Kumar Sinha, MD and CEO, Mahindra Life Space Developers, joining us now. Mr. Sinha, thank you so much for joining in. Well, yes, there's an increase in Q3 bookings and volumes as well. But if I look at the 9-month sales, they have come in at 1773 crore rupees. FY25 sales were at 2800 crore rupees. Do you think you'll be able to surpass last year's bookings, considering that the quarterly run rate so far has been around 500 crore rupees?
Yeah, so thank you. I think we will be able to surpass our last year numbers and hopefully show a healthy growth. Some part of that is driven by the launches, as you touched upon. We just an example, we had a very successful launch of a project called Mahindra Blossom in Whitefield, Bangalore. It has done in the 3 days of the last to last weekend, it did more than 1,000 crore itself. So actually, we are hoping to see a significant growth driven by some of these launches. So one of them is Mahindra Blossom. We're expecting a couple of other launches to come through. But more importantly, for the launches that we did in early part of the year, as well as the phase launches of the previous projects, that will give us growth momentum. But I think we see good opportunities across all of our markets, Mumbai, Bangalore, and Pune. And these launches are just an evidence to show that there is momentum in the market for our kind of products, for our kind of value proposition.
Right, Mr. Sinha, but could you quantify these launch numbers for us, and how much in Q4 and how much would come in FY27?
Yeah, so we are looking at maybe 2 to 3 big launches coming in the next 3 months, and I'm not constraining it by the end of financial year because sometimes the launches spill over the March 31st deadline. But we have roughly, I would say, anywhere from 7 to 8,000 crore worth of launches that are going to happen towards the end of Q4 and the start of Q1. So combining some of that together. Exact radar dates, exact launch dates are not yet known. We are pushing hard to get them sooner. But this is very important because for the next year, I've given a guidance of 4,500 to 5,000 crore for our pre-sales on the residential side. And that's something that we are really looking forward to by having these launches locked in the early part of next financial year. And hopefully some of the Q4 launches will actually have a very good soothing effect for the pre-sales velocity in the next year.
Okay, Mr. Sinha, the big talking point, of course, has to be demand trends, realty index coming off the 52-week high, many stocks at lows as well. Do you think we're towards the later part of the real estate upcycle?
Yeah, no, I wish I knew the perfect answer to that, but let me give you 3 points here. The first point is there are some signs of moderation in the market, especially in certain segments and certain micro markets or specific cities. For example, NCR, we see a significant slowdown. We see slowdown in a luxury segment. So I think there are markets that have this characteristic show up. But overall, if you look at the overall, like we look at inventory overhang, like how much of inventory is there that is in the market that the customers can buy. It has moved up only 10% from 13 months to now close to 15 months. That means if there are no new launches coming into the market, all the inventory that is there will get absorbed in the 15 months. It was 13 months 2 years back. So it hasn't been very significant shift on the inventory overhang side, but there is certain pockets, certain segments where you see slowdown. So that's the overall market, I would say. The second is it's very important for us to be clear where we play. And it's good that we are playing in Mumbai, Pune, and Bangalore. And third part is as things slow down, and we expect some part of it to happen and then get corrected over a longer period of time, there is a shift towards branded developers, shift towards quality developers who have multi-year track record, who have always met customer expectations, exceeded customer expectations by designing the product well, but also delivering them on time in line with their expectations. And we players like us tend to stand out quite well.
Okay, all right. Mr. Sinha, thank you so much for that honest answer. That's the word coming in from Mahindra Life Spaces. They continue to see growth and new launches. But yes, there is some moderation in select micro markets. With that, we'll slip into a short break. When we come back, we'll talk more about markets, get you some stock-specific action as well on the other side.
Welcome back to Halftime Report on CNBC TV 18. Like you can see, the Nifty as of now, 25,700 around that mark of the day's highest point, of the day's lowest point. But resilient day is what is coming in for the markets. Broader end of the market, though, managing to hold on to better gains in today's trading session. And that's what we are keeping an eye out on. So
yes, absolutely choppy, flat for now, but we'll keep an eye on what the moves in the later part of the day are. And with that, we'll take your leave on this edition of Halftime Report. Thank you for tuning in. Business Lunch comes up next.
Stocks continue to swing between gains and losses as IT stocks drag, but the real economy plays. The energy, utility and consumer durables along with metal names are offsetting the impact. In fact, the advances are far outstripping the declines, keeping the positive sentiment intact.
Anthropic's latest plugins for Claude Cowork that automate data analysis trigger a slide in IT stocks as disruption fears resurface. Analysts see lesser impact for Indian IT services but suggest some derating.
Fractal Analytics is eyeing a scaled back valuation of nearly 15,000 crore rupees for its IPO. This comes after it trimmed the IPO size by over 40% compared to initial expectations of a rush for India's first AI company offer temper.
Gold posts its biggest single-day gain since 2008, climbing 6% overnight and rushing past the $5,000 mark. Rising US-Iran tensions and continuing demand for the physical metal, including from central banks, aids the rebound.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. I mean, the markets today, Nifty and Sensex, now in the red, and the broader markets doing better than them, which hasn't happened in a bit.
That hasn't happened in a bit, indeed. And it's been that kind of a session, right? You know, compared to what we saw yesterday, the optimist would say we were up 600. The pessimist would say we were down 600 from the highs. You can say it both ways. But for now, it's a proper tug of war that's happening between the bulls and the bears as we speak, and the bears are led wholeheartedly by the IT stocks. They have plummeted in today's trading session. Large cap IT, mid cap IT, there is no space to hide whatsoever. 7% lower now on the IT index and led by all the index heavyweights. Infosys is now down 8.5% as we speak. The losses continue to mount. TCS is now down 7%. It has slipped below the mark of 3,000. The market cap has now slipped below the 11 lakh crore mark. Wipro is down 4.5%. Tech Mahindra, HCLTech, Persistent Systems, Coforge, you name an IT stock, and it is down anywhere between 4% to 10%. That is the kind of rout that you have seen across the IT space. But offsetting IT are the banks and the other names that are doing well for themselves, Arundhati. So it's a proper tug of war.
Absolutely. And, you know, as you pointed out, if you look at that sectoral performance, you can't not talk about that IT pack, right? It's seeing big cuts after Anthropic's new AI tool sort of spooked those IT names. Infosys, Coforge, LTI, Mindtree, all of them falling nearly 8%. Every IT stock, as Hormuz pointed out, on the index is in the red. However, gains across other sectors are offsetting the losses that we're seeing in this IT pack. We've got oil and gas names doing well, Oil India, ONGC, IOC, all of them gaining between 2 and 4%. The metal pack continues its up move, NMDC, Vedanta and Zinc, all of them seeing gains as well, 2% to 3% higher. Auto stocks also doing well, Bharat Forge, Maruti Suzuki, Hero MotoCorp, all of them between 1 and 2% in the green. But the key talking point after the India-US deal was announced yesterday, Parikshit Luthra joins us now with more on the agreement between India and the United States. Parikshit, what are sort of the next steps after this announcement?
Well, a lot has been spoken about the $500 billion commitment to buy more American products. Sources now tell us that India now intends to buy more of American products which we need for our energy and economic security. And this is not immediately. This is an intention to buy American products over a 5-year period. What will this include? This includes US oil and LNG, purchase of which is already 70% up year on year, aeroplanes, aircraft components, precious metals, diamonds, technology products, high-tech chips, products used for data centers, and all of this will be purchased in a staggered manner. And this is India's intention to do so. So that was one important point. Secondly, how do you frame what has happened so far? Officials in the government calling this the first phase of the bilateral trade agreement. Now, this is in goods only. A joint statement will have to be finalized by India and the United States, and then this will be followed by a signing. What is important to note that our labor-intensive exports, which had been impacted very heavily, especially textiles, leather, footwear, that now gets a comparative advantage over countries like Indonesia, Vietnam and China. So sources tell us that $30 billion worth of Indian exports, which includes bulk of your labor-intensive exports, will now be subject to 18% tariffs instead of 50% earlier. We also see that there will be no change in tariffs under Section 232, which the US imposes under national security grounds. So this includes auto and steel. So whatever tariffs were there under Section 232, they continue as it is. As far as exemptions go, there were close to $44 billion worth of products which are not subject to reciprocal tariffs earlier. And this includes pharma, mobile phones, minerals, natural resources, and those will remain exempted. A lot of moving parts in this deal. Some of the negotiations are still taking place, but the in-principle agreement has been reached. The finalization of the joint statement will be crucial, and that will be followed by the signing of the deal. And then, of course, there will be a negotiation on services and the full-fledged BTA. All of that is going to take a long time, but the first step has been agreed upon.
Parikshit, thank you for that update there. Now, US Trade Representative Jameson Greer spoke exclusively to CNBC on the trade deal with India. Take a look at that conversation.
The time has come, and now we have the deal. We'll finish papering it, but we know the specifics, we know the details. It's a very exciting opportunity. On the one hand, we'll continue to maintain some level of tariff against India, 18%, because we have this giant trade deficit with them. But they've also agreed to reduce their tariffs for us on a variety of agricultural products, manufactured goods, chemicals, medical devices, etc. It's an exciting opportunity for both countries. And starting at the end of last year, the Indians started winding down their purchase of Russian oil. We've been monitoring that. They've been diversifying purchases of energy from the U.S., not just oil, but also gas, propane, other things. That's been going up. We'll keep monitoring that.
Meanwhile, India's Commerce Minister Piyush Goyal says that agri and dairy products are protected under the trade deal with the U.S. Take a look.
एग्रीकल्चर और डेयरी इन दोनों सेक्टर्स को संभाला है, उनके हितों को संभाला है और इस क्षेत्र में लोगों को उज्जवल भविष्य मिले और मौके मिले, आमदनी बढ़े, उसके लिए लगातार काम किया है। यूएस ट्रेड डील में भी भारत के जो सेंसिटिव सेक्टर्स हैं, एग्रीकल्चर को लेके, डेयरी को लेके, उनको संरक्षित किया गया है।
Now, SEBI Chairman Tuinkant Pandey has reacted on the issue of the STT hike in the union budget. Listen to what he had to say.
लिक्विडिटी इंप्रूव करना हमारे जो मार्केट में, कैश मार्केट में, वो बहुत इम्पोर्टेंट ऑब्जेक्टिव है हमारे लिए, क्योंकि उससे बहुत सारी जो लिक्विडिटी की इश्यूज, लिक्विडिटी टर्नओवर बढ़ने से मार्केट की जो स्ट्रक्चर है वो इम्प्रूव होती है। कि जहां आप एसटीटी की बात कर रहे हैं, उसमें भी थोड़ा सा ज़्यादा डिफरेंशियल भी क्रिएट हुआ है बिटवीन द कैश मार्केट एंड द डेरिवेटिव्स मार्केट।
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Fly Emirates, fly better.
Shares of Indian IT companies fell after AI startup Anthropic released a productivity tool. The the IT index has fallen over 6%, and all of those stocks seeing big cuts. Rima is here with all of those details. Rima, what's spooking these IT stocks?
Well, the fear is of disintermediation. Just to take a step back and understand what happened. So Anthropic has released a Claude co-work agent. It's agentic AI, and they've done it for 11 segments. One of them is legal. And basically, this is not sold as a separate standalone AI tool. It's built directly into the platform enterprises already. It's built into the platforms that enterprises already use today. So the fear is of disintermediation. Now, there are many companies which sit between an LLM and an enterprise. They use the power, the infrastructure, the ability of the LLM to understand the enterprise's workflows, the data, the unstructured, structured data, and come up with analytics. Right? There are companies which do that. So Claude AI, the agentic AI, has done it for 11 sectors. And one of them, the legal one, has actually spooked a lot of them because it can go through compliance, it can do documentation reviews, it can come out with legal briefs. So the fear is that what if, going forward, you don't need that, that integration service provider, that intermediary. And even if you don't replace the intermediary, the fear is that can it cause deflationary pressure, pressurize the revenue pool. And even listed IT companies do earn certain amount by implementing customization, integration, and maintaining enterprise software. So yesterday there was a sell-off across the board. Companies which provide software tools to legal companies, there are data analytics companies which sold off, even SaaS companies like ServiceNow, Salesforce sold off. Here in India, you are seeing a brutal sell-off, and it comes at a time when the sentiment surrounding the technology space has also been very weak. IT companies have gone through a period of deflation, and now the fear is that there will be increased deflation. But is the sell-off overdone? What is the other side of the story? Listen in to the opinion Shireen got when she spoke to IT majors surrounding the impact of AI on their operating business model when she chatted with them at Davos.
How much of this new AI opportunity is likely to cannibalize on the existing maintenance revenue?
So where we've built some estimates which show there is some compression of revenue in different services because many of the AI agents improve productivity. But equally, we see a larger pool which is growth opportunities. And we will showcase that to show that net we see much more growth than compression.
I also want to understand from you how your contracts and your billing is being reworked in light of the fact that you're now doing AI work as part of it. So there's agents and so on and so forth. I mean, how are contracts, is pricing being changed on account of the AI influence and the AI adoption?
It's very early, but my sense is it will change. So first, as you know very well, a lot of things were moving to outcome based. So agents will support that. And as we go through time, my sense is there'll be a mix because we work on what we call pods. Pods have engineers in them. We will also have some part of it with software agents. So the pricing will evolve, but today not a lot has changed, much more outcome based.
Okay, so what could that potentially mean as you look at repricing in this era that you intend to transition into?
Not very clear yet, meaning there is a lot more value that these agents and the joint work will deliver. But as always, at least what we've seen in the past, part of that value shared with the client and part then comes to Infosys.
So in terms of margin impact is what I'm trying to understand what it would mean.
So the margin, first, we've had a very strong margin program over the last year and a half. So we are very clear that our margin will remain at the guidance we are at right now. We don't see anything which will become negative on that.
What should the next chapter in our AI journey as a country look like?
See, if you look at from what the traditional lens, most of the Indian companies are good at, the traditional services companies. I agree with what the minister said. He talked about the 5-layer approach, and what in TCS we call it the infrastructure to intelligence. There are multiple layers from infrastructure. There is a model layer, there is application or the agent building layer, and the experience layer on top. And while many of the IT companies in India have not built their own models, but we should not lose fact that the value actually comes in in understanding the business context of our customers, ensuring the data for our customer data works for them. And I think that's our core capability. And most of us are focused on that, and you'd see us delivering value from that.
So there's going to be no change. You're not going to go the LLM way.
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
Raj, FinServe's numbers at the bottom of your screens. Profitability absolutely flat from last year. The revenues have grown by 24%. And we'll get you more details on this as the show goes by. The stock, though, has taken a bit of a dive from the highs. Not as much, but still 0.7% lower. As we speak, we'll get more details in just a bit. But reacting to recent reports of NVIDIA's brewing tensions with OpenAI, CEO Jensen Huang has told CNBC that the chipmaker's plans to invest in OpenAI remains on track. He said that there is no controversy and emphasized that the company's continued support for OpenAI remains.
No, there's no controversy at all. It's complete nonsense. We love working with OpenAI. We are incredibly honored and delighted to be able to invest in their next round. And so we're privileged that they're inviting us to invest for each one of their rounds. We would love to be invited, and we would consider, of course, investing in it. This is one of the most consequential technology companies in history. And this will by far be one of the most exciting investments. And I'm delighted to be invited, and we'll consider every single one. We are going to invest in their next round. We're looking forward to Sam closing it, and he's doing terrifically. And we will invest in the next round. There's no question about that.
On that note, it's time for us to slip into a short break. But here's a quick sneak peek into the stocks we will be addressing on your stocks today. Don't forget to catch fundamental and technical experts give their views on these at 2 p.m. today, only on CNBC TV 18.
Welcome back. The 4-day partial U.S. government shutdown has ended with Donald Trump signing the $1.2 trillion funding bill after it was passed by the House of Representatives, which are narrow majority. The bill contains spending measures for Homeland Security, Pentagon, State and other departments. The next report tells you more.
But I'm thrilled to sign the Consolidated Appropriations Act.
U.S. President Donald Trump signed a spending deal into law on Tuesday, ending a partial government shutdown that went into effect on Saturday. The deal gives lawmakers time to negotiate potential limits on Trump's immigration crackdown, while restoring lapsed funding for defense, healthcare, and other agencies.
And it continues funding for the Department of Homeland Security until later in the year.
Trump negotiated the spending deal with Senate Democrats, who are demanding new restraints on his aggressive immigration enforcement tactics, following the killing of 2 U.S. citizens by federal agents in Minneapolis last month. The deal passed the Senate by a wide bipartisan margin last week, and on Tuesday it narrowly passed the House of Representatives.
On this vote, the yeas are 217 and nays are 214.
Here's Democrat Steny Hoyer from the House floor.
Minneapolis has shocked the conscience of America. The Congress needs to rein in the Department of Homeland Security.
Republican House Speaker Mike Johnson said states led by Democratic leaders need to work more with federal law enforcement.
We make the plea and the demand that the governors and the mayors in these blue states and blue cities participate with federal law enforcement so that we have a safer environment in which to implement and to enforce federal immigration laws.
But Elaine Camark, senior fellow at the Brookings Institution, said Republican support for ICE could backfire during November's midterm elections.
Who knows if it'll be a live issue in October or November? If they pull back ICE and pull back this sort of radical deportation plan, by the time we get to October or November, it may not be an issue anymore, and I think that that's what they're realizing.
The Trump administration said it was already deploying body cameras on immigration agents in Minnesota, which is one of the Democrats' demands. But other Democratic proposals will face more resistance as negotiations between the two parties continue.
And with that, it is a wrap on this edition of Business Lunch. From Hormaz and me, goodbye and many thanks for watching. Midcap Radar takes all the action forward.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Some recovery from the lows. It's been choppy so far. But yes, we are sitting with gains of 35 points right now. And Bank Nifty and Midcaps, they are outperforming.
Hi, Sonal. Yes, absolutely. But the story really lies underneath the surface at this point in time, with the IT stocks really taking the brunt in today's trading session. All that and more in the next 30-odd minutes. These are top stories. Stocks swing between gains and losses as IT drags, but the real economy plays. Energy, utilities, consumer durables and metals offset the impact. In fact, advances far outstrip declines, keeping the positive sentiment intact.
Hindustan Aeronautics, previously a front-runner to build India's fifth-generation stealth fighter, has been reportedly knocked out of the race. The stock slipped 6%.
Nomura upgrades XI to a buy rating with a target of 398, expecting the industrial business to recover even as growth in the auto segment remains healthy.
And shares of Lloyds Metals, V2 Retail and Sheela Foam, they see gains in today's session on the back of solid December quarter numbers. V2 Retail, though, has come off from the highs.
All right, so those were all of the stocks that we are following in today's trading session, all of the top stories that we're tracking at this point in time. Remember that the broader markets are seeing some amount of momentum or a marginal amount of outperformance at this point. So the mid-cap index is up around 0.3%. The advanced decline ratio stands in positive terrain as well. Remember that yesterday was that super performance for the markets reacting to the India-US trade deal. So today is a little bit of consolidation which is taking place. However, the advanced decline ratio, like I mentioned, is on the positive side. So 2,700 stocks advancing to around 1,600 stocks declining at this point. Maybe we can just go across to Gaurav now if he is with us. Yeah, to take us through all of the mid-caps that are moving around in trade this afternoon. Gaurav, over to you.
Well, as if you look at the mid-cap index, it is actually up 0.3%, and the reason being that it looks like the US tariff trade euphoria is still not over, because we have got stocks like Gokaldas Exports, Sheela Foam, Kitex, Avanti Feeds. All of these are actually up in trade. And on the flip side, if we look at the IT index, now that is seeing some kind of pressure, and the reason being that the Anthropic AI tool, which is actually taking over the IT index, not just in India, but we saw this effect in US market as well. We've got Eclus, Signity Tech, Coforge, LTI Mindtree, Persistent System, all under pressure. Remember today from the Nifty mid-cap index, we saw Oil India actually reaching its 52-week high. But on the flip side, we saw IT names like KPIT Tech reaching its 52-week low level. So all in all, it looks like on one side we are seeing sharp gains, but on the other side, which is IT, we are seeing some kind of cuts coming up from the market in a day-to-day.
Okay, all right, take that point. Thank you so much, Gaurav, for joining in. Let's get stock specific now. Pidilite posted a good and a consistent quarter in terms of volume growth and even margins. My colleague Mangna Malu caught up with Sudhanshu Watts, the managing director of the company, began by asking him as to what could have been better in the quarter and also if there are any downside risks going forward. Listen into that conversation.
What could have been better is that in the quarter that has gone by, I think we also faced a little bit of pressure because of the US tariff. You know, there is a part of our business which has basically a high export intensity. And I think that business got affected in quarter three. So we've delivered a 10.2% growth, but Manglam, that number could have been upwards of or closer to about 12%, if I could say so.
All right, but,
but
between
I think
that,
consistently delivering, building on the portfolio, I think that's very good.
Between that and now, you know, the US-India FTA has been, or rather a trade deal has been signed. So do you think this removes the uncertainty and that 10% becomes 12% starting next couple of quarters?
We will continuously lift the growth, Manglam. It's difficult to predict and give a specific number, but I think we will continue to lift our growth. You've seen that. Even if you look at 9 months into this year, Manglam, our growth has gone up by about almost a percentage point. And I think that's something which we will continue to grow as we go forward.
And what about the domestic business? What do you make of the environment right now? Because a lot of the other building products peers, they did say that, you know, there was this shorter festive season, extended winters, or rather extended monsoons, all those factors impacted their volume growth. And you did near 10% volume growth in that as well. What did you do differently and how much of this is likely to continue?
So, Manglam, I think one thing which I have steadily maintained in all my conversations with you is that what comes into play when it comes to Pidilite is two things really stand out. And I think something which we continuously keep working on. And, you know, one is the strength of our portfolio. Right. So we keep building our portfolio, Manglam, which allow us to sort of, you know, manage some of these external factors better than most of our peers. And I think the second thing which is interesting about us is our execution machinery. So we continue to sharpen the pencil as we keep going, and we are obsessed about improving ourselves and getting better of ourselves when it comes to execution. So these two things give me a lot of confidence. If you look at the quarter that went by, for us, our construction chemicals portfolio, particularly Roff, which is our tile adhesive brand, and also Dr. Fixit, were our star performers in terms of growth. Other brands also did well, but I think these two sort of lifted. So what happens is, quarter to quarter, year to year, you will have one star batsman who will come and score a century, Mangalam. And that ensures that you always put a good score on the board. I think that's the way we work.
You often say this, that you have this core growth and pioneer categories that happened, etc. If you could give us a sense, because you don't give us specific portfolio numbers, what proportion of your portfolio grew 2x, 3x of the overall growth, and which of these underperformed the domestic business?
Yeah, in the domestic business, if you look at it, I think the businesses that continue to do very well for us is, like I talked to you about construction chemical, this part of the business delivered between 2x to 4x, depending on the brand which you were looking at. I think in terms of our core portfolio, we actually delivered good numbers, but we delivered closer to 1x this time. So ideally, our desire is to keep that between 1 to 2x. I think the core part of the portfolio also delivered, but delivered more between 1 to 1.2x of the GDP. So I think that's the way it has been. I think most brands came in and delivered. The growth was outperformed by some of these, and also our projects business. So if you look at projects, we continue to do very well. There again, we've delivered upwards of 20% growth. I think that's what has happened.
Proportion of your revenue is from projects? Because, going forward, the kind of buildings that are coming by, the projects that are being announced, etc., from the real estate players, etc., how much could that impact your growth going forward?
So as we continue to grow, the ratio of projects in our portfolio, or share of business of projects in our portfolio, will keep growing, Mangalam. We don't share a specific number, but all I can tell you, it's sizable. It's continuing to grow. And as it grows further, the share of business will grow. And with that growth, that will continuously give us a lift on our overall growth as we go forward, particularly in domestic business.
And you're not worried about the recent commentary coming in from real estate players where, they perhaps overestimated demand, and as a result of which they're not able to meet their near-term guidances. Is that a concern for you?
So, Mangalam, what happens in our case is that first, I think even if you look at real estate, and even if you look at new construction, you can cut it in multiple ways. There is an element of real estate which is not affected at all. As you know, I think we are sitting in South Bombay at this moment. So there are some which are doing exceedingly well. But fortunately for us, in our portfolio, there is both new construction, but there is considerable renovation and repair. And I think the combination of two, and I think that sort of again insulates us.
How much is that mix, renovation versus new construction?
So I would say renovation at around 70 to 75%, and new construction between 25%. So 25, maybe 25, 30, keeps sort of moving around. So that's the mix. So for us, renovation and repair continues to be higher than new construction.
All right. What do you say about the raw materials? Because it's been fairly well behaved over the last 12 to 18 months, if I remember, VAM prices. Right now, the currency has been a bit of a concern. Do you think that could veer you away from your margin band right now?
So no, we've maintained a margin band of 20 to 24%, Mangalam. I think as far as VAM is concerned, VAM has been quite benign and steady for quite some time. I think in the quarter that's gone by, it was at about $840. I think we feel that it has perhaps bottomed out. But having said that, I think the impact of rupee depreciation or a little bit upward movement on VAM is something that can be absorbed by us, or even can be transmitted in the form of price increase. So as far as margin is concerned, between our ability to pass on the price increase and also some of our cost effectiveness programs, at this moment, we are not worried at all.
Your band is fairly broad, 20 to 24% is nearly 400 basis points. The question was more towards whether it stays around this 24% band where it has really been over the last few quarters. So, or is there any downside risk for it to go to even 21, 22%?
See, Mangalam, as you know, quarter on quarter it fluctuates. But as far as the year is concerned, I think the year that is going on, 9 months into the year, we are at around 24%, actually marginally ahead of 24%. I think in the foreseeable future, with the way the raw material pricing is, we see ourselves at the higher end of the band.
All right. So 10% volume growth continues, 20 to 24% EBITDA margins continue. Just a final question before we let you go. domestic versus, rather consumer versus B2B. B2B had underperformed because of the exports factor that you said. Will the mix of this volume growth, 10%, be led by consumer or B2B in the next few quarters?
So, Mangalam, I think once also if we break up the B2B for the quarter that has gone by, domestic B2B business has delivered mid-teens growth. So I think, so therefore that's a good news. So therefore that gives us confidence. As far as we are concerned, we would like both engines to fire. So for us, consumer and bazaar should deliver double-digit growth, but I'm quite confident that B2B also will come back total now, I think, with the improvement in environment into strong double-digit.
Okay, so that's the management of Pidilite. That stock is up around 1.5%. We also had the MCure numbers which came out, so that stock should come up for you as well. MCure is the one that I'm talking about, up around 1.5%, with revenue up around 20% this quarter. So good going in terms of a performance. We'll take a short break on that note, but we'll get you a lot more on the markets. A lot of stocks in focus this afternoon. All that and more on the other side. Stay tuned.
Welcome back. There's a definite recovery which is underway. We'll have to see whether this sustains or not. But in the broader markets, we are seeing some pressure on specific stocks. HCL is one of them. There is some project that has been taken away from them and it could impact their profitability. Ria is here to tell us more. Ria.
Well, yes, HCL has been knocked out of the race to develop India's fifth generation stealth fighter jet, or the AMCA jet program. Now, this is as per industry reports that have been confirmed by analysts, and HCL was expected to be the front runner for this up until now, which is why the street is reacting so negatively to this new development. HCL had bid for this program with two other smaller firms, and this will now be the first time that HCL will not be involved in one of the country's most significant military projects. The other bidders for this project include Tata Advanced Systems, Adani Defence, L&T and Bharat Electronics, as well as Bharat Forge in partnership with BEML and Data Patterns, among some other companies. And as per reports, three of these companies have now been shortlisted, and the final project winner is expected to be disclosed within the next 3 months. The AMCA project as a whole, the total development cost for the prototype has been valued at 15,000 crores initially, and the total project cost is valued at roughly 1.5 to 2 lakh crores. So this will be a very significant project, and in terms of the impact on HCL, analysts believe that this will be sentimentally negative for the stock, and they do not expect any material impact on the financials of the company. Keep in mind that the FY25 order book of the company stood at roughly 1.9 lakh crore rupees, and at the end of FY26 they are expected to have a closing order book of roughly 2.5 to 2.6 lakh crores. So they already do have a very strong order book that provides them revenue visibility for the next few years. But nonetheless, the stock today is taking a hit, down roughly 6% in trade.
Okay, all right. Thank you so much, Ria, for that. So that is on the back of a news update, but earnings, they're coming thick and fast. Mankind Pharma is on our radar. Ekta, how did the numbers look?
Well, largely the numbers were in line, but the street probably is a bit cautious on the stock. So the revenue was up around 11.5% this quarter, but it was down 4% on a Q-on-Q basis. Similarly, the margins came in at around 25.8%, which was largely in line. And we had the profit, which was up around 12% on a year-on-year basis, but declined 18% Q-on-Q. The domestic business was up 11% year-on-year, which is the bulk of the business, but it was down 4.3% Q-on-Q. Consumer health, which is a part of the domestic business, was up 5%, but was down 10% sequentially. Exports was up 14%, but was down and was up only around 1.6% on a sequential basis. So that's probably one of the reasons why the street was a bit cautious on Mankind Pharma's numbers this quarter. We do have the Century Ply numbers on your screen, where the operational performance definitely looks better. We'll take a short break on that note, but more on the markets once we're back. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, for the market, seeing a marginal amount of movement coming in for the mid caps, so up around 0.4%, with the bank nifty up around 0.4% as well. But let's talk about certain stocks which are in focus, and we do have a couple of them which are buzzing around. We have Nigel as well as Rima joining in to tell us about the stocks that they're tracking this afternoon. Well, Nigel, let's go across to you first. Lloyd's Metal is the one that you're looking at.
Well, Lloyd's Metal has corrected close to around 20% from the recent peak, but the numbers look very, very good. The reason that I say that is that the EBITDA number came in at around 1,800 crores. And the reason that it's good is because in a single quarter now, they're doing 1,800 crores of EBITDA. In FY24, they did close to around 1,750 to around 1,800 crores of EBITDA in the full year. And last year, if you compare quarter three's EBITDA number that they have delivered in comparison to FY25's total EBITDA, actually they've achieved close to around 90% of that EBITDA. So the run rate clearly has gone up from a few hundred crores to around 1,800 crores on a quarterly run rate, and the margins improving by around 35%. How do they manage this? They've got EC limit that's been increased, so they are mining a lot more iron ore and obviously selling a lot more. The pellet production as well is moving up, but the sponge iron production as well is moving up. So put all that together, operating leverages play out. They've done various other measures with regard to the operational efficiency, which is helping them on the margin front. And value-added products as a percentage of their mix as well as moving up. So that explains why the past quarter is very good. Now, the guidance is very strong. For example, on iron ore production, they'll do 22 million tons odd, but for the next year, it'll be 25 to around 26 million tons. On the pellets front, they'll do close to around 6 million tons to around 8 million tons of production in the next year. And also, from being just a pellet as well as an iron ore miner, now they're going to become a steel company. And part of that will be seen in the next fiscal itself. The management spoke to us here on CNBC TV 18 and we quizzed them. Going by the EBITDA per ton that they're doing and going by the volume guidance, they could potentially do close to around 7,500 crores of EBITDA just from the iron ore business as well as the pellet business. They go on to confirm that the Triveni engineering business could do 2,800 crores to around 3,000 crores of EBITDA, and the copper business could pull up 500 to around 700 crores. So from a company that's doing around 1,800 crores of EBITDA on a quarterly run rate, in the coming year, they could potentially do 10 to around 11,000 crores of EBITDA in the entire fiscal. Explains why the stock is excited. Back to you guys.
All right. Thank you so much for explaining that. 10% higher on that name today. But Exide Industries, that's the other one on our radar. Nomura has upgraded the stock. Rima, tell us more.
Yes, so Nomura has upgraded the stock. They say Q3 numbers are largely in line with expectation. The auto segment remains healthy. Industrial business is likely to recover. But what they go on to argue is that the stock has underperformed the market. So in the last 6 months, it's down 20%, while the market itself is down close to about 3%. So after that, the core valuations of the company stand at 10 times FY28. Core is X of the lithium ion cell investment and even the investment, the stake that the company has in HDFC Life. About 3 months back, this core valuation was close to about 13 times. So Nomura argues that now, after the recent underperformance, the valuation looks attractive. The company is expected to see an EPS growth of 17% and hence an upgrade from a neutral rating to a buy. The target price stands at 398. Back to you.
Okay, all right, Rima as well as Nigel. Thanks very much for that. So that's the update that we have on specific stocks, and that's all the time that we have on Mid Cap Radar. Your stocks once we're back. Stay tuned.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC TV 18 Motilal Oswal Studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, in terms of the markets today, a resilient day what's coming for the markets, right? Nifty, as of now, holding on to gains of around 0.2% in the trading session. 43-point uptick is what we're seeing for the Nifty 50. 25,760 levels, around that is what the Nifty is trading at, just inching towards the day's highest point. Let's keep an eye on that. Broader end of the market, that's been outperforming. We've spoken about that through the day as well, and advance decline ratio clearly in the favor of advances versus decline in the trading session. IT continues to be the top sectoral loser. As of now, it's down almost 5 to 6% in the trading session. So let's watch out for that one. Metals continues to shine in the trading session as well, and a lot of individual movers on the back of their earnings. That continues to be the trend. Apart from IT today, obviously specific reasons that we're seeing a fall coming in. Devyani International, I would like to pull that up because I reported their numbers a short while ago, and after that we've seen a run up coming for the stock. So Devyani International for the day is up almost 9%. Let's watch out for that one as well, and a lot more numbers flashing at the bottom of your screens for your Tube investments is something that we'll keep an eye out on. But this is a show where we solve all your stock related queries, and we'll be doing just that with Asa Jain, research analyst at HEM Securities, as well as Richard Jain, equity technical research wealth management at Motilal Oswal Financial Services, to answer all the stock related queries. Asa as well as Richard, good afternoon. Thank you so much as always for joining us on the show. Let's start with the first query for today then. This one is coming in from Jay Parmar, who's writing to us from Noida. He is holding 325 shares of Tata Power. This is at a price of 380 rupees per share. Wants to know the long-term view on the stock. Obviously, earnings around the corner as well for this one. Asta, Tata Power, what's your view on this?
Hi, good afternoon to everyone. If I talk about Tata Power, the previous earnings were a sort of muted one. So what we have seen that the earnings were not able to meet the expectations. Now, with the growing opportunity in the power space, I believe that definitely this company will going to perform. But we really need to see how they are, because they are also increasing their solar manufacturing. In fact, management has indicated that in the previous con calls also. So my idea here is just to stay invested in this counter for a price target of around 390 to 400. So wait and watch. And if anyone has this stock in their holding, then definitely a hold from that side.
Okay, hold is as of now the view coming in. They'll be reporting the numbers today as well, I believe. So let's watch out for that also. Rajat, what's your view for Tata Power? The viewer is making a loss on this one, but anytime soon that we could at least expect the 380 level, which is the buy price. Long-term story, also what is the target?
Yeah, hi, very good afternoon. Well, if you look at last entire 1 year, since Jan 2025, the stock has been trading within a range only. Whenever it comes near that 415, 420, it witnesses selling pressure, whereas on the low side, 340 is a good support for the stock. So I think the longer term trend still remains range bound. But the good thing is that in this entire consolidation, the long term average supports of 50 EMA are still intact. So I think considering he's a long term investor, he has already seen that pain of time wise corrective phase in the stock. So these are not the levels where he should look to exit from it. Continue to hold on at current levels. In the near term, the 200 EMA is around 384 itself, around your cost price. So expect that pullback move in the short term. But even from a longer term perspective, I would advise to continue to hold on the positions.
Hold on to that position. That's a view coming in on the technical front as well. Let's move on to the next query for today. We have Tarun Kapoor, who's writing to us from Nagpur. He is holding 500 shares of Samvardhana Motherson, and this is at a price of 120 rupees per share. Wants to know if he can add more shares for the long term. Asta, your view for Samvardhana Motherson, what should they be doing with this? Obviously, some of these auto ancillary names have that US exposure, the trade deal coming in as well. So now what's the story for Samvardhana?
So basically, there are some ramp up, greenfield ramp up is also there. I think that is also major focus of the company, because management has indicated that along with the strong order inflow which this company is witnessing, I think they are also scaling up well in the spaces of aerospace, etc. So my idea here is to stay invested in this counter, because we believe that this counter is well poised to move till the level of 150. So 140 to 150 are the targets which we would like to assign to this counter, and hence recommending a hold on that.
Okay, hold is a view on the fundamentals. Technical levels, Ruchit, that one should keep an eye out on for Samvardhana Motherson.
In the recent correction, the stock has managed to form a support base around its 200 EMA, which was at 108, 110. So I think the base has been formed there. And since then, a high top, high bottom structure could be seen. So downside seems to be limited from here on. On a short-term basis, 115 is a good support for the stock. So if you want to add more positions, then any dips towards 115, 116 can be used to add more positions.
Okay. Dips, the levels that you can add more position if you're looking to, is what Ruchit has mentioned as well. Next query then for today, we have this one coming in from Yamini Jain, who's writing to us from Kanpur. And she's holding 300 shares of Tata Motors PV. This is at a price of 350 rupees per share. Should she continue to hold, average, buy? What should they be doing right now? Add more is their view. And they're a long-term investor. Asta, your view?
So view on Tata Motors is positive as of now, and definitely one can add more on this counter as well. Now talking about the fundamental seems to be okay, especially if I talk about the Tata Motors PV. What we are expecting a sort of slight rise in the margins as well as going forward. And I think the balance sheet is also in a very good shape. So this is the counter which we are advising, in fact, our clients to remain invested for the price target of around 420 to 430 at the initial levels.
On the technical front, Ruchit, they bought it at 350. So what should they be doing? Average, what levels, and what are the targets for the long term here?
The good thing is that the buying price is quite low. If you look at the recent price action, the price is corrected post the demerger and then formed a support base around 335, 340. Exactly around the just below the buying price. So the risk reward ratio is very favorable to hold on the positions with a stop loss below 335. If that remains intact, then expect an up move towards 410, 415, which are the swing highs. So hold existing positions. I don't think there's much need to do more at current levels. But around 410, you can take a review again.
Okay, right now hold is the view on the technical front. Don't do anything much. Hold on to it for the long term. That's a view on the technicals. Let's move on then to the next query. We have Prakash, who's writing to us from Hyderabad. He's holding 3,000 shares of Bank of India. Price is 163 rupees. So stock is around their buy price right now. Short-term investor. So what's a short-term outlook on this one? In the short term, Bank of India, what should they be doing with this one, Astha?
Short term is also looking promising for this counter with the price target of 180 to 190, which we would like to assign to this counter. Now, talking about the fundamentals, what we have seen is their advances have registered a growth of 13%, especially if I talk about the gross advances. So, definitely a growth was there. In fact, their overseas advances have also witnessed the growth of around 6 to 7%. So, we really like that because growth in advances is always positive. Bank deposits have also shown a strong growth. And in fact, if I talk about their GNP and NNP ratio, because apart from growth, any banking counter is well looked upon if we touch their GNP and NNP ratios, and there also we have seen decline. Now, one of the major factor is that in fact they are maintaining their ROE of around 13 to 14%. So I think that is also looking attractive to me apart from ROAs. So all in all, a good bank to remain invested in with a price target of 180 to 190.
180 to 190 is what we can keep an eye out on. Ruchit, is that the level you would also suggest for the short term? It's a short term query. So 3 to 6 months or max, I think 1 year they would be looking to hold on for.
Firstly, the sectoral trend seems quite strong. We have seen a good outperformance in this recent volatility which we had seen from the PSU banking space, which is a good sign. The stock also seeing some correction last week, but managed to form a support around 145, 150 range where the 50 DEMA for the stock is placed. From a short-term perspective, yes, keep a stop loss below 146 and continue to hold on your long positions if this high top, high bottom structures continues. 176, 178 is where the technical targets would be placed.
Okay, we'll keep an eye out on those levels over there for the short term. But on that note, we're actually going to sip into a very short break. We'll come back with more of your stock-related queries after the break. Stay tuned for that. Welcome back to your stocks in CNBC TV 18. Nifty is at uncomfortably at the 25,780 levels now. So let's watch out for that. Almost again back near the day's highs point, 62 point uptick as of now. That's where we started the show with. Not much of a move there. This 25,700 around that mark is what it's trading at, and that range is what it's moving around today. But yes, moved from the red to the green at least for the day. But let's move on and keep it going with all your stock related queries with Asta Jain as well as Richard Jain today. The next query for today is come from Amit, who's writing to us from Mumbai. He's holding 500 shares of Coal India. Price is 395 rupees per share, making a profit on this one. Wants to know if he can continue to hold the stock for the next 3 months. Again, a short-term query there. Asta, your view for Coal India?
So view is positive, of course, and definitely we would recommend a hold because we are positive on this counter. So recommending a hold on this counter with a price target of around 460 to 470 as of now. Now talking about the fundamentals, past quarterly results were not that great. What we have seen that there was a volume growth which was not very much, optimistic. In fact, it has disappointed, and some of their full year guidances was also like, in line with the expectation. But I believe going ahead, definitely, when we start seeing some sort of a rise in the volume, definitely that will yield a positivity in the numbers as well. So in that hope only, we are recommending a hold on this counter with a price target of 460 to 470.
Okay, keeping an eye out on those levels there. But Ruchit, in the last 1 year, the stock has given 15% return. They bought it at 395. Making some profit. For the next 3 months, do we expect a further up move from here, or maybe it's better to get out at these levels?
In fact, if we see entire calendar year 2025, the stock traded in a very narrow range. It's just recently, the month of January, the stock gave a breakout from that 1 years of consolidation, and I think 8 to 9% returns were made in the month of Jan itself. So the trend for the stock is quite good. So one should continue to hold on the existing long positions. 410 is the immediate support. So if you're a short-term trader, you can keep a stop loss below 410 and expect targets around 480, 490, where the previous swing highs or previous all-time highs was there. So good stock to hold on at current levels.
Okay, good stock to hold on to at current levels. That's a view there on the technicals. Let's move on. And the next one is a caller query where Beju, who is calling on the phone line from Ahmedabad, he's holding 2,000 shares of PG Electropras, and this is at a price of 600 rupees per share. Beju, what is your query on this one? What would you like to know?
Should I hold or should I sell it off? Because after the results, I think the shares had gone down yesterday.
Okay. Asta, your view on this one?
We have seen that their product business has shown a very strong growth despite the challenging environment right now these companies are placed in. And I think this growth momentum is not limited to one category. Across all the 4 categories, they have shown a strong growth. So I'm very much optimistic about the numbers which they have posted. Although the stock is like, also showing some sort of a strong momentum today. But going ahead also, we believe that this stock is well poised to move till the level of 650 to 700. These are some ambitious targets I'm assigning to this counter right now, but I think it is for the longer term perspective which I'm talking. So for the longer term perspective, definitely a hold from my side. The targets have been set at around 650 to 700.
Okay, 650 to 700 is the target that for the long term that you're saying. Ruchit, would you give Beju short term as well as long term targets to keep an eye out on now?
Well, pullback move can be expected in the short term towards 630, 640. But largely, I think the trend for the stock is still range bound. Post that correction, the trend for the stock has turned sideways. It has not breached that 500 level, which is a good sign, but it needs to give a breakout above 640, 650 for any kind of trended up moves. So I think in such markets where a lot of stocks from the broader markets are showing an up move, you can expect pullback move, but too early to say whether we would see any kind of outperformance. So maybe around 630, 640 would be good levels to take a review again for the stock.
Okay, but so right now you would say hold and then maybe sell at that 630, 640 levels before selling, just have a review again.
Yes, that should be a good idea.
Okay, thanks so much for that view there. Thank you so much, Beju, for calling us as well. Hope that answered your query. Let's move on to the next one then for today. We have Avinash, who's writing to us from Chennai. He's holding 1,440 shares of Yes Bank. This is at a price of 33 rupees a share. Wants to know if he should exit at the current levels or add more or average. Asa, your view?
View is positive because what we have seen is that the numbers were better than expected, and especially what we have seen that there was a decline in the credit cost. So that is and slippages. So definitely these are some of the focus point of this bank, which we have witnessed in the quarter, that slippages as well as credit cost has seen a decline, and hence I am positive on this counter for the price target of 24. Remain invested.
Okay. Richard, your view for this one? Yes Bank, viewers bought it at 33. What should they do?
Well, a pullback move can be expected towards 23, 24 kind of range, but no, not a stock where outperformance should be expected. So overall, the trend is still sideways in the range of 20 to 24.
Okay. That's a view there of the technicals as well. Sideways move 20 to 24 is what Richard is saying. Let's move on. The next query. Vinay is writing to us from Pune, holding 1,000 shares of L&T. Price is 3,224, making a profit in this one. He wants to know the target for the next 1 to 3 years. And he also wants to invest 15 lakh rupees in semiconductors, data centers, defense, alternate energy. Asta, your view for both of them. Where should they look to invest in if they want to look at data center semiconductor opportunity as well as in terms of L&T?
So for L&T, L&T is looking positive to me. 4,200 is the price target which we are setting for this counter. Although here the horizon is long-term for our investor, but these are some medium-term targets which I'm assigning right now to this counter. Now talking about the fundamental seems to be very strong. The growth was led by all the segments, whether it is IT, whether it is infrastructure, and robust order book is which we are very much liking for this counter, and hence we are positive, keeping our price target in the short to medium term at around 4,200 level. Now talking about the other spaces where our investor wants to invest money in, I think in the semiconductor space there are stocks like Moschip Technologies, which is looking good to me. So Moschip Technologies is there. In the data center space, we still like Anant Raj as well as NetWeb Technologies. So these are few of the counters which we are positive as of now in these spaces, and there one can deploy the funds in.
Okay. Some of the names there coming in for data center, semiconductor opportunity as well. Richard, what's your view? L&T levels they should keep an eye out on in the medium to long term, as well as anything that is looking exciting on the charts and technicals in the semiconductor, data center, defense side?
So I think should continue to hold on L&T firstly. The overall trend, the mid to long term trend still remains on the positive side. Recently, the stock did correct around with the market volatility, but managed to form a support base at its 200 EMA and has resumed its uptrend. So I think 4,700 is where the technical targets are placed as per the retracements on the charts. So in the medium term, can expect levels around 4,700. As far as for new investment stocks are concerned within the semiconductor space, I think no EMS provider Sirma SGS is one stock which is technically looking good. Overall structure remains positive, a relative outperformer within the space if you look at the recent corrective phase which we are seeing. So this is one stock where you can look to take some exposure.
Okay, Sirma SGS there is coming in as well as one of the options for you. Thanks for the view there, Richard. Next query for today, we have Vishwas Kaude, who's writing to us from New Delhi. Investment query, wants to know if he should, invest in Trent right now at the current levels. Numbers coming in as well. Asta, your view.
Yes, so I think right now just wait for some more time because the quarterly updates were okay. I mean, we have seen growth in their top line in the quarterly updates, and in fact, company has opened certain new stores as well as their Zudio store as well as West Side stores. So definitely they have started showing good contribution in the numbers, but still we believe that the valuations are at high level. So the kind of growth which we want from this counter is not that good, which can justify the valuation at this point of a time. So Trent is such a stock where I think one should wait before making any fresh investments.
Okay, wait before making fresh investments. You're not finding the valuations too attractive yet. Richard, what's your view for Trent? Given last 1 year, we've seen that sharp fall in 2025 for Trent. Is it the right time, or are we expecting a bit more of a correction on the technicals as well?
So I think price-wise, we have already seen a good correction over last few months. Some positive divergence are visible on the charts where the prices have formed a lower low, but RSI has formed a higher low. Such divergences usually leads to a pullback moves. I think a pullback move could be expected. So we expect that the trend for the stock could turn from down to sideways going ahead. So maybe price-wise downside would be limited, but expect some consolidation going ahead.
Okay, that's a view there on the technical front. Next query for today, we have Hitesh who's writing to us from Mumbai, holding 100 shares of HDB Financials, 910 rupees. Should he continue to hold or sell? Asta, your view?
So HDB Financial is right now hold from our side with a price target of 700, 760. What we have seen in the numbers right now, yes, they have shown growth in their asset under management, and this growth was at around 12%. But we still want to see some more, strength in the profitability, and that can justify the valuation. So right now, we are not very much comfortable with the valuation as of now as well, and hence results seems to be okay. But on the valuation front, it is just a hold, not a buy from our side. So hold this counter.
Okay, hold is the view on the fundamentals front. But that was the last query for today, Ruchit, as well as Asta. Thank you so much for joining us on the show and helping answer all those stock-related doubts that our viewers have sent us. Viewers, you can keep sending us your queries on the phone number that will be there on the screens for you all, as well as the email ID. You can send us and we will get them answered with our experts on Monday, Wednesdays, Fridays at 2 p.m. only on Your Stocks. But with that, we're going to wind down this edition of Your Stocks today. Thank you so much for tuning in. Last set of traders still left, and you have closing bell up next for that.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC TV 18 Motilal Oswal Budget Headquarters.
The Taiwanese index is just below the flat line. The Hang Seng is also absolutely flat.
Right now, today, for industrial goods, their average tariff is about 13.5%. That's going to go to zero.
So gold is trading back above $5,000 an ounce right now. Biggest one-day gain since 2008.
The closing prices are at the lows or even lower than they were at about 10 o'clock.
The volatility is just insane.
We will start seeing some order announcements happening from the global companies to India, which had probably stopped over the course of last 1 year.
120 points, 25,600. That's 140 odd points lower.
HCL has actually been knocked out of the race to develop India's 5th generation stealth fighter jet program, which is the AMCA fighter jet program.
Clients still will want to have a high-touch model and are ready to pay more than 350 rupees or 0.35%.
Well, the Nifty is continuing to hold in the green. The Sensex is trading more or less flattish. The mid-cap index is well flattish. But the big boy is coming and taking on the IT index.
And metals offset the impact. In fact, advances far outstrip declines, keeping the positive sentiment intact.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Rima. And Rima, good to see intraday recovery on the Nifty. We're currently virtually at the high point of the day. Hopefully the IT stocks as well cut their losses. Very, very small recovery from the day's low. But that's clearly been the big drag, while the Nifty Bank has been the go-to sector because that's batting to the bulls.
Indeed, the Nifty IT index seeing its worst single-day fall since COVID March of 2020 as it falls nearly 6.5%. But despite that, the Nifty on the whole has recovered more than 200 points from the day's low, 230 points as we speak, as it nudges towards that 25,500 marks. Mid-caps are outperforming. The mid-cap index is up nearly 0.7%, with the advanced decline ratio still having more than 2,000 stocks in the green for less than 1,000 stocks in the red. And as Nigel pointed out, banks are batting for the bulls. But outside of that, you've got gains in oil and gas. Generally, if you pull up the Nifty CPSE index, that's holding up in the gain with a gain of close to about 2%. But let's tell our viewers what all we've lined up on the show on Closing Bell in the next 1 hour. And then we'll get chatting about individual stocks. Markets hold ground even as the rout deepens in the tech pack. The Nifty is holding closer to 25,800. Cautious range-bound trade across indices. Real economy stocks are doing well. Energy, utilities, consumer durables, metals offset the impact. Global IT services stocks sell off as Anthropic's new AI offering puts the core business of outsourcing firms at risk. That's the question mark everyone's asking. Indian IT stocks have crashed. The index has slumped 6.5% with bellwethers like HCLTech and Infosys, TCS under pressure. Jefferies calls it SaaS apocalypse. Hindustan Aeronautics skids following the company's exit from the race to develop India's next-gen stealth fighter jet. We'll try and understand the impact on HAL's balance sheet in just a bit. Moving on to gold, that's posted its single biggest day gain since 2008, pushing the index once again past that $5,000 mark. Rising US-Iran tensions and continuing demand for the physical metal, including from central banks, aids the rebound. Shares of Sheela Foam and Devyani International surge on the back of the Q3 numbers. Analysis coming up on the show. And later on, we'll tell you what to expect from the results of retail giant Trent.
All right. How do you position yourself in the final hour of trade? We have Rahul Sharma, Director and Head Technical and Derivatives at JM Financial Services, who joins us on the show. Hi, Rahul. Good afternoon. Good to see you, Ben. I think, Rahul, the last time we spoke, you were sounding a little bit cautious, right, on the index. You could correct me if I'm wrong. But we've seen a big recovery from there. What's your view on the index from here on? Do you believe this is just a relief rally? Or do you think sentiment has turned, so you'll be more optimistic from here on?
Yeah, very good afternoon, Nigel. Rightly recollected, yes, we were cautious the last time we had a discussion, but things have changed overnight after the yesterday's tariff news that came, trade deal news that came. Now, what essentially we are staring at is still there is a large chunk of positions by FIs which are shorts, which have started covering in yesterday's session. We saw that number improve, the long-short ratio improving. And secondly, Nifty is changing its gears slowly but surely. And now we think the time is right. Over the next 3 odd months, we may see the Nifty do very well from here. So the multi-quarter consolidation time correction, which we were into, probably is about to end in the next 2-3 months time frame. We should see the animal spirits to be back in the market, especially in the mid cap space and the small cap space as well, where the damage was significant. So broad-based recovery is what we are expecting in the market. And secondly, Nifty, as far as it is concerned, a new all-time high is very much on the cards. Sooner than later, we should see that level coming up on the screens.
Sounding far more bullish today. Good to hear, Rahul. The bulls will be happy to hear that tone. What about individual stocks? What do you have for us?
Yes, so metals are the way to go. NTPC is one stock which is seen a breakout today. Very strong volumes on the daily charts. We are seeing big targets of up to 95 and 100 rupees. One can look to buy at this level. The momentum still is favoring the metal stocks in spite of the correction that we saw a few days back. Apart from that, from the heavyweights, it is Bharti Airtel. Bharti has formed a base around the 2000 mark. We feel the stock is looking good for a target of 2100 on the upside. Can be bought at these levels. The stop loss placed at 1990. So as of now, it is metals and telecom with which we are going ahead. But I think broadly, the market is showing strength today. IT being down, and in spite of that, Nifty has managed to be a plus 75%. That goes to show the change in sentiment that has happened. That is, in a good market, even negative news is getting absorbed, and probably in a day or two, even the IT space should start consolidating and rebounding.
So technically, what is the chart of the Nifty IT telling you?
Yeah, so Nifty IT index is all over the place. We saw the IT index do very well on the budget day once the announcement was there on the tax havens for the data centers. And immediately we are seeing this sector getting a big hit in today's session, post which what happened with the AI development that has happened. But the chart is, essentially, not giving any directional sort of, a clarity. Such big distortions, they are best left on their own. Probably after a couple of weeks, the clarity should emerge. But like I said, in a good market, even the negative news gets digested and the market moves on from here. And we've seen negative news, whether even positive news as well, getting digested very soon in the market. When it was a bear market, we were seeing good news like GST and income tax rejig got adjusted very quickly. This time around, it should be the other way around, where negative news gets digested positively, and eventually the sector recovers. So wait and watch is the view on IT index, and the rest of market seems to be doing fine.
Okay, just to quickly revise the news surrounding IT. As I said, IT shares, the Nifty IT index, it's seeing its biggest single-day fall since March of 2022. That's the COVID day fall. And the reason is that Anthropic has released 11 new plugins for its Claude agentic AI. So basically, Nigel, there are LLMs and there are enterprises. And there are many companies which sit in the middle of them, including, say, a company like Fractal Analytics. What they basically do is that these middlemen, just for the sake of simplicity, they will use the intellectual prowess and the abilities of an LLM, and they will apply it to an enterprise's complex unstructured data or structured data and come up with analysis, right? They will simplify the use of many CRM tools. You want it for HR, you want to find out what the sales predictions are. They will use the LLM's tools to apply it to the enterprise data. And now the question mark is being asked on these intermediaries. Is there a risk of disintermediation? Agree that there is no case to be made for completely replacing it, right? But there is a risk that revenues get compressed, that there could be revenue deflationary, the productivity. If earlier you require 10 engineers to sit in the middle, maybe you now require 5 engineers.
Or less.
Or maybe even less, who knows, at the way in which it's progressing. I think that is the big risk people are coming down to, that what happens to the middleman, the person who is sitting between the LLM, who is the infrastructure layer provider, because those companies are getting smarter and they themselves are coming out with that middle layer, coming out with those agents who can, solve for the problem. So which is why across the board yesterday in US and Europe, you saw a sell-off. So one of Claude's updates was on legal work, where they can do compliance work, they can draft legal debriefs, they can find out risks in an NDA. and therefore many companies which provide legal software. Whether it's from Thomson Reuters, there's a company called there's RELX, Relix, there's a company, LegalSet, all of them plunged in trade. Then there were companies, SaaS companies like Salesforce, which largely provide CRM software, or a ServiceNow, which provides HR software. They plunged in trade. Your regular IT sourcing companies also were under pressure. So it's not that there's a risk to IT services companies' business model, but people are fearing that there is going to be further revenue deflation. We've already seen productivity deflation. Sentiment surrounding Indian IT companies was hit, and now it's gotten further hit. But, there is always a question mark of, was this an overreaction? And that we'll see as time plays out. But for now, there is a bit of an anthropic effect, and there is a global tech rout, and in that, Indian IT companies too are seeing red. Deven Choksi is now joining us on the show. Deven, give us your analysis and the read of the sell-off that we've seen on Indian IT companies.
Yeah, Rima, good afternoon. Well, I think probably it is justified sell-off to an extent, which has wiped off around close to $300 billion worth of market capitalization across the globe in various IT companies, given the kind of agentic AI threat that people are talking about. However, when I look at, how the Indian companies are positioning themselves, TCS, Infosys, among others, they have been systematically, adapting to agentic AI workforce in their environment to begin with. At the same time, they are converting the existing databases into a structured database, wherein probably they can access, through the agent, the solution that the companies would be requiring for the client. In fact, on the billing side also, from a pure coding kind of an outcome, they are basically moving with solution kind of an outcome. So as against software as a service in earlier days, where the services have been provided in some of the cases, now it is basically agent as a service, is being created by these kind of companies. So maybe markets have reacted a little bit in hurry as I see it, but most of the Indian companies are working in that direction with their clients. Quite possible that they may have the better ways of charging to the customer as against the time value on which they were charging to their customers. But I guess that is not taking over the larger prospect ahead. The world is requiring significantly large amount of automation to augmentation as far as their business environment is concerned. And that augmentation process is going to be really requiring some of the larger companies' role being very meaningfully played. And I guess our companies are already in that direction. So not too sure, whether one would like to sell out these kind of companies. Maybe in the current fall, they become attractive enough and go below 20 times price earning ratio in some of the cases, could become a buy opportunity in fact.
Okay, the current fall may be an attractive opportunity. Price valuation multiples have corrected. And plus, these are companies with a dividend yield of 4 to 5%. In fact, since morning, we've been debating with our experts on whether the sell-off is warranted or is it overdone. We had a chat with Arvind Sanger of Geosphere Capital Management and Moshe Khatri on this issue. Listen in.
So this is not about current earnings. This is about concern about future growth, future value. And so finally, I think people have now started worrying about different segments, and IT services, the latest ones to get this concern, because the SaaS companies are going to see, disintermediation by AI and by AI agents and by AI software. Then at some point, people are realizing that, even the software services companies are going to suffer in this same issue of can agents do the work and how much will be the value of IT services companies in that new, if that's the new world we're moving on into. And again, this may not be a one-year call, but this is a 2, 3, 4 year. There's real headwinds emerging that could be very meaningful.
Ultimately, the proof's going to be in the numbers. I just want to, factually, if you look at most companies reporting in the past few weeks, they've done better than expected. Guidance looked better than expected. So I don't know. I think we've been talking about for 2 years, the disruption has been going on. If we actually get to a better trajectory in terms of revenue growth for the space, I think that'll be, and we should be in an okay shape. The volatility is just insane. And I don't know if that necessarily reflects fundamentals at this point. That's my point of view here.
All right, let's move on from the tech pack. The other stock that's getting knocked is HAL because the street believes there's an opportunity that's been missed, though their order book is still looking rock solid at close to around 2 lakh crore. Ria joins in to break it down for us. Ria?
Well, yes, HAL has been knocked out of the bidding race for India's 5th generation stealth fighter jet program, or the AMCA jet program. And HAL was expected to be the front runner for this project up until now, which is why the street is reacting so negatively to this new development. And the company had bid for the program with 2 other smaller firms. And this will also be the first time that HAL will not be participating in one of the country's most significant military projects. Now, the other bidders for this project include Tata Advanced Systems, Adani Defence, as well as MTAR Tech, Bharat Forge in partnership with BEML and Data Patterns, and L&T along with Bharat Electronics, among some other companies. And as per reports, 3 of these companies have been shortlisted, and the final project winner is expected to be disclosed within the next 3 months. Now, as far as the details for the AMCA project go, there's a value of 15,000 crores that has been assigned for the prototype development phase of the project, and the total project is valued at roughly 1.5 to 2 lakh crores. So this will be a very significant project. And in terms of the impact on HAL, analysts believe that this will be sentimentally negative for the company, but they don't see any material impact on the financials of the company. Remember, the closing order book for FY25 for the company was roughly 1.9 lakh crore rupees, and they are also expected to close this financial year FY26 with an order book of roughly 2.5 to 2.6 lakh crore rupees. So they also already have a very significant healthy order book that will provide them revenue visibility for the next few years. But nonetheless, the stock is taking a big hit in today's session, down roughly 6%.
Okay, all right. Thanks a lot for that, Ria. Deven still with us. Deven, what do you think? Is it a buying opportunity, this downtick that we're seeing on HAL? Or do you think the valuations are not very, very cheap? And now there is some intense competition coming in from the private names. What's your view?
Yeah, Nigel, I think they already have visibility of about 8 times their current sales book, I think, in the order book position right now. So frankly, I think from a perspective of seeing the growth in the company's business, one should not be doubting it. If this particular project has not come their way, I think because of the disqualification criteria which they have faced, which sounds like a little bit awkward, but at the same time, I think that's what I think the government wants to ensure, that no one company gets maximum business. Possibly one of the reasons for which they are disqualified for this particular project. I think that puts them behind anywhere. On the contrary, I think the company remains, I think, really in a stronger bracket. Coming to valuation, I think if my numbers go right, I think 1 year forward, somewhere around current price, I think somewhere around 28, 29 times price earning ratio. Not expensive, given the kind of visibility that the stock company is offering. So, frankly, the stock price fall could be, I think, a buy opportunity in a given situation.
By the way, look at Emami. The stock is zooming 6.5% on Emami. The net profit is up 14.5%. We'll wait for the top line. But I remember Q2 particularly was a very weak quarter for the company. When the domestic volumes had declined, they were impacted on account of heavy monsoon and the GST transition. So Q2, I remember domestic volumes were down 16-17%, but the bottom line is up 14.5%, even after taking into account the wage hike impact. Revenue growth has come in at 9.7% at 1,157 crore, and it's a sharp increase compared to 9.5% on a year-on-year basis, and compared to the prior quarter, which was 800 crore, we've seen a sharp jump in the company's revenues. EBITDA margins at 33.4%. Maintained on a year-on-year basis compared to Q2 when it had dropped to 22.4%. There is a sharp increase. So the street likes it.
Yeah, absolutely. The street likes the numbers coming in from Emami. Mangalam is here. He's going to tell us about Trent. But Mangalam, you want to just come in quickly with regard to Emami, just throw some color. If I remember correctly, the stock used to be 800 rupees 2 years ago. So valuations turned relatively cheaper since the stock was down 35%. But volume growth of around 9%. Would you be a little bit impressed with these numbers?
Well, these are good numbers, given the circumstances. Why do I say that? One, because Emami, nearly 60% of their revenues comes in from winter products. And this time around, we did have an extended winter, delayed, a strong winter as well. So a large part of their, I'm sure, skin moisturizing Boro Plus sort of range has been doing well. The company's been working a little on their men's grooming portfolio as well. For a fairly long time, their fair and handsome sort of products did not do too extremely well. So a reset out there has led to growth there too. And add to all of this, the correction in the stock from its peak, even as we speak right now, this year's 52-week high has been 655 rupees. Going into the numbers, the stock was close to around 450 rupees. So all these factors made it an attractive bet, and good numbers, non-disappointing numbers, near double-digit revenue growth, near double-digit volume growth, with net profit growth of 14%, taking into account that 10 crore exceptional is something that the street likes, and perhaps which is why, given the sort of valuations at which other FMCG companies, which are reporting mid-single-digit sort of revenue growth, are trading at, the street is seeing some signs of a re-rating for Emami, and that's something that's played out for the last few quarters. But this time around, the numbers really are hitting home, and the street is respecting that.
Okay, Mangalam, thanks a lot for that. What about Trent? What do we expect from there? We have a cheat sheet, I think, over there as well.
Yes, Trent, we do have a cheat sheet. What's interesting is that Trent, post its third quarter update that came by, the stock actually saw a big decline. And coming into the numbers, the stock's actually being fairly well bid. It's just the mood of the market right now. From its 52-week high, the stock is down 40%, trading at around 69 times, not particularly cheap. We know the growth rates. Standalone revenue for the company has grown at around 17%. They've opened 17 West Side stores, 48 Zudio stores during the quarter as well. And the revenue growth itself has been trending down from 19% to 17% over the last couple of quarters. But the street believes that this time around, maybe on the margin, there could be a bit of a surprise. A CNBC TV18 poll says consolidated EBITDA growth at 19%. This at a time when the revenue is growing around 17%, which implies that there could be margin expansion. Net profit up 9%. There could be an impact of higher depreciation on account of the number of stores that they've added. Net profit will be lower because of higher depreciation. All eyes will be on management commentary around demand and revenue growth. The stock has taken a big nosedive from the peak. Any positive surprise and any indication from the management on revenue growth picking up from here could bring back believers of Trent, which actually are sitting on a fair amount of losses all of 2025 and the start of 2026 as well.
Well put, Mangalam. When you're not expecting much, and if there is a glimmer of hope, the street may latch onto a stock that was around 8,000 rupees, currently available at around 4,000. Wait for your analysis, Mangalam. In the next hour or maybe later in this evening, it'll keep you busy, among other things. Thanks a lot for joining in. So Trent is buzzing post, ahead of its numbers. Expectations are low out there. Emami, the stock spikes up because those numbers look good. The stock has corrected close to 30% from the recent peak. So risk reward appear to be favorable and those numbers are good. And TeamLease, there's a good growth on the absolute EBITDA number of around 21%, I think, is the growth out there. The net profit number has grown even more. But there is a marginal improvement in the margins. And just take a look at that. It tells you, Rima, a little bit about the market mood right now, right? I mean, barring the tech space that is worried about the global issue, any kind of good news is being digested quite well. A couple of weeks ago, when you're getting good news as well, a lot of companies are not reacting to the good news. So, that's the phase of the market we've just entered, it seems. Sentiment has turned a little bit. Devin, sorry to keep you waiting for so long. Emami, Trent or TeamLease, any view on any of these three companies? Two of them have delivered numbers, Emami as well as TeamLease. And Trent, we're waiting by, but expectations are relatively lower.
Yeah, Nigel, I think Emami, good set of numbers. Comparatively, compared to the peers, I think they're available at a lower valuation. And with a higher declaration of dividend, I think it puts, more amount of confidence into the business of the company. I gather that Zandu portfolio possibly has done well for them in this quarter and has also contributed to the better margins for the company. But we'll have to wait and see the breakup for that. The Trent in particular, I believe that their expansion continues, including going into the UAE market. And that could give them slightly better edge, particularly on the margin front eventually. But all said and done, everything is still in the price. Though I understand that the stock price has corrected significantly. But till at this point of time, I guess the valuations are not at all comfortable to me. Company growing in a reasonable growth phase right now and then sustaining at the same time. But the valuations are far too exceeding the kind of a growth rate assumption that the market is putting across. So in my viewpoint, we'll have to wait for, some time correction to happen along with the price correction has already happened. Maybe some time correction will be justified if or not to add further into Trent.
It's been a 30-40% up move in many of the tariff-ridden sectors which have found relief, whether it's textiles, shrimp. Look at Gokuldas exports, another 20% up on that. What's the strategy here?
Well, I think the immediate reaction has to be positive, undoubtedly. Maybe I think the backlogs, which they haven't been able to execute due to the tariff-related issues, particularly in case of textiles. I think they should be in a position to clear those backlogs in a little quick succession, possibly. And that could possibly give you another 1-2 quarters of, a very high growth rate, which is also equally, a good thing if one wants to look at the numbers 1-2 quarter ahead from here. But most of the things do get reflected into the price demand, and that is where probably one need to be careful. Whether you want to ride this particular momentum at this point of time, or you would really want, the market to stabilize at a reasonable level. Maybe I would go for the second. The reasonable level stability in the performance of the company is something which one would like to expect before putting a buy recommendation on the business due to the prospects which are emerging now.
Okay, all right. Thanks a lot, Deven, for joining in and giving us that view on all of those stocks. Wishing you a good remainder of the day, Deven.
Thank you so much, Nigel.
Well, keep an eye out on a few stocks. Actually, Carousel was another set of numbers that we got earlier today, and that stock as well has spiked up. Remember, this is following up yesterday's 20% move with another 5% move. They have a high amount of exposure both to the Europe as well as to the US market. Explains why that stock has moved up. And Rain Industries, I recall we here at CNBC TV roughly a month or 25 days or so ago, we were telling you that the aluminium party is going on. Rain Industries makes CPC, that's an input cost for aluminium companies. And since aluminium has got into a bull run, it seems this is one of those proxy plays. But keep in mind, the stock is moving up, but they have a very high debt in the books. So debt reduction and refinancing is going to be key to track from here on. But otherwise, that's a bit of a proxy play. If I got the number correct, I think 42% of their revenues come from the aluminium business. So that's why that stock as well is moving up. And various aluminium makers have been talking about CPC prices moving up, which is an input for them. And Rain Industries is a producer of CPC. So it could be one of the reasons the stock is moving up. But we'll slip into a short break. On the other side, Dinshaw Irani of Helios Mutual Fund is waiting for us. Stay tuned.
Fly Emirates, fly better.
Markets are holding up. I think the breadth of the market is particularly encouraging because the number of stocks that are moved up actually are close to around 2,100 stocks odd. By the way, another order win, Capacite Infra. It's that time of the market now where some of these order wins, some of the good news will be digested. So that's why the stock is up close to around 8.5%. As I said earlier, a couple of weeks ago, some of these bombed out names, they wouldn't be reacting to this news. But for the time being, Capacite up close to around 8%. Let's tell you what's going on in the F&O market. The Nifty Bank, as well as the Reliance Industry stock, both of them have come in there and they're batting for the bulls. And this was the call that I made earlier this morning as well, that the IT index is going to drag. So you require the big boys to come in there. They need to put their hand up and they need to do the heavy lifting. That's precisely what's happened today, because both those two, you put the Nifty Bank as well as Reliance Industries together. That's close to around 41-42% of the index. And you have IT index, which IT is around 11% of the Nifty. That's down by close to around 5%. So that's how it's offsetting each other. Well, the Nifty options data as well is quite interesting because the PCR that was at around 0.6, 0.62, 0.7 as well, it's moved to around 1.1. Still, it's very far away from the, overshot level, which is at around 1.6. So that's par for the course. The 25,700 put, that's seeing aggressive writing. And the premium at the start of today was around 162 rupees. That's come down to around 110 rupees. So the writers are back in the game. 25,800 put as well. Premium at the start of today was 211 rupees. That's come down to around 150 rupees. So put writings back and the bulls will be feeling quite good looking at the screen. Now the important support levels, that's where the 20 as well as the 200 DMA is at. 25,250, 25,500. If you go by the options data, if you go by the technical levels as well, 20 and 200 DMA, that's where precisely it comes in at that. So you don't want that to break on the downside. On the upside, yesterday's high, that's 26,300, becomes a bit of a resistance mark. Individual stocks, tech is getting slammed, and Infosys actually all through the trading sessions there not been any recovery. There is fresh shorting being seen out there, but the stock is at the low point of the day and open interest has swelled up. PG Electroplast, one of the stocks that fell off the cliff, but we had the management who reiterated that their guidance of around 300 crores in PAT will be met. For the time being, the shorts, they're scampering for cover because that stock has popped up, as is the case with KEI Industries. The stock has seen a sharp correction, but there's a short covering bounce that's playing out even on that particular name. And since we're seeing crude oil prices perk up a little bit, that explains why Oil India and ONGC are seeing fresh buying. Net, it's a good trading session till the lower levels of around 25,250 odd will get protected. Well, the bulls will feel they're very much in the game after after quite a few months of underperformance. That said, let's get back to getting market opinions. We have Dinshaw Irani, CEO, Helios Mutual Fund, who joins in. Hi, Dinshaw. Good to see you in. I was wondering whether you've changed something new with regard to the spectacles. No, it's the old one, as fashionable as ever. Good to see. Dinshaw, how are you feeling about the markets? How the sentiment has turned in a matter of around 72 hours. HTT hike, everyone was disappointed. It hurt sentiment more than anything. And suddenly you have the trade deal. Suddenly you have talk about being oversold. Earnings need to pick up. As the famous Hindi dialogue said, entertainment. I think for now it is earnings need to show up. That's what's going to lead the markets higher. How are you feeling about the market now?
First of all, thank you, Nigel, for having me on your show, and a very good afternoon to you and your viewers. I thought we'll start off with our favorite call on IT sell rather than on the markets as such. Probably we'll take that up later. But the fact is that we were...
Dinshaw, let's talk about the markets later. The sell call now, do you stick by that? Do you think the fears are over-exaggerated? Is it providing some kind of a buying opportunity with the index down 7% and you have market capitalization erosion of around 11 lakh? Let's take that first.
Okay. So, Nigel, actually, you heard from Anthropic and Palantir last night, but you heard from us probably a year back, specifically February of 25 is when we called out that AI is going to be a big disruptor for IT, and we had seen early signs at that point in time. And we still don't believe there's been a reset in that segment because I don't think the companies are right now even gearing up for that as such. TCS to an extent has seen the writing on the wall, and that's why they've been very cautious in terms of adding manpower. In fact, they've been laying off people quite regularly. But I believe that that pyramid on which this whole structure was built, the employee pyramid, that has come under question with AI playing its part. The bottom of the pyramid, which is to control the costs for all these IT companies, the manpower costs for all these companies, all the IT companies, is going to come under question. That bottom is going to get squeezed. I mean, the bottom of the pyramid is going to get squeezed. And as a result, the cost is going to escalate upwards. And that is why that massive reset. And plus, AI is going to play havoc with the initial, I mean, the historic way that we've been doing business in India is basically the man hours into the rate per hour. The man and the hours are going to shrink because of AI. And obviously, I don't know how much rate can compensate for that shrinkage. So I think there's a reset which is happening, and we'll look at it. I don't think this it's done and dusted in IT as such. I think there's more to go in terms of not only the price correction, but in terms of even the fundamentals going off a bit.
Okay, so complete avoid IT sector for now at least. There is more revenue deflation, which is likely to take place. Valuations could get compressed. Then sure, hi. What about PB Fintech? It's a stock that you've liked. Is it still a part of your portfolio? Because the street seems to be spooked by this fundraise, considering they had so much cash in the books and they're going out there and making a large acquisition.
Yeah, so it remains a part of the portfolio, but frankly, Rima, we've also been very cautious in that space, in that particular stock. We're not adding to that name in a rush. I think some kind of understanding has to come there, as in not only in terms of what the management is thinking, because they're also looking at going outside India. They want to become an MNC. I think these all things are, with India giving you such a huge growth option. I don't know why that looking at outside markets for growth. So maybe we'll have to do a rethink out there and see what it goes. But anyway, we're not adding to that position as of now.
Are you considering selling your holding?
No. And even if I was not going to tell you that. But no, as of now, no.
Did you chat with the management and raise the concerns? I mean, I'm sure it's been flagged off by many people in the market. They can see it in the stock price. But have you had any conversation with PB Fintech?
I'm sure my analysts would have had conversations with them. I haven't directly had a chat with them.
Okay, all right. Then, sure, anything else? Since we've got the US trade deal done, chemicals, textiles, those stocks are flaring up. You think it's time to look at it?
So fortunately for us, we had Gokuldas Exports with us, which is a part of our holding. It's a disclosed holding, so I can share that name. And obviously, we had KPR Mills. These were the two stocks in textiles that we held, and that has done phenomenally well. But one more thing out here, Nigel, is that despite the tariffs, if you had seen Gokuldas results, which came last week, they did fairly well in terms of margins. We were of the opinion that the margins will shrink quite drastically, but they did very well. And what argument the management gave on the call was that even the US buyers are right now having a paucity of suppliers. So they are looking at India in a very benign way. And as a result, we have to let go of some margins. But can you imagine with now tariffs coming down 15 to 18 for textiles, this is going to be a big boost for all the profitability. In fact, the margins will come back. And I'm sure there's at least FY27 will look a very exciting month, not only for textile companies, but other plays also like auto ancillaries, which saw a lot of compression last year as such. So that way.
So in the earnings season so far, Dinshaw, what is it that you've liked where you are seeing a big potential basis the numbers, the strategy, the commentary that you've added on recently to your portfolio?
So actually, we've basically the quarterly numbers didn't, we haven't changed our portfolio based on the quarterly numbers because we take a slightly longer term view as such. But what we did have noticed in this quarter specifically, and this is a replica of what happened in the September quarter also, that the small cap universe has done far better than the mid cap and the large cap. So basically, small cap has done better than mid caps, and mid caps, I'm talking about earnings growth, has done better than large caps. So if you look at the NSE 500, some 250 odd stocks declared the numbers till the end of Jan, and of which I think the large caps were some 54, 55 odd stocks. The growth there was just 2%. For that, and effectively for the small cap, which was around 120 stocks, which had declared the numbers, the growth rate was north of 40%. So obviously, this is where the excitement lies for us today. And mid caps are around 19 odd % growth. I think some 70 odd stocks has declared the numbers out there. So that way, I think this is what is making us look at the small cap and the mid cap universe more appreciably now.
So you're quite constructive on the markets, it seems, at this juncture. Would that be fair?
Yes, definitely, Nigel. In fact, the worst seems to be over. One saw that in the last year. and with the kind of fiscal loosening that the government has been undertaking and the RBI also on their part has been undertaking, I think that has helped demand come back in a big way. One saw it in the September quarter. One is seeing that effectively even in the December quarter. And I have no doubt, hearing the commentary of various managements after the results, that this particular quarter, the March quarter, also looks fairly exciting. So I think the worst is over. From here on, you'll see growth, tariff coming back to normalized levels. I think there's no way FIs won't come back to India.
Let's party soon. Thanks a lot for joining in, Dinsha, and giving us that comment. And good to end a conversation on an optimistic note. See you soon.
Thank you.
Let's hop across to Hormuz. He joins us to tell us all the big movers at this hour. Hormuz, take it away.
Well, if you try to look for a gainer on the IT space, you would find an error 404 on this as of now, because that's the kind of fall that you have seen in a lot of these companies, be it Infosys, TCS, Persistent, Coforge, all of them. For TCS, it's the biggest drop since March of 2020. And since for others as well, it's a multi-year drop for a lot of these companies. Now, if you take a look at the market cap lost as well, Infosys at the lowest point of the day lost close to 60,000 crore, TCS lost close to 80,000 crore, HCLTech, Wipro, Tech Mahindra, all of those are almost $1.5 lakh, even more than that, 1.5 lakh crore and more wiped out in a lot of these IT companies. Now, the recovery from the April lows was pretty evident from these names. Most of these stocks made a low on the 7th of April when Donald Trump announced a tariff pause first up, and then they have recovered anywhere between 10% to 30% on the large cap space. Persistent and Coforge, of course, they have been outperformers, so they recovered a lot more compared to their large cap peers. Now, what have the mutual funds done in this period between March and December? They've continued to hold on, or more than increase their stake in a lot of these companies, be it Infosys, be it TCS. They're of course closely held companies as well, but look at Persistent and look at Coforge. Mutual funds have increased their stake during this 9-month period. Same is the story for the retail investors as well. They too have mostly increased their stake, barring of course Persistent Systems, which has seen a slight trimming, and HCLTech, which has seen a slight trimming, and Infosys too. But most of the others, the shareholding has either remained stable or it has increased compared to where it was in March of last year. But the story doesn't end, because despite this fall and the recovery that you had seen before today's accident, most of these stocks are still well below their peak, which was either made in December of last year or in January of this year. Most of these names down anywhere between 10% to as much as 35% for stocks like TCS.
When numbers can paint a picture. Thank you very much, Hormuz, for that. Get into a break. On the other side, we'll get you a check what dealing rooms are saying in D Street Chatter. Stay tuned.
Welcome back. Markets holding in the green. Good time to go across to Nimesh and D Street Chatter. Nimesh, now thumping has started?
Not really.
Not really.
You know,
They're happier at least.
I'll tell you other way around. You know, Nigel, there is still a lot of disbelief in this market because still I'm getting a lot of feedback and a lot of queries that is this a good deal? Are there any devils in the details and also clearly the position is so light and the markets have rallied in the last 2-3 days that everybody's missed out. So there is still a bit of skepticism, and that's why people are still looking for negative news, or for that matter, not able to participate because it came as a bit of a surprise for many, and they've lost out. So that's the feedback. From a today's market perspective, I don't think it's a bad outcome, Nigel, given the fact that the Nifty index, the IT index is down 6%. That's dragging the Nifty by almost 150 points, and still the Nifty up 60 odd points. So clearly there is momentum after the US-India trade deal, and that momentum is continuing in today's market as well. The good part is now we are seeing a bit of momentum in the broader markets as well. The small cap index is up nearly 1.8%. There is a lot of momentum in the broader market names, and looks like that catch-up rally is only going to continue in the very near term. We've seen a bit of Nifty rally of 1,000 points. Now it's spilling out to the broader markets as well. In today's flows, well, it's mixed, but I understand there is a bit of buying back in the select PSU names as well. So the PSUs are firing, the mid-cap index is done, small cap index is buzzing as well in today's market. So clearly the momentum is back, but I'll still say that there is lack of interest and participation from retail and HN investors. Clearly that's showing up from the interaction that I'm having. Again, technically the next level to watch would be another 400 points on the Nifty to watch out for. But it looks like the Nifty move is done. I guess now the big momentum might happen, but at least from the very near term in broader market names, both in the mid cap as well as in the small cap.
Indeed, Nimesh, maybe you got oversold on the downside. Some glimmer of positive news, and positioning was rather light as well. So let's hope that we can continue this good run. But widening of the market, I agree. Broadening of the market is going to be important. Individual stocks, though, what are you picking up?
So a couple of names in the broader markets. The first stock is Kryzac. That stock is under pressure today. It's been consolidating in a narrow range, but under pressure today because there is anticipation and indication of a large block deal coming very soon. One of the promoter entity could be a potential seller, and I understand some domestic mutual funds are likely to bid in that block. So watch out for a large block in Kryzac very soon. That's the first name. The second stock is Mahindra and Mahindra. That's been buzzing in trade today on very strong volumes. Remember, the company announced a very large export order, and also I understand one long-only fund has been aggressively buying in M&M in today's market. So watch out for M&M in terms of delivery data. The third name is HCLTech. It's part of my list today simply because, well, the entire IT pack is under pressure. I understand there is a small MOC buying in HCLTech. Among all the IT names, this is the only stock where there is a small MOC buying. So watch out for HCLTech there. And the last one is BLS International. Again, part of the broader market momentum back. BLS International is buzzing in trade today. It's up 12%, large volumes as well. The results are on 6th, but I understand along with the results, there could be potential corporate development as well. The street is anticipating maybe there could be a buyback announcement. So that's the reason why BLS International is buzzing in trade today.
Thanks a lot for that, Nimesh. Interesting times, with regard to the markets, and plenty of news flow as well. But let's focus on the money markets. The rupee did not follow through on the 1% move that we saw yesterday. It's remaining range bound at around 90 to 90.5 paise or thereabouts. Lata joins in to help us out with a quick analysis on what's going on. Lata, what are you picking up?
Yes, it's a tight range that we have seen, the dollar moving between 90.25 rupees to dollar and 90.5. That limited range. The pressure on the rupee came actually from a lot of dollars which PSU banks bought early morning. So the guess is this is probably for some government payment. It could be defense payments or interest payments which the government is making. But the bigger sentiment negative was this Anthropic news. After all, a large chunk of India's exports comes from services exports, IT services exports. And if that will be under a cloud, that tended to be a bit of a negative for the rupee bulls. The important part is that people are not very impressed in the rupee market about this 4,236 crores of rupees, is it, of FPI buying that we heard on Tuesday. That was the final number. The custodial banks tell us that they don't see that kind of excitement among their clients. This could be just short covering or hedge funds buying. The real FPI buying is not the buzz they got. On the positive side, they said there is no role that Reserve Bank played. Reserve Bank did not buy or sell dollars. So the anxiety of the market that if the rupee appreciated too much, the Reserve Bank may come and buy dollars. That kind of a sentiment also was not there. But clearly, the huge recovery that we saw in the rupee on Monday and Tuesday, that spirit is not there on Wednesday.
Thank you very much for that, Lata. Rahul Sharma is back with us for a few BTST calls. Rahul?
Yeah, so one stock that I'm liking on the banking space is Axis Bank. The stock has corrected to its support area of 1335, 1340. One can look to buy at these levels. The stock placed at 1310, and we are anticipating a target of 1380, 1390 in the by tomorrow, maybe day after tomorrow. Another stock which is closing very strongly is NMDC. Very strong volumes on the cash and derivative segment, closing above the resistance area of 85. We feel that the stock can move up to 87, 87.5 in a day's time frame, and one can look to buy for the BTST with a stop placed at 84.90.
Got it. Okay, all right. Thanks a lot for that, Rahul. We look forward to chatting up with you soon. For the time being, slip into a short break. Mayuresh Joshi is waiting for us to help us out with some stock talk.
Welcome back. We were almost at the 25,800 mark, so retraced a bit in the last 45 minutes. So now down to levels of 25,750, but still managing a close in the green with the mid-caps outperforming. Eternal is a stock to watch ahead of its numbers, going strong with a gain of nearly 5%. Mayuresh Joshi is now joining in from MarketSmith India. Trent is the one I was referring to because its numbers are expected. Mayuresh, the street has been disappointed with Trent's numbers for a while now as valuations keep getting derated as we get set to a new normalized growth rate aligned with its size. What is your view on Trent now and expectations?
I think, afternoon, Rima, I think the expectation largely is going to be a mixed bag as far as Trent is concerned, looking at what their update has probably come out. But anything which surprises the street, I think the street and the mood and the sentiment that the market is now in I think it will be taken positively with both hands. And therefore, any positive surprise on same sales store growth in terms of commentary related to Zudio, in terms of store expansions, in terms of the product mix, I think that is going to do the trick. So I think any number which is probably a tad bit better than street estimates is something that is going to probably ensure that the stock reacts very, very positively. From a MSI standpoint, I think the rating ranking seems to be on a neutral ground, and therefore I think we'll wait for numbers to probably come through and then probably take a call.
Okay, all right. Mayuresh, I want to ask you about two metal companies, but let me just run you through the news first. Lloyds Metal, the stock is buzzing in trade. The quarter 3 numbers were very, very good. Margins at around 35%, and the EBITDA number came in at around 1,800 crores. Keep in mind, 1,800 crores is more than what they were doing on an annual basis just two years ago. And if you compare it to the FY25 EBITDA number as well, 1,800 crores is nearly around 90%. So clearly, those numbers are very, very good. The guidance has been very, very hefty, with regard to the iron ore sales volumes, whether it's the pellet sales volumes, and even DRI. Keep in mind, in FY27, they'll actually become a steel player. So there'll be maybe 150 to around 200,000 tons of steel that they'll be selling. We spoke to the management earlier today, and I quizzed them whether or not, they can do around 7,500 crores of EBITDA. On only their iron ore as well as their pellets business. And they said that, maybe the numbers are not very, very off. Triveni Earth Movers, the management said, Mr. Gupta said that the EBITDA can move towards 2,800 to around 3,000 crores, while the copper business can generate 500 to around 700 crores. So now the market capitalization of Lloyds Metal is more than 65,000 crores with an EBITDA ballpark 4 to 5,000 crores. However, going by this guidance that they've given, it appears that the EBITDA number can actually be 10 to around 11,000 crores. Which then makes the stock available at around 6 times or thereabouts. So explains why Lloyds Metals, after correcting close on 20% from the top, that one popped up in trade. NMDC, well, Nuvama, they came out with the no. They maintain a hold rating, by the way, but they've increased their target price around 85 rupees from around 79 rupees earlier. Their view is basically that they are forecasting the iron ore prices to move up by around 400 to around 500 rupees in this month itself because steel pricing has moved up. And they're saying that because of the iron ore price hikes that are likely, that's what's going to drive the EBITDA number for quarter 4, and it's going to look quite good. So because you're bracing for a good push in terms of prices as well as volumes, they're raising their EBITDA estimates by around 5 to around 10% for the next couple of years. Even the volume estimates, actually, they're going in higher. So on the back of that, after seeing a bit of a correction yesterday, that stock is well up close to around 5%. Mayuresh, you like either of the two? Actually, I think in the past you've spoken about Welspun Corp as well. So any of these names, Lloyds Metal, NMDC, or Welspun Corp?
Afternoon, Nigel. So I think the stellar show from Lloyds Metals continues. And as you rightly pointed out, I think the expectations in terms of an FY27 number as far as Lloyds Metals is concerned, I think probably looks far stellar. Iron ore production expected in the 25 to 26 million ton range. The pellet production with the tie-up that they're probably expecting to do with Tata Steel as well, between 6 to 8 million tons. The DRI production line is up. The slurry pipeline is probably aiding a large part of the sponge iron volume sales as well. And steel production should probably edge around that 0.15 to 0.20 mark. Therefore, I think looking at numbers and how margins have probably played out, with more synergies coming through, and the addition of the copper business, I think the acquisition that they've probably done with a 12,000 TPA at this juncture, expanding that to 30,000 TPA over the next few quarters, iron ore volumes expected to inch higher. The EBITDA that has been reported for 9 months for iron ore volumes or iron ore in general has been stellar. The pellet EBITDA per ton has been reasonably good as well. So to that extent, I think stellar set of numbers from Lloyds Metals. The momentum can very well continue. As far as NMDC is concerned, I think the downstream business is something to be watched out for. And therefore, I think expectations in terms of ferrous players as a pack, in our opinion at Market Smith, as a sectoral perspective, I think the rating rankings look pretty robust as we speak. So I think base metals, huge rally done. I think the second leg of the rally will probably move to the ferrous counters. And therefore, on the downstream part of the business, as far as NMDC and the steel operations are concerned, I think that can continue doing well. Because in our opinion, I think ferrous players, with the safeguard duties that have come through, both revenue growth as well expectations in terms of utilization levels going higher, might mean better operating leverage and better reported EBITDA per ton. So yeah, watch out for both these stocks, NMDC and Lloyds.
Thanks a lot, Mayuresh, for joining in and giving us that quick view. We run out of time on this edition of Closing Bell, so we'll just need to wrap down the markets actually. What lost out today? the tech names, market capitalization erosion of more than 10 lakh crore, Infosys, TCS, HCLTech, all the top losers, actually the top 5 losers on the Nifty were all from the tech space. Then what bailed out the bulls? Well, you had Trent and Eternal, both of them have corrected a goodish bit from the top. They came in there, they tried to do some kind of fight back, but the real heavy lifters had to be Reliance Industries, that was up more than 1%, and it's closer on 9% weightage on the index. So that did well. And the Nifty Bank ended with a gain of more than 120 points. Remember, the last tick is going to be lower, but on an average, I think it goes home with a gain of closer on 200 points. So the broader markets, plenty of stocks doing a jig of their own. Textile stocks, they wanted to participate on the upside. So after yesterday's 20% move, Gokuldas followed it up with another 20% move. Indocount as well participated on the upside, and Kitex Garments, that stock as well was up and about in trade. From the other names that did well, some metal stocks did well. Lloyd Metals, numbers look good. Management is confident and optimistic about the future. The street bought into it after the recent correction that we have seen. Rain Industries, a proxy play on aluminium players, so that stock as well was up. It's got a cement plant in South India as well, so street a little bit optimistic. The debt concerns continue, but let's see what happens on that front. Besides that, Exide, Nomura positive on the stock, the street likes it. That stock, in fact, was flying away, and Ola returned back to its winning ways after the kind of, correction that we've seen on that name. Bharat Coking Coal, on the first day of listing, the stock was a 45 rupee stock. After the poor results that we saw yesterday, the stock is down closer around 3% in trade today. And Welspun Living, actually, that was one of the notable losers that cooled off after the big run that we saw in yesterday's trading session. Net, we go home with a gain of closer around 50 points on the Nifty, and the bulls will take it. The big point really is the number that's up for you on the screen. The number of stocks advancing, outweighing the number of stocks declining, and that by a significant margin. Well, we'll wrap up on this edition of Closing Bell. You stay tuned. Markets Forward comes up next.
Wall Street gains for the third straight session. The Nifty ends above 25,750. Broader markets outperform. IT stocks take it on the chin.
AI disruption fears rattle tech and IT stocks worldwide. Anthropic releases a new plugin to automate specialized tasks and workflows for companies. The Nifty IT index plunges more than 6% to mark the worst fall in 6 years.
Hindustan Aeronautics falls nearly 6% after reports indicate that it is out of race for AMCA's fighter jet program, which was expected to be the front runner with two other smaller firms. Analysts don't expect any material impact on its financials.
Fractal Analytics is eyeing a scaled-back valuation of nearly 15,000 crore rupees for its IPO. This comes after it trimmed the IPO size by more than 40% as initial expectations of a rush for India's first AI company offer tempered.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the key data points to gear up for the trading next day while recapping trade today. I'm Mangalam Malu, with me, Ritu Singh. Ritu, it was a very good day of trade from a bull standpoint. After a big move that we saw yesterday, and then there was the overnight fear on, the IT sell-off. This morning we saw the IT index close, or rather open lower, fall further lower, and despite that, the Nifty actually ended about 50 points higher. So give or take everything, we've done a lot better than what the street was preparing itself for. We actually gained about 200 points from the lows, and that was led by Reliance. We saw the Nifty Bank outperform, and at the same time, towards the end, the IT index as well, which at one point was down by about 7.5–8%, recovered about 1.5% from the lows. So did not pressurize the market so much. Yes, that line is big shade of red, but it wasn't 8%. It was down just 6%.
Yes, it's the big names that pulled the market up. Reliance is one that alone contributed, the most to this uplift. And then you had ICICI Bank and Eternal that also pulled in their weight, in the last couple of hours of trade for the Nifty to close 50 points up. The IT pack here down almost close to 6%. But you had the energy, metal pack, auto, realty, all of them, pulled their weight through the course of the day. Now, over the next few minutes, we're going to get you all of the big news and the key developments that took place today, the top corporate voices and events that we're going to be tracking ahead. Let's start the day with the, with what we've told you about the markets, but also recap what we have in store for you in the next 30 minutes. We start with the top movers and shakers of the day with Hormaz Fatakia, and then we'll break down the sharp sell-off in the Indian IT stocks following Anthropic's latest AI plugin launch. We'll also put the spotlight on HAL, which slid more than 5% amid reports that it could be out of the race for the AMCA stealth fighter jet program. Last but not the least, we'll also take you through the key market events to watch out for in tomorrow's trading session. So on to our first segment of the day then, Mangalam.
Yes, let's go across to Hormaz, who's standing by the big wall to tell us about all the movers and the shakers of the day. There were far more gainers than losers. Hormaz.
They indeed were, and what a day it was. You look at the first plate and you would wonder that the markets would have had a bad day today, because look at Infosys down 7, TCS down 7, Persistent, Coforge, HCLTech, all of them selling off. No IT stock today ending with gains. But if you look at the other plate, it will tell you why we had a good day despite this first plate, and the recovery in the Nifty, the gains on the index despite the sell-off in the IT names were led by all of them. ICICI Bank, Reliance, Bharti Airtel, HDFC Bank, L&T, the heavyweights putting their hand up in today's session and ensuring that the Nifty downside A is capped, and then B recovering and then ending the day higher than what the market eventually feared. The earnings reactions continue to move in as we count down towards the end of the earnings season. Lloyds Metals was up 10, Sheela Foams 15, Carousel came out with results just a few minutes earlier, as did Imami. Imami at one point was up almost 7% and ended up giving up all of those gains, and Teamlease too, after that initial 10% pop, gave up some of those gains to end just 4.5% higher. The rebound in oil prices has again put ONGC and Oil India in the spotlight. ONGC gaining 4, Oil India also ending 4% higher today. And Siemens Energy did well, as did Indian Oil Corporation, despite the rise in oil prices. And lastly, some underperformers in today's session, barring IT. You spoke about HAL. We'll talk about that more as the show goes by. Triveni Turbine is an earnings reaction. Sai Life Sciences didn't do so well for itself, 8% lower, and Latent View too, seeing some bit of a selling pressure today, 8% lower on this stock as well.
Thanks, Harmas, for taking us through that exhaustive list. Let's go across to our guests then. Mayuresh Joshi, Director of Research at MarketSmith India, is with us, and so is Somil Mehta of Mirae Asset Sharekhan. Gentlemen, thanks very much for your time here. Mayuresh, let's get your view on the IT pack. That was, the story of the day. A bit of an underperformer all of last year. With the correction that we have now, do you see some pockets of opportunities to buy quality names?
Afternoon, Ritu. I think we'll still wait and watch. I think what has happened yesterday night, I think, is just an example of what is expected to happen over the next few months and quarters as well. And therefore, I think as the processes evolve on the products and the platform side, as far as AI is concerned, not just in the US, you're seeing fabulous strides being taken in the China ecosystem as well. And therefore, I think competition is going to brew up pretty thick and fast. Having said that, our traditional IT businesses will need to cope up in terms of the AI ecosystem, the Substack ecosystem as well. And they have to gear up pretty fast because I think the entire world is probably gearing up on that front. Obviously, I think in terms of expectations on how results have been so far, results were very much in line with estimates as far as large cap players are concerned, whether it's constant currency, revenue growth expectations in terms of the EBIT guidance that has probably been given. And similar is the story for mid-cap IT companies. Therefore, I think the distinguishing factor in terms of valuations for large cap being a tad bit better than mid-cap, but the intensity, both in terms of AI, pricing related intensity, as well as competitive pressures, I think that might still continue to plague a significant amount of earnings growth as we head into the next few quarters. So I think we're maintaining a neutral view on the sector. We've maintained that for a very, very long time, to be honest and honest.
Right. A couple of these consumer discretionary names did extremely well today. The top Nifty gainer was Eternal. The second one after that was Trent, ahead of numbers, up 5%. We saw some traction in Titan as well, up 2%. And from the broader markets, a lot of these QSR names, Devyani International did well, 6% higher post results. Following Devyani was Sapphire. These companies are on the path to merger. So because Devyani moved higher, Sapphire followed suit as well. Good time to welcome Somil Mehta as well. Somil, what do you make of the price action today? We had all the reason to go down, but the resilience kept it up. We were up around 50 points by the end of the day.
Absolutely. Good afternoon to everyone. We are holding to 40 and 20 daily moving average now. We've seen a very good bounce. We've seen a very good, breakout of a, consolidation, a sharp correction as well. So I think we will stay around these levels. We'll consolidate around these levels, but the overall structure still remains positive now. As we have gapped up above very crucial levels, 20 and 40 daily moving averages around 25,470 and 25,620. So these are the two levels which I'm looking for. And now there are stock specific action, like very beaten down stocks have started moving up, like Trent, Dixon, TI Industries, TI India, DLF. All of these stocks have started moving up, which is showing a lot of strength in the market now. So I'll be positive. Buy and decline should be the strategy, and my targets on the upside in a very short term would be 26,000, but I'll be looking for new highs very soon.
All right, you're looking for new highs very soon, and for those new highs to come, the IT index actually has to perk up as well, because that index fell almost 6% today after Anthropic released its latest AI plug, which spooked the IT stocks across the board, not only in India but globally as well. Rima joins in to tell us what was ailing these stocks and the impact that it could have on their earnings.
Indeed, it was a very sharp sell-off across the IT companies. Just to take a step back and understand what happened. Now, Anthropic released 11 new plugins for its Claude Co-work agent. This is basically agentic AI for different types of work, for legal work, CRM work, etc. And Claude is not sold as a standalone AI company. It's being built directly into the platforms enterprise already use. So the fear is of disintermediation. Now, there are many companies which sit between an LLM and an enterprise. They use the intellectual abilities of the LLMs, their power, and help analyze enterprises' data because it sits in the middle and comes up with solutions. But this work can be done by an agentic AI. So the fear is that what happens to that middle layer? Is there a risk of disintermediation? If not, completely replacing it, but can it pressurize their revenue pools? Can it cause higher than expected deflation? Then are the valuation multiples justified? And even Indian IT companies do earn a certain amount of revenues by implementing customization, integration, and maintenance of this enterprise software. So which is why across the technology stack, yesterday they were sold off. Companies which provide legal services, tech companies which provide legal services, like that by, Thomson Reuters, LegalSet sold off. Data analytics companies like Morningstar, FactSet sold off. SaaS companies like ServiceNow, SalesNow sold off. Global IT companies, Accenture, Cognizant under pressure. And now you can feel the ripple effect across the Indian IT companies. And it comes at a time when the sentiment surrounding the Indian technology majors has already been hit.
All right, Reema, thanks very much for that. Now, artificial intelligence firm Fractal Analytics is all set to make its market debut next week. Now, this is going to be India's first pure-play AI IPO. The company has, however, cut its IPO size by more than 40% to 2,834 crore rupees versus about 4,900 crore rupees that it had initially proposed. Now, the company has also set a price band of 857 rupees to 900 rupees a share. Speaking to CNBC TV 18 earlier, its management spoke about the disruptive force of AI. Take a look at that, and then we'll get our guests in to weigh in on this IPO.
We are the disintermediating or disruptive force that's saying that your existing technology stacks don't do a good job. Use AI to power decisions directly using these models. So we feel we are the disruptive force right now. They will see this is such an evolving space and such a large space. There'll be multiple players, multiple winners doing multiple things. And so Fractal's focus is enterprise AI, which is the hardest part of AI, is translating enterprise AI excitement into enterprise performance. Now, the biggest companies in the world that have complex software structures and databases and so on, and hundreds of thousands of users driving decisions inside companies using AI. So that is a space that is currently not yet taken off in a very significant way. So that was also, in that terms, there are very few companies in the world that understand it.
All right, so that's about Fractal Analytics. Mayuresh has spoken about IT already. Mayuresh, your view on Hindustan Aeronautics. In fact, we'll get in RIA first and then get your view on Hindustan Aeronautics and all the defense stocks post the budgets for announcement of around 20% increase in defense capex. Hindustan Aeronautics tumbled nearly 6% today after it indicated that the company could be out of the race to bid for AMCA's 5th generation stealth fighter jet program. They had been widely expected to lead the project along with two smaller partners. But Riya Bhatia joins in to tell us whether that's a negative for the company or not. Them getting this could have been a positive, but them not getting this is not a negative because analysts are not factoring anything from this, is it?
Well, yes, Mangalam, as you rightly said, HCL has been knocked out of the bidding race for the AMCA jet program. Now, this is as per industry reports that have been confirmed by analysts. And up until now, HCL was expected to be the front runner for this program, along with the two smaller firms with which it had bid for this project. And which is why the street is reacting so negatively to this, because up until now, they were expected to be the front runner for this. And this will also be the first time that HCL will not be involved in one of the country's most significant military projects. Now, in terms of the other companies that have bid for this, that includes Tata Advanced Systems, Adani Defence, along with MTAR Technologies, L&T and BEL, and even Bharat Forge, along with BEML and Data Patterns, among some other companies. And as per reports, 3 of these companies have been shortlisted, and within the next 3 months, a final winner is expected to be declared. Now, the AMCA project, for this, around 15,000 crores have been allocated for the prototype development phase of the project, and the total project has been valued at roughly
You're going to the middle?
Yes, right here.
Good afternoon, ladies and gentlemen. What a pleasure it is to be here to talk to these two absolute stalwarts. And then we've got two more stalwarts coming up afternoon, Mr. Ambani and Mr. Pink. It's great to see you both here. Without further ado, let's dive straight into it. I think Hitesh, in his opening remarks, Mr. Kamath, gave us a very clear indication of where we currently find ourselves as far as the Indian financial sector is concerned, especially the opportunity for players like Jio BlackRock. And I want to understand from you what you believe will be the levers, the triggers that will lead to this transformation of the current assets under management for the mutual fund industry to double over the next 5 years.
I think, thank you, Shirin, and good afternoon. We ride on the India story. The India story, we now talk of a 10% growth. I believe that 10% growth is sustainable. And my experience in banking shows that if you're growing at 10%, financial services business typically grows at 15%. So we should simply compound at 15% and you'll have a doubling of the assets. But that's only part of the story. I think there is also going to be reallocation of money from savings to investment. So you can put a number, I don't want to speculate. My belief is the mutual fund industry in India is going to more than double.
More than double?
More than double over the next 5 years. Given a 10% growth and the shift from money lying in savings account at very low interest rates into investment accounts which give you higher rates.
Well, that's good news for the mutual fund industry. What about banks? Sir, they're already complaining about deposit mobilization.
Yeah, we'll talk about banks another day. And I have talked many times about this. I think everybody has to reinvent, so banks also will have to reinvent themselves. But we are talking of this business.
Yes.
And I think we are talking of our joint venture, which has no legacy. I would think what is critical in today's world, not just for us, but in any business is, what's your legacy situation? And are you willing to deal with legacy? I think we are privileged because we have no legacy at all. So we are at the right time at this moment, and we will have to keep being at the right time as we grow.
You know, Rob, let me pick up on the phrase that Mr. Kamath used, we're at the right time. Are you also at the right place? Of course, the experience with India goes back over 15 years now. Why the belief to want to double down on India at this time?
Well, first, it's an honor to be here, and it's so exciting to have the opportunity to be here today, having launched the asset manager and having launched the wealth management company. If you take a step back, when we announced what we were doing here together as Jio BlackRock, the aggregate mutual fund industry was roughly $650 billion. Now it's $900 billion less than 3 years later. So I think this question of, is it going to double? I think it's certainly going to double. The question is, how big should it be? And if you believe, which we strongly do at BlackRock, if you believe that India is going to become the third largest economy in the world, I think we'd all agree that the capital markets need to grow. I think we'd all agree that the mutual fund industry needs to be a lot bigger than under $1 trillion, which it is today. So when we look at the opportunity set, we think in many regards it's just beginning. Mm-hmm. As we think about where India is today in terms of its capital markets, as we think about where India is today in terms of financial services, and importantly, where it is with regard to wealth and asset management, in many regards, it's like what the United States or like the United Kingdom was if you go back 20, 30 years ago. People are buying mutual funds, and they're buying good mutual funds. They're paying very high prices, they're paying high distribution costs, and they're sort of collecting funds as opposed to having the opportunity to really understand, what am I investing for? What is my outcome that I aspire to? Mm-hmm. And how do you actually build a portfolio with the right building blocks to achieve that outcome? And that's what's so exciting to us, is that in many regards in India today, that space is open. The combination of technology that we're able to bring through BlackRock, and importantly, the distribution, reach, and brand of Jio, bringing those two together enables us to really deliver something unique to the market here.
Rob, if I can just double down on what you said there, and you talked about the headroom for growth here in India. I want to put this in the context of what you're seeing globally. Today, for BlackRock, assets under management, 11 trillion at last count, or perhaps even more higher or higher. So if we are where the US and UK were 20 years ago, what do you think is imperative in terms of the way that products are designed, in terms of the way that you distribute these products to customers, and the use of technology? And how can we leverage technology to accelerate growth?
Well, a lot of the use of technology in India for so much of the consumer experience is highly, highly, highly personalized. And when you look with regard to financial services and asset management, it hasn't really caught up in the same way as so many other aspects of India has. So, for example, the ability to really understand what someone's objective is. I want to retire at this age. I want to save for a wedding. Understanding that and backing into the right portfolio, automatically rebalancing that portfolio. And I think very different than many other aspects of someone's life, the real miracle of investing is that compounding of return. So if you could save 10 basis points, 0.1%, year after year after year after year with regard to expenses, and if you could generate 0.5%, 1%, 2%, 3% of extra return as you aspire to that outcome, the effect could be profound. So the opportunity here in terms of bringing these methods that are really at this point quite common in other parts of the world, bringing them to India and the scale that India provides, it's so exciting to us. You know, if you look at Jio BlackRock, we launched roughly 7 months ago, and we have 1 million customers. There are very few places in the world where that would even be a thing, that would even be an aspiration. So the ability to take what we've built at BlackRock for so many decades and implement it locally at the scale, at the consumer level, there are very few places in the world where you could really do that like you can in India.
So 1 million customers in India, what's the aspiration in the next few years?
It depends on if you ask the two of us or if you ask Larry and Mukesh.
Let me start with you. Let me start with you.
I don't see any reason why. Well, first, I think many more people in India need to enter the capital markets. I think many more people in India need to take advantage of that miracle of the compounding of returns. And there's no reason why, as we look forward 1 year, 3 years, 5 years, there can't be many millions of Indians benefiting from the capabilities of Jio BlackRock.
Mr. Kamath, you said that we need to move beyond legacy, and in many ways, we need to start afresh. Let me ask you that in the context of the use of technology, but also designing products that are going to be relevant for the Indian market. Also, the regulatory recalibration, perhaps, that is required to ensure that we go from the 800 billion that we currently are at and grow, twice as much.
Yeah, I think break it into 2 parts or 3 parts. One is product capability. I think our partners bring that in abundance. I think they are the leaders in the world, and they have the ability to model and design products as appropriate to any geography. So I think they have now understood this market along with the new vehicle that we have. And now I think we can bring the knowledge that they have gained elsewhere to this market. So I have no doubt about that. And here it's very interesting. So you have a phase where you need to understand whether the company, our customer is willing to use technology. We had that experience aplenty in the bank. The customer was willing to use technology. Every bank said the customer is not willing to take technology. And that's what we saw happen from 2000 onwards today. I think the same thing needs to be done in the mutual fund industry. There's a particular way we expected the customer to deal with us through an agent network, for example. Question today that could be asked is the customer willing to deal with us directly or in a hybrid way, but more directly? Can we have large part of the business direct And that's the model that has been launched. And in a way, the first few months were a test of this, I would say, approach. And it is clearly proven to be right. For example, we have not talked about it, but of the 1 million or so customers that Rob talked about, there are 100% have come online. About 25% are new to mutual fund who have come online. So, and I told my colleagues that I can't believe this number, because if I put myself in new to mutual funds, I have not been into mutual funds, and I'm going to come online and get on and buy a mutual fund, I would have said, I will hesitate. But the young Indian is not hesitating.
That's Gen Z for you, sir.
Exactly. So we need to learn one minute. It's not. I've got an anecdote to this, which is even more interesting. So clearly that is proven that you are getting people online who are new to this. We need to scale this up now. And imagine 10x or 50x in terms of what we have done. If it is 1 million, what is that X number? They will determine in quick order. Other thing is, then we tested this hypothesis of Gen Z or Gen Alpha or earlier. So I mentioned this to some people I knew who were on our common boards and so on. And I just mentioned, and I had a message from one of these people, very well regarded, everybody knows him, so I won't name him. He says, I got on this, and he didn't tell me I was getting on. In 1 minute, I had my account going. 1 minute. And Hitesh told me a story yesterday that somebody else that he mentioned too, in 1.5 minutes, I had my account going. So clearly, I think you provide appropriate technology. India has come of age to say that I am willing to experiment with that technology irrespective of my age. And I think that we learned during COVID, because everybody had to become literate in a way to use a machine and transact financially. So that, I think, is an advantage that we have. And it works to any service provider, financial services provider, which is digital first and has low legacy.
Well, you're giving quick commerce a whole new meaning now, Mr. Kamath. Account openings in a minute and a half. But Rob, coming back
but
to...
Wait a minute. Your payment bank, we open an account in 3 minutes. So please try it out.
You should try it later. Open an account.
I most certainly will. But Rob, coming back to the use of technology and AI specifically, and we were all in Davos. And if I were to do a word cloud, if it wasn't President Trump, it was artificial intelligence and AI. The use of AI specifically, you and your team are behind Aladdin, and that clearly symbolizes the magic of artificial intelligence. But what happens to human stock pickers? I mean, are they going to be relevant any longer?
Absolutely. And I think what's important about investing is that part of it is art and part of it is science. And I think if you look at the different methodologies that we have within BlackRock, we have quantitative capabilities, and a lot of those quantitative capabilities we were able to transport to India in terms of how we actually leverage AI to create alpha signals. But at the same time, you have human intuition. And importantly, going back to this concept of stock pickers, if you think about what the traditional process has been, you have a group of people who lock themselves in a room and they read stuff. And no matter how much of a speed reader you are, there's only so much stuff you could read in a given amount of time. And now you have these capabilities that really enable the human to have access to someone who could read everything produced in the world, who could summarize everything produced in the world, who could figure out trends, themes, and actually use it to inform the human intuition, use it to inform the human stock picking. So I think there's room, at least for the next decade, there's room certainly for both. And it's really the human to the power of AI, more so than we have robots sort of choosing stocks for the rest of time.
So we still have a decade.
At least. I'll reassess in a decade.
You'll reassess that. But we've got about 30 seconds left. Mr. Kamath, I'm going to start by asking you, you're a perennial India bull. What makes you most specifically bullish on the India story in light of the fact that we have just presented a budget which has laid out the roadmap for a more medium to long-term bet on the knowledge economy, on artificial intelligence, on electronic manufacturing? What makes India most compelling today?
Very simple, Shireen. I look for patterns in everything that happens. You look for examples and patterns. So you look at transformation stories in a country context. Japan, 20 years, went from nothing to very powerful. We're talking about 70, 90. China, late 90s to 2015, similar story. Our story has started only 4 or 5 years back. And if you look around us, we know how much is to be done. So that gives you the path, as it were, or the runway, as it were. And that to me is at least 15 to 20 years minimum. So you have the runway. And then you see all the exciting things that you mentioned just now happening. You put one on top of the other. You have a pathway for the next 20 years, which is definitely going to be at least 10% year-on-year growth. And within that, we stitch our story.
Within that, we stitch our story. Rob Goldstein, the final word to you. What makes India the most compelling story for you?
I've had the privilege of coming here since 2010. And when you have the opportunity to travel the world, and India is part of your rotation, you could see with your own eyes the opportunity. You see the opportunity, how it emerges with regard to human capital. You see the opportunity, how it emerges with regard to technology here. And even importantly, you see the opportunity with regard to infrastructure and something like the coastal road and how that's changed the whole city of Mumbai. So as we look at India, the opportunity set here is striking. There are a few places where you'll get off a plane anywhere in the world that will have the growth rate, that will have the knowledge base, that will have the STEM graduates, and importantly, you will have as many people on an absolute basis, just the sheer numbers of people who are entering the middle class, who are entering that mass affluent and affluent segment, it's unparalleled anywhere in the world.
An unparalleled story. Rob Goldstein, KV Kamath, thank you so much for setting the stage for where India stands, but more importantly for the headroom for growth for India's financial services sector and for the mutual fund industry in specific. And thank you very much for articulating for us what Jio BlackRock's plans are for India. Appreciate your time. Ladies and gentlemen, a big round of applause for KV Kamath and Rob Goldstein. Thank you very much. And without further ado, may I request the chairman of Reliance Industries, Mr. Mukesh Ambani, and the chairman and CEO of BlackRock, Larry Fink, to please join us on stage. Ladies and gentlemen, a big round of applause for the two leaders who join me in a conversation on what it will take to invest in a new era, the trends that will shape our investment choices.
Hey Shireen, how are you? Good to see you.
Good to see you. I think they want a picture, so if you can just
Sure.
have the two of you here. Thank you. Mr. Ambani, Larry Fink, thank you very much, and welcome to a warm, sultry Mumbai from a very cold Davos, Larry Fink, where you were in the throes of conversation with world leaders about the world order or the world disorder. So let's get started with that. We're talking about investing in a new era. What are the changes that you foresee that will shape the investment choices, the investment decisions of leaders like you as we look at this new era?
Well, first of all, it's great to be here in Mumbai. It's great to spend time with my partner, Mukesh, and the entire Reliance NGO team. So it's a real honor to be here. Weather is nicer here than it is in Davos, and much nicer than New York, where I had our board meeting last week. So it's good to be here. You know, we talk about a new era to give people a foundational understanding where we are. But as an investor, I don't look at any era. I mean, our job is to be having people focus on the real opportunities to invest over a lifetime. There's so much information that confuses people. Media talks about the moment, the velocity of money. And the reality is, for most people, they need to be in a position to grow with each and everyone's country. So when you think about the growth of India, it's not a quarter, it's not a day or a week, it's not a year, it's over a long horizon. And you could say maybe this is the era for India and over the next 20, 25 years. But if you use that as a foundational paradigm that we all want to think about, the era of India, forget about the era of investing for a second, but the era of India, the key for us, the key for Geo BlackRock is to compel more people to understand what does that mean, the era of India, and how do you participate in it? What we've learned in the United States, for that segment of the population that had invested with the growth of America, they're far better off than those who just kept all their money in a bank account. And so the key is, if you believe in the era of India, forget about the era of India, investment, the era of India, which I believe in, we need to get more people investing alongside the growth of the country. And that's the role of the capital markets, that's the role of what we can be doing together. And to me, whether it's, you want to focus on AI, you want to focus on how we live, how we grow, how we educate ourselves, to me those are subsets of the era of India and the opportunity to be an investor alongside the growth of India. And to me, that's a compelling story. It's not about, about tariffs or President Trump or anything else that's top of mind. We need to be compelling people to think about the horizon of investing over a long period of time, to grow with the great companies of India, to be a part of that and to participate in that. And I'm absolutely convinced, if you believe in that, the era of India, we need to compel hundreds of millions of Indians to invest alongside the growth of India. And that will actually transform India in so many ways, because as more and more families invest alongside the growth of India, India has less needs for the importation of capital. And I do believe the combination of importation of capital from foreign investors who believe in the era of India, but the fundamental foundation of any country is having the domestic economy being built on the back of retirement savings, on the back of excess savings, to invest alongside of that.
Well, thank you very much for those opening remarks. And, the era of India, says Larry Frink, that is certainly going to be one of the headlines that goes out this evening. But if I could ask you to explain to us what excites you the most about India. You referenced the tariffs, and, we've had a deal with the US overnight. President Trump and Prime Minister Modi have signed off on that reciprocal tariff agreement. So the overhang has lifted at least on one aspect of that relationship. How crucial a development is that, and what excites you the most about India today?
Well, let's be clear, over 20 years it had no bearing. Maybe over the next 6 months or a year it had some significant bearing, but over time, the foundational issues of India, how it's able to leapfrog. I mean, you watch what has, over the last, I would say, since the era of the smartphone. And I think that's a pivotal point. 2012 was, think about your life before the smartphone here in India. But the beginning of the smartphone, the rollout of 5G, and how that transformed India in so many ways. When you think about how the Modi administration digitized the rupee and how it transformed commerce in India across the board, I am very worried about other countries. Even the United States is falling behind. We need to be digitizing. We need to be thinking about how this all plays out. I think this is part of the democratization of India, and so now India is a leader in this. And so I could cite many things that give me optimism, but the fundamental opportunity is the huge intellectualism of India, the transform what technology, whether the technology was created in the US or somewhere else in the world, the dispersion of that technology in India is really what is so inspiring, and the utilization of the new technology for more and more people, and how that transforms commerce, consumption, information, education, all of that is ripe for real solid growth. And I agree that India has, over the next 10 plus years, it's going to grow anywhere from 8 to 12%, probably hovering around 8 to 10. And that's a place where I want to personally invest in. And what we need to do is compelling more Indians to invest alongside that growth.
Well, we certainly hope that more Indians are going to be investing in that story as well. And speaking of one such Indian, Mr. Ambani, let me talk to you about Larry Frink's phrase of saying that this is the era of India. Now, you've seen India over the last 2 decades transform itself in many, many ways, especially as far as the digitization era is concerned. Specifically, what excites you? What is compelling about the India story today? How have you seen it being transformed?
Well, Shireen, before I answer that, let me warmly welcome Larry, and I'm grateful to Larry to again come back to India. It was a conversation that we had in 23, and it just took me 5 minutes to saying, Larry, BlackRock should be back in India. And he said,
that's all it took, 5 minutes?
Will you partner me?
Less. It was a car ride. We had to go to point A and point B, and we accomplished it in a car ride.
In terms of, here you are with your full team, and we have launched the business. So thank you for again coming back to India, and India warmly welcomes you and your colleagues, and to all my colleagues from the industry and the financial community, a very warm welcome. And we look forward to working with each and every one of you. As Shireen said, I think that, Larry, there is an old Indian saying that a tree only attracts attention if it bears fruit. And today, in this new era, as you described it, India and the tree of the Indian economy is bearing fruit with great visibility, with sustainability and abundance. As everybody said, right, we are confident, like we are the largest growing fast economic growth in the world. 8 to 10% is possible and doable, and I think that sustained double digit is not ruled out. So that gives us and that is why we are, after a long time, attracting all this attention. And this has happened primarily because I think that the last 10, 15 years, right, we had 2 successive periods. We had 10 years of Manmohan Singh, where we focused on growth. And then we were very lucky to have now consistently 15 years of very stable leadership. So stable economic leadership defines a country. And I think that we have to be thankful to Prime Minister Modi for giving us this stability now for going in, by 2029, it'll be 15 years. Yeah. I also think that we've got what is different about this is we've got a very clear goal. A goal in terms of saying we have to be developed, Viksit Bharat by 2047, which every Indian aspires to and has started believing in. Second, we've executed at scale, right? While as Indians, we like to criticize ourselves, and we are not, and it's a good thing in a democratic mindset, but if you see, we've built more roads in the last 15 years than any other, like multiple times than any other country, including the United States at its peak. We've built power capacities. We are now the leading renewable power producer in the world. We've built in our own industry digital capacities, 5G, that is better than most people in the world and cheaper than most people in the world in terms of what. And now every Indian village has got 5G. So, and I can go on, like we've built the same thing in terms of infrastructure, the roads that you see in Mumbai. For a long time we said that we will connect Mumbai to the mainland, and we now have the bridge that is running. So we've executed. We've also had policy which is sustainable. So even when you see between governments, right, we all thought that Aadhaar was the earlier government's piece. I think this government was wise enough to saying we've had continuity in policy at all times. In terms of that, we've had stability, we've had predictability. We've also been conservative. So as Indian successive finance ministers, we've always maintained our debt in order. Relative to global debt, we are still 50% of GDP as debt. So we are not, like the world norm is now 100%. So we've had, and I think that we've also in the private sector, and what excites me the most is the startup industry. When I interact with startups and we see young 28, 30-year-olds starting up companies, and I can clearly see, right, 100 new Reliances in terms of where, and the aspiration, the confidence that they have. And finally, it is the confidence that you see. Fortunately, we now operate across the length and breadth of India. So it's not only the confidence in forums like this, but when you see the confidence in young people going to school and colleges, wanting, and in parents today believing that their tomorrow is better than today. Right? And that is a big, big change in India, that all of us, this is our baby boomer generation. This is the Indian generation that believes that they'll make a better tomorrow than today. And that's the confidence that we see as a result of all of this. And I don't want to rule out, like when everybody, we've also had, right, at least I think a sustained 15, 20 years of great law and order. Right? And that is a prerequisite to continuous economic growth, social harmony. All of these things matter in terms of that. And hopefully, like we are now setting the foundation for many, many decades. The world sees that. And that is why, you know, even like after the budget, we had the European treaty, we had, fortunately, the US. So the world is looking at us. We have, like, and we at Reliance get at least every month 3 or 4 global majors. We cannot say yes to everybody for partnerships in terms of saying we want to come to India and can we work together. So the world is taking notice of India. It's a tree laden with abundant fruit. And you know, I've always believed that for profit and for prosperity, nobody needs an invitation, and that is why we are attracting all the people. And I think this is very, very sustainable over the coming decades. Like
sustainable for the coming decades, and 100 more Reliances, in your words, from the startup ecosystem. If that is, comes true and that bears fruit, it'll be a very, very different economy, as you point out, Mr. Ambani. But, you know, I want to understand from you, since we're talking about Jio BlackRock, we're talking about the opportunity for India's financial sector. A lot of people are asking, is the ambition and the aspiration to disrupt this business just as you did with telecom, Mr. Ambani?
Well, our ambition and aspiration starts with, you know, what I admire about Larry. Right? And Larry is not only, right, the result-oriented CEO of a US top global multinational, right? But I think that he has a very compassionate and passionate heart, right? When he told me that, look, like at the end of the day, purpose of BlackRock is not to just make short-term results or not even to make returns, right, for my investors and my shareholders. If I cannot put this money to work, first for the betterment of society, and as a byproduct, I give my investors and shareholders returns, then I would have done my job. And that is the Reliance philosophy too. We've always believed that our minds match. And the purpose of Jio BlackRock, right? And I think that disruption is fashionable, but the opportunity that we see is that Indians have really been savers, right? Right from, if you look at our history, we have saved consistently over the last 5-6 decades. What has happened is that some of this saving has not been productive. If you see just the last year, right? We as India imported $60 billion worth of gold, and we imported $10 to $15 billion worth of silver. And all of this not for industrial use, but really for domestic savings in terms of, now this is unproductive. If we can actually convince the Indian saver that if one invests in the capital markets in a safe, transparent, and consistent way, there are returns. And these returns, we heard from all the three panelists, compound. And for us at Jio BlackRock, the opportunity is to encourage Indians to save, but to make sure that we give them the options to convert those savings into earnings and hopefully compound their earnings so that they not only work for themselves, but they also work for the Indian economy. And that propels the Indian economy to grow in terms of what we want to do. And then we all grow together. So yes, if you call that disruption, we will use technology, distribution to achieve that for every Indian household, for every Indian small business and large businesses. That's our objective.
So from the foundation and the beginnings of BlackRock, we never focused on targets of growth, ever. And yet, our focus has been relentlessly on the client, whether it's a client who's awarding us 100 rupees or a sovereign wealth fund who is awarding us tens of billions of dollars. If you are working on behalf of each and every client, and you're serving that client over a long horizon with good advice, with maybe a degree of safety, and importantly, just confidence building about the opportunities of compounding over a long period of time. Through the utilization of technology to intersect more often, more frequently, to have deeper, broader relationship with your clients. That's how disruption occurs. But disruption does not occur because you set a target. The target is making sure you're living with purpose every day with each and every client. And if you can achieve that with consistency day after day, clients will reward you with more share of their wallet. And so to me, it's just it's a process. It's a process you have to earn every day, live every day. And if you do that properly and you embedded that in the culture of the firm, we could be disruptive, but you can't be otherwise.
Yes, we can't be otherwise. You need to have the alignment of values, and then, of course, everything else builds on top of that. But Mr. Ambani, let me come back to you on the investing in India's growth opportunity and this new era that we're speaking about, and the role of making strategic choices today, which will require patient capital. And I want to understand from your perspective what it will take actually to build patiently with patient capital over the next 2 decades.
Well, I think that the Indian opportunity, as we stand at about $4.5 trillion of GDP in a $110 trillion world. Right? I see us outgrowing the world and finding our right place. So I am one of those believers who think that this 4.5 in a 20-30 year period, right, will outgrow the rest of the world, and we will hit $25-30 trillion. It's going to be 30 years from now, but as we do that, the India opportunity is a 10, 20, 30-year opportunity. And when you think about solving India's energy problems, I am a believer that in the next decade, India will not import 80% of its energy. We have a path, and God willing, like with technological breakthroughs, we will be reasonably self-sufficient in energy. Investments in such like energy sectors which make us self-sufficient are 20, 30-year time horizons. Investments in physical infrastructure that we still need. We have the opportunity to build with today's technology the physical infrastructure for 1.4 billion people. We've done a lot, but there's a lot more to do. These are also 20, 30-year opportunities. Technological infrastructure. We are not going to be behind the world in terms of building country-scale intelligence infrastructure so that every village has intelligence available to them. And this also is a 20, 30-year opportunity. Each one of this is hundreds of billions of dollars of investment. And within that, while the benefits are there, right, they're long-term, sustainable, compoundable opportunities, and that requires sustainable capital, which comes both from within and outside. And to my mind, India is attracting, we ourselves, our own experience in most of our industries is that it is not capital which is a problem. It is opportunities and execution, right? And the ability to give an overall transparent framework to both the consumers and the investors, which is the opportunity. It's not going to be limited by patient capital. The world recognizes that India, because the world also doesn't have many such scale opportunities where they can deploy on a few projects hundreds of billions of dollars.
Absolutely. The market, of course, in India presents a very compelling opportunity across different sectors, as you spoke of. But Larry Fink, let's talk about AI and the power, the potential of AI. And you're a big believer in the AI story, not just for BlackRock, but in general. You know, the stock market volatility notwithstanding, the fact that we're spending hundreds of billions of dollars in this AI infrastructure build out, and this is sort of front-loaded spending, and there's a question mark still on the revenues and the returns. How do you sum up what is happening in the world of AI today? What do you look for? What do you look at?
I would first and state that I don't believe there's an AI bubble.
You don't believe that?
Not at all. I believe the greatest risk we have is if we don't invest and continue to invest, China will win. And I believe the need to rapidly expand the AI opportunities is necessary. That doesn't mean we're not going to have some bankruptcies. We'll have some failures. That's capitalism. You're going to have some big successes and big failures. But the opportunity that companies have in utilizing AI is going to be present in everything we do. I mean, even yesterday you had Anthropic announce a new model, which is going to be threatening for some businesses, but it's going to be an opportunity for other businesses. You mentioned Davos, and you mentioned the word cloud. There's no question AI is among the most topical conversations we're having now because it is disruptive. It's going to be disruptive for some industries, but it's going to also be very advancing. I mean, the future of AI in terms of drug discovery, in terms of humanity, is real. The use of AI for the development of new sources of power or cheaper sources of power, what can that mean in the long run for the global south? Could we have abundance in energy one day? Now that's still pretty far-fetched at this moment, but the opportunities of the acceleration of science is there. Rob Goldstein talked about, having the ability to use AI to learn everything about one subject in minutes now. And so AI is going to allow more discovery, more opportunities, and with that technology, like so many other technologies, It's going to be disruptive for some businesses and some economies. And the key for AI to be really successful in every society, we need to make sure that AI broadens economic success and it doesn't narrow economic success. We talked about that a lot in Davos the last 2 weeks, and that's going to be the real issue. Can AI be not only disruptive, but can it be expanding and broadening economic success throughout all economies? And that's going to be the big question about, how do we play that out? In the early part of AI, you're going to see countries that are huge winners and some countries that are going to be left behind. And so you have all this dynamism around how AI is going to be playing out. That is in the short run. In the long run, I think it's going to be more democratizing, but in the first few parts of AI, it's going to be more limiting. And so we look at AI as a huge opportunity. For us in navigating the $14 trillion that we manage on behalf of our clients, we have to use advanced technologies to process the business that we are already doing. And the same thing for all the other major companies. Through AI, you have better understanding of your clients, better understanding of your inventory controls. You have so many advantages by the application of AI and technology. And that is, in the long run, to be very powerful. In so many of the developed economies, we have excessive deficits. It's a conversation that was not talked about in Davos about the excessive deficits, which is a substantial problem for many of the developed economies, including the United States. Can AI increase productivity? And if so, can we increase GDP with a diminishing population? That's going to be the question that Korea is going to be asking, and Japan's going to be asking, and Italy. Can you have a growing economy? Can you have a broadening of economic success with fewer people, with the utilization of AI and robotics? I believe the answer is going to be profoundly yes. But it also means countries that have very rapid growing populations, that's going to be a bigger question. And I think India is at the nexus of it, large base population, but the one thing that I've noticed, India is more accepting of technologies than many of the developed countries. India is more accepting of related to change than most developed economies. And so because of the large scale population, AI is going to create jobs and disrupt jobs, but for those economies that are willing to accept change and rapidly deploy that change in a positive way. And I think about India, the way it rapidly transformed its economy with the digitization of the rupee. I mean, to me, that was a wonder to watch. And so to me, AI is going to be a powerful growth engine in the world, but we need to make sure it's a growth engine for more.
You're absolutely right. And, to your point about India surprising on the digitization front, this was a surprising fact for me as well. The Binance CEO in Davos telling me that India is the #1 adopter of blockchain technology. And that's something that I was not aware of. But Mr. Ambani, since we're talking about AI and we're talking about technology, to Larry Fink's point, how do we leverage all of this to create shared wealth creation?
Well, I think that I'm a believer, have been a believer that we have to embrace technology. We cannot run away from it. And AI is real, right? From an India point of view, it is hugely advantageous. If we think about 200 million children in our schools, and if we now think about connectivity to all our schools, and we give ourselves a goal that in 1 decade, right, with a fraction of the total GDP that others spend on education, we can deliver to each of these 200 million kids, including in the remotest village, quality education, right? I think without AI, this problem, we could not have dreamt about solving it. And we will, we are also participating in this opportunity. This is a solvable problem. You take healthcare and saying India is a large economy 1.4 billion people, but without any social security, without any organized health safety net, right, as yet relative to all the other countries. Can we deliver? Everybody, like the large economies, spend 8, 10, 12% of their GDP on delivering healthcare to their citizens. Large amount of it is wasted in terms of what, and everybody recognizes this. Can we in India take care of all our 1.4 billion people with a digital physical health system at a fraction of global costs? Answer is cannot do it without AI. Security, right? Again, critical for our safety for all our 1.4 billion people. If you use AI, right, and complement it with your law enforcement policies, possible to do. Simple taxation, right? We can now have the ability to have for each citizen, each company, the transactional transparency. So your tax paying becomes as simple as when you stay in a hotel and you have an electronic system, you can see all your transactions both ways and there are no disputes. And it becomes a much predictable, enforceable society. Can it? So that's AI. And we shouldn't get scared of AI. It's exactly like when the Industrial Revolution came, right? Humanity moved forward. We moved, productivity moved forward. We moved from 0.3% growth for many, many decades or many centuries to 3% growth overall, right? And at that time, if you go back 200 years and if you ask people that can people travel 2,000 kilometers a day, right? We would say not possible. Today, all of us, not two, with flying, we can travel 30,000 kilometers a day. And I think we're just at the beginning of that age. We must embrace it. India has the opportunity, and what we see, as you said, is we see that young Indians, as Kamath Saab said, old Indians, right? India just adapts to technology faster than everybody. We've seen it firsthand over the last 5 years in terms of what we want, and we should use that at our competitive advantage. Embrace this, get the productivity advantage, get the earnings advantage, build a better society in terms of, and use tomorrow's technology before anybody else so that we catch up from our $4,000 or few $1,000s per capita to double-digit per capita, and then get to, the US is still at $40,000, $50,000 a capita, so we've got a long way to go. This is our part to catch up, and I think the world will allow us to catch up with them in the next 2 decades, and that's an opportunity. Like from my point of view, at Reliance, we are taking this opportunity with both hands in terms of that. It's once in tens of centuries opportunity, and we can, like, if we embrace technology, if we allow our youth to embrace that, right, then in the next 20, 30 years, we can redefine India and find our true position in the world.
A multi-generational opportunity, as you put it, Mr. Ambani. But Mr. Fink, let me address the issue that you brought up and said it didn't get enough attention in Davos, and that was deficit. But what did get a lot of attention in Davos was, of course, the interest rate trajectory that the world is going to be faced with, and how you see some of these factors impacting markets globally, the investment sentiment globally as well. Where do you see interest rates headed? Do you believe that we're likely to see more cuts coming in? And what will be some of the other crucial risks that investors need to watch for?
Well, all those questions are for the short term, so let me answer some short-term questions. Look at the markets. The markets are honest. I mean, any single day the markets may miscalculate something, but over time markets is a great mirror of what's really going on. So whether there's political pressure one way or the other, sure, that could shape a market over any one day or week, but markets actually are bigger than any individual or any economy. And so if if the Federal Reserve eases too early, and we see inflation, we see measures that prove it wrong, you're going to have a steepening of the yield curve. So all those issues to me are not that important, to be honest. I know they're important for day traders. They're important for media because they can talk about all the churn and all that. But it really doesn't matter that much, and I don't really spend that much time focusing on those type of issues. Now, over a course of any one quarter, any one year, yeah, sure they matter, but over time the markets correct itself and rebalance itself, and that's pretty much the message that we have to constantly talk about, because the message is not about the moment, and everybody gets so confused about the politics, the polarization of opinions, the politicization of everything, and yet over time, that's the beauty of markets. The markets are an honest reflection of global economies over the long run, and if you believe in humanity, if you believe that we correct our problems over time, I actually believe the things you read in the newspaper, all the stuff we read that's frightening, I get actually excited because we're talking about those issues. And generally, we mitigate most of the things that are on the front pages. We actually mitigate. So I actually am pleased when I see all the things, all these terrible things, and I'm not trying to say each and one of those things may be really terrible, but the fact that we're talking about it, it mitigates. We self-correct. Are the things that you don't read in the newspaper that you think are a problem, those are the things that bother me. Like the long-term issues of deficits that we don't spend enough time talking about. How do we mitigate it? The best way we mitigate it is through growth. And that's what I try to tell every political leader. How do you grow your economy? Because if you grow your economy, the deficits will be smaller as a percent of GDP. But, and so, I don't get bothered by most of the stuff I read because it's a good thing. That's the power of the press, to identify all the issues. But through that identification of the issues, we mitigate those issues. You think about all the problems you read and all the wars and all the skirmishes, but in most cases over time they resolve themselves. You think about how problematic everything is when we entered this year, and yet when you think about the beginning of 2025, everybody was so nervous about everything, yet markets did great over 2025. We have some form of resolution in Gaza and Israel. There are so many other areas in the world where we actually have diminished risk. But if you ask the average person who reads the paper, they would think things are actually worse than they are. And to me, obviously, negative news sells far better than positive stories. And so what I'm trying to say, and my message to everybody is, yes, please be a global reader of what's going on, but don't get so alarmed by it, because we're going to mitigate most of those problems because that's what we do as human beings. And that is the whole message about long-term optimism. Long-term optimists generally win. Elon Musk said in Davos, it's better to be an optimist and being wrong than being a pessimist who's right. And I think about just Elon himself for a second. I've never met a person who is as smart as he is, but with the imagination that he has and the guts to do what he's done. And I think in building that out, and I would just liken that to Mukesh Ambani, the ambition, the imagination. And those are the key things in growth and opportunity. And to me, this is what we all want to be a part of. We want to invest with the people who have ambition, who have the guts to do things that break the mold, that changes society, but they change society because of imagination and guts. And to me, that's the beauty of being a long-term investor.
Absolutely. So being an optimist and getting it wrong versus a pessimist and getting it right, in Elon Musk's words, is more important, and you agree with him. But Mr. Ambani, you were talking about the startup ecosystem, and I want to understand from you, both of you spoke about changing the mindset from savings to investing, and both of you are focused on generating growth. What is the message to the young Indian saver today? What would both of you tell the young Indian saver? And let me start by asking you, Mr. Ambani.
Well, Shireen, I think that to my mind, the India opportunity, right, is genuinely a new era. It's now, we can see it visibly over the next 2 or 3 decades in terms of, and all of us agree that growth, and we take growth for granted, but let me tell you, all over the world, people would die for 10% year-on-year growth, right? And we are growing on a large base, and we will sustain that. So for any young Indian, right, this growth is going to be converted to growth into his or her income, right? And so you would have income growth. We've got to continue our savings mindset. We still want to be conservative. We don't want to inherit too many deficit problems. We are still okay. So as long as we save, and if we make that mental mindset in terms of saying we will go and invest our savings to grow with India back into productive uses, to have these productive uses, Jio, BlackRock, and the whole financial community. Today, to my mind, while we all talked about 1 minute, I still think that from my perception, right, access to investments and productive compoundable investments is complex, it's not affordable, and it's not available to all. And that is what every young Indian should demand for. And it's our job in industry to do exactly what we did with Jio, that it should be available to all. And then people will benefit from the power of compounding. I think that we talked about compounding, but money in a bank account lying in simple interest is not compounding. Right? Money in stock market is compounding, and India has an efficient market. We have now regulated it well, and if we can channelize this money to grow for every Indian along with them, right? That is the opportunity that we have, where hundreds of millions of Indians, right, become owners of wealth and don't only observe wealth creation. And I think that India is well equipped. The institutional mechanism as well as the corporate mechanism is aligned with that very fact that we are here utilizing all the technologies to enable this for Indians is there. And within this framework, right, there are still many, many unsolved problems. And even after 3 decades, there will be many unsolved problems. So the opportunity for startups, think in a big macro piece, right? It's a $110 trillion world, 4.5 trillion India, right? The $110 trillion world with AI productivity will go up to a $300 trillion world in 3 decades, right? India has the opportunity to take its share. So there is like 35 trillion. We have 30 trillion of new value, right? That has to be created, and that means there is 30 trillion of new market value, and that is what people will participate in the next 3 decades, and that's why even 100 alliances might not be enough, but that's the opportunity for a young Indian starting today.
Larry Fink, your message to young Indians in the context of what you've seen happen in the other countries that you operate in?
Mostly believe in your own country. Believe in the opportunity growth. I mean, think about it. If India can grow 10% a year, then let's assume the stock market only grows at 10% a year. It grows at a multiple of the growth of a GDP. But let's just assume it only, that means you're doubling your pool of money every 6.5 years. Okay, that's a pretty good outcome. That's much better than keeping your money in a bank account. And to me, that's the foundational issue. Grow with your country. And if you believe that there's leverage in the system, which there is, you're going to. If the economy grows at 10%, the equity markets are going to grow, 5-6 points above that over time. And so, to me, that is that's the foundational to build financial security, dignity when you're in retirement. And to me, that is a whole foundational issue for a successful economy.
You know, you spend a lot of your time fishing, Larry, I believe. I believe this deal got done in a car, and it was less
We weren't fishing, no.
No, you were not fishing, but what was the bait?
Friendship.
Friendship. That is the perfect note to end this conversation. Larry Pring, Mukesh Ambani, thank you so very much for joining us and giving us a long-term perspective of the strength of the India story and the strength of this partnership. Appreciate your time. Ladies and gentlemen, a big round of applause for Larry Pring and Mukesh Ambani.
Thank you, Shivi. You're brilliant as usual. Thank you.
Thank you. Thank you.
Thank you, Larry.
Hello and welcome to our special broadcast. I'm Archana Solanki. Here are the headlines we're tracking this evening. AI disruption fears rattle tech and IT stocks worldwide. Anthropic releases a new plugin to automate specialized tasks and workflows for companies. Nifty IT index plunges over 6% to mark the worst fall in 6 years. Sensex and Nifty end at a 3-week high after posting modest gains. The rupee weakens against the dollar after a bumper rally yesterday.
दोनों पक्ष व्यापार समझौते से संबंधित आवश्यक तकनीकी प्रक्रियाओं को पूरा करने और कागजी कार्रवाई को अंतिम रूप देने के लिए मिलकर काम करेंगे.
Commerce Minister Piyush Goyal briefs Parliament on the India-US trade deal, says details of the agreement will be announced soon, adds that India was successful in safeguarding the interests of agriculture and dairy sectors. However, US Trade Representative Jamieson Greer says tariffs on a vast array of American agricultural goods will go to zero. External Affairs Minister meets his American counterpart Marco Rubio in Washington days after Trump and Modi agreed on a long-awaited trade deal, discussed formalizing bilateral cooperation on critical minerals. The two leaders emphasized the importance of working together to unlock new economic opportunities. Reliance Chairman Mukesh Ambani says the world is taking note of India's rise, adds the startup industry excites him the most and he can see 100 Reliance industries emerging from India. This is the era of India, says BlackRock Chairman Larry Fink, expects India to record high growth for over 2 decades, calls India a leader in digitization and warns countries like the US could be falling behind. Embrace technology, don't run away from it, says Mukesh Ambani as he bets big on artificial intelligence. BlackRock Chairman Larry Fink says there is no AI bubble and the real risk is not investing in artificial intelligence. The Reserve Bank's Monetary Policy Committee kicks off its 3-day meeting. CNBC TV 18 Citizens MPC votes unanimously for status quo policy. Majority of the members expect at least one repo rate cut by the RBI in 2026. The Supreme Court pulls up CBI Enforcement Directorate for delay in launching a probe against Anil Ambani for allegedly siphoning off over 40,000 crore rupees. Court orders the ED to form a special investigation team. CBI confirms a lookout notice has been issued to prevent Anil Ambani from fleeing the country. Mamata Banerjee becomes the first sitting chief minister to make a personal appearance in a courtroom to argue her plea. Argues in the Supreme Court that the SIR process is not for inclusion but for deletion. Alleges that the Election Commission failed to comply with court's directions on the logical discrepancy list. Supreme Court issues a notice to the EC. NVIDIA's Jensen Huang plays down reports of tensions between the chip maker and ChatGPT creator OpenAI. Huang says everything is on track and NVIDIA will invest in the upcoming round of fundraising by OpenAI. That's a CNBC exclusive. Home Ministry formally revokes President's rule in Manipur after a year, clears the way for BJP's Yumnam Khemchand Singh to take oath as the Chief Minister in the ethnic strife-hit state. The 62-year-old leader was elected as the Legislative Party leader by the BJP yesterday. All right, the big story we are tracking this evening. Anthropic's new AI automation tool has sent shockwaves to IT stocks across the globe. Tech stocks on Wall Street lost close to $285 billion in a single session. The AI giant released a new plugin that would automate specialized tasks and workflows for companies. Indian IT stocks got battered in trade with fears of the new AI tool causing possible structural disruption. The Nifty IT index was also down nearly 77% and making it its worst day since March 2020. Rima Tendulkar joins us now with the details. Rima, what does this mean for the IT industry now?
Well, the fear is of disintermediation. Just to take a step back and understand what happened. So Anthropic has released a Claude co-work agent. It's agentic AI, and they've done it for 11 segments. One of them is legal. And basically, this is not sold as a separate standalone AI tool. It's built directly into the platform enterprises already. It's built into the platforms that enterprises already use today. So the fear is of disintermediation. Now, there are many companies which sit between an LLM and an enterprise. They use the power, the infrastructure, the ability of the LLM to understand the the enterprise's workflows, the data, the unstructured, structured data, and come up with analytics, right? There are companies which do that. So Claude AI, the agentic AI, has done it for 11 sectors. And one of them, the legal one, has actually, spooked a lot of them because it can go through compliance, it can do documentation reviews, it can come out with legal briefs. So the fear is that what if, going forward, you don't need that, that integration service provider, that intermediary. And even if you don't replace the intermediary, the fear is that can it cause deflationary pressure, pressurize the revenue pool. And even listed IT companies do earn certain amount by implementing customization, integration, and maintaining enterprise software. So yesterday, there was a sell-off across the board. Companies which provide software tools to legal companies, there are data analytics companies which sold off, even SaaS companies like ServiceNow, Salesforce sold off. Here in India, you are seeing a brutal sell-off, and it comes at a time when the sentiment surrounding the technology space has also been very weak. IT companies have gone through a period of deflation, and now the fear is that there will be increased deflation. But is the sell-off overdone? What is the other side of the story? Listen in to the opinion Shireen got when she spoke to IT majors surrounding the impact of AI on their operating business model when she chatted with them at Davos.
How much of this new AI opportunity is likely to cannibalize on the existing maintenance revenue?
So there we've built some estimates which show there is some compression of revenue in different services because many of the AI agents improve productivity. But equally, we see a larger pool which is growth opportunities. And we will showcase that to show that net, we see much more growth than compression.
Many of the IT companies in India have not built their own models, but we should not lose fact that the value actually comes in understanding the business context of our customers, ensuring the data for the customer data works for them.
So there's going to be no change. You're not going to go the LLM way.
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
All right, time now for a mega CNBC TV 18 exclusive. Two global business tycoons, Reliance CMD Mukesh Ambani and BlackRock chairman Larry Fink, came together on one platform to discuss the art of investing for a new era. In a 46-minute conversation with Shireen Bhan, the two industry stalwarts spoke on a broad range of topics, from India's growth potential to the potential of artificial intelligence. Ambani said that the world is taking note of India's rise, said that the startup industry excites him the most. He also told Shireen Bhan he can see 100 Reliance industries emerging from India. Fink was equally optimistic about the India story. He said the next 20 to 25 years are India's era. Both the leaders bet big on AI and stressed that one must embrace tech and not run away from it.
What excites me the most is the startup industry. When I interact with startups and we see young 28, 30-year-olds starting up companies, and I can clearly see, right, 100 new Reliances in terms of where and the aspiration, the confidence that they have. And finally, it is the confidence that you see. Fortunately, we now operate across the length and breadth of India.
Let me come back to you on the investing in India's growth opportunity and this new era that we're speaking about, and the role of making strategic choices today, which will require patient capital. And I want to understand from your perspective what it will take actually to build patiently with patient capital over the next 2 decades.
Well, I think that the Indian opportunity, as we stand at about $4.5 trillion of GDP in a $110 trillion world. Right? I see us outgrowing the world and finding our right place. So I am one of those believers who think that this 4.5 in a 20, 30-year period, right, will outgrow the rest of the world, and we will hit $25, $30 trillion. It's going to be 30 years from now. But as we do that, the India opportunity is a 10, 20, 30-year opportunity. And when you think about solving India's energy problems, I am a believer that in the next decade, India will not import 80% of its energy. We have a path, and God willing, like with technological breakthroughs, we will be reasonably self-sufficient in energy.
I don't believe there's an AI bubble.
You don't believe that?
Not at all. I believe the greatest risk we have is if we don't invest and continue to invest, China will win. And I believe the need to rapidly expand the AI opportunities is necessary. That doesn't mean we're not going to have some bankruptcies. We'll have some failures. That's capitalism. You're going to have some big successes and big failures. But the opportunity that companies have in utilizing AI is going to be present in everything we do. I mean, even yesterday you had Anthropic announce a new model, which is going to be threatening for some businesses, but it's going to be an opportunity for other businesses. So when you think about the growth of India, it's not a quarter, it's not a day or a week, it's not a year, it's over a long horizon. And you could say maybe this is the era for India and over the next 20, 25 years.
What excites you the most about India? You referenced the tariffs, and we've had a deal with the US overnight. President Trump and Prime Minister Modi have signed off on that reciprocal tariff agreement. So the overhang has lifted at least on one aspect of that relationship. How crucial a development is that, and what excites you the most about India today?
Well, let's be clear, over 20 years it had no bearing. Maybe over the next 6 months or a year, it had some significant bearing. But over time, the foundational issues of India, how it's able to leapfrog. I mean, you watch what has, over the last, I would say, since the era of the smartphone. And I think that's a pivotal point. 2012 was, I mean, think about your life before the smartphone here in India. But the beginning of the smartphone, the rollout of 5G, and how that transformed India in so many ways. When you think about how the Modi administration digitized the rupee and how it transformed commerce in India across the board, I am very worried about other countries. Even the United States is falling behind.
You can catch that entire conversation on our digital platforms. Time for a short break. Coming up next, Supreme Court pulls up the CBI Enforcement Directorate for delay in launching a probe against Anil Ambani for allegedly siphoning off 40,000 crore rupees. Details when we return. Welcome back. In a move to boost India's data center ecosystem, Finance Ministry sources have clarified the scope of the Budget 2026 tax holiday for global cloud service providers. Sources say that using Indian data centers will not expose foreign companies' global income to Indian taxation. Timsy Jaipuria is here with the details.
The Finance Ministry has issued a crucial clarification on the data center tax holiday announced in the Budget 2026. The aim is to remove tax uncertainty for global cloud service providers using Indian data centers. According to Finance Ministry sources, the exemption is meant for foreign companies providing cloud services globally, including in India, and is strictly limited to income arising from procuring data center services from India. Sources say the 4 key conditions must be met under this. First, the foreign cloud service company must be notified by the government. Second, the data center from which services are procured must be run by an Indian company. Third, the data center must be notified by the Ministry of Electronics and IT. And fourth, any cloud service provider provided to Indian users must be routed through an Indian reseller entity, which is also an Indian company. The big key takeaway here is that there is no risk of the foreign company's global income being taxed in India simply because it uses Indian data centers. This is a significant assurance for global cloud majors who have been wary of potential tax exposure. However, domestic economic activity remains fully taxable. Profits earned by the Indian data center company for services provided to the global entity must be taxed in India. Similarly, profits earned by the Indian reseller from selling cloud services to Indian customers will also be taxed like any other domestic company. Sources say if the Indian data center is a related entity of the foreign cloud company, such as a cost-plus captive unit, a 15% safe harbor margin has been provided to reduce transfer pricing disputes too. Importantly, the tax treatment remains the same whether the data center is Indian-owned or a subsidiary of the global entity, ensuring a level playing field. The clarification is expected to boost confidence among global cloud players and strengthen India's push to become a global major in the data center hub, with Indian operators now able to offer services without triggering tax concerns for their international clients. The finance minister, in an exclusive interview, also had told Network 18 earlier that after the budget, she said that Indian companies with a global presence that fit the parameters will be eligible for the tax holiday.
Global companies, if they are Indian in origin, will also have to have their profits and other things understood, global profits, profits made in India. And most of these global companies who are setting up business in India are already also paying tax. It's not as if they are not being covered by taxation for the earnings that they get from India. So if anyone who fits into this definition, not just this, you've very clearly defined it. So referring to that definition, whoever fits in will get it.
West Bengal Chief Minister Mamata Banerjee appeared before the Supreme Court to make oral submissions against the special intensive revision of the electoral rolls in the state. She became the first sitting Chief Minister to do so. Banerjee raised concerns about the appointment of over 8,000 micro-observers from BJP-ruled states, alleging that they are deleting names from voter lists and superseding powers of booth-level officers. She claimed that many living people, particularly women, have been wrongly declared dead. Banerjee also questioned why West Bengal alone was being targeted, calling it an attempt to bulldoze Bengali people. The Supreme Court has issued a notice to the Election Commission on Banerjee's plea and will resume hearings on February 9th. The Supreme Court has pulled up the CBI and Enforcement Directorate for delaying a probe against Anil Ambani for allegedly siphoning off over 40,000 crore rupees. Court has ordered the ED to form a special investigation team. Ashmit Kumar joins us now with more. Ashmit, please take us through what the Apex Court said.
Well, the CBI and the ED confirming to the Apex Court that they've launched investigations into siphoning off of funds, alleged siphoning off of funds of over 40,000 crore rupees by group companies of the Anil Dhirubhai Ambani group. And to that end, also clarifying that as a part of their investigations, they've already made a few arrests and they've also attached properties north of 12,000 crore rupees. Now, all of this was in response to a PIL that had been filed by E.S. Sarma, former government bureaucrat, who had flagged as a part of this PIL that the banks had learnt about siphoning off of the funds as far back as 2020, but that the investigations were launched as recently as 2025. Now, the Supreme Court took note of this delay and frowned upon it, questioning as to why there was such a long delay for the investigating agencies to spring into action. But now that the investigations have begun, the court said that it will be monitoring, and to that end has directed the ED to constitute an SIT, a special investigation team, also clarifying that this investigation needs to be fair, but at the same time needs to be swift, needs to be prompt. Not just that, the Supreme Court also adding another caveat that as a part of this ongoing investigation, the ED CBI must also probe any collusion, conspiracy by bank officers. That is also something that the CBI has brought into the fold. As far as Anil Ambani is concerned, well, CBI ED also confirming that they've issued a lookout circular against Anil Ambani to ensure that he doesn't flee the country. But to that end, his counsel Anil Ambani also clarifying that without informing the court, Anil Ambani will not be leaving the country. And finally, the Supreme Court saying that this is a matter that requires close scrutiny, and to that end, asking for monthly status reports to be filed by the investigating agencies.
Right, thank you, Ashmit, for that. Moving on, 3 minor sisters died after jumping from the 9th floor of their Ghaziabad home early Wednesday. Police have alleged that the incident occurred after their parents objected to their gaming addiction. A suicide note and an 8-page diary were found with the girls apologizing to their parents. Investigations are currently ongoing. And with that, it's a wrap on this special broadcast. Thank you for watching. Stay tuned to CNBC TV 18.
The Wall Street gains for the third straight session. The Nifty ends above 25,750. Broader markets outperform. IT stocks take it on the chin.
AI disruption fears rattle tech and IT stocks worldwide. Anthropic releases a new plugin to automate specialized tasks and workflows for companies. The Nifty IT index plunges more than 6% to mark the worst fall in 6 years.
Hindustan Aeronautics falls nearly 6% after reports indicate that it is out of race for AMCA's fighter jet program, which was expected to be the front runner with two other smaller firms. Analysts don't expect any material impact on its financials.
Fractal Analytics is eyeing a scaled-back valuation of nearly 15,000 crore rupees for its IPO. This comes after it trimmed the IPO size by more than 40% as initial expectations of a rush for India's first AI company offer tempered.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the key data points to gear up for the trading next day while recapping trade today. I'm Mangalam Malu, with me, Ritu Singh. Ritu, has a very good day of trade from a bull standpoint. After a big move that we saw yesterday, and then there was the overnight fear on, the IT sell-off. This morning we saw the IT index close, or rather open lower, fall further lower, and despite that, the Nifty actually ended about 50 points higher. So give or take everything, we've done a lot better than what the street was preparing itself for. We actually gained about 200 points from the lows, and that was led by Reliance. We saw the Nifty bank outperform, and at the same time, towards the end, the IT index as well, which at one point was down by about 7.5–8%, recovered about 1.5% from the lows. So did not pressurize the market so much. Yes, that line is big shade of red, but it wasn't 8%. It was down just 6%.
Yes, it's the big names that pulled the market up. Reliance is one that alone contributed, the most to this uplift. And then you had ICICI Bank and Eternal that also pulled in their weight, in the last couple of hours of trade for the Nifty to close 50 points up. The IT pack here down almost close to 6%. But you had the energy, metal pack, auto, realty, all of them, pull their weight through the course of the day. Now, over the next few minutes, we're going to get you all of the big news and the key developments that took place today, the top corporate voices and events that we're going to be tracking ahead. Let's start the day with the, with what we've told you about the markets, but also recap what we have in store for you in the next 30 minutes. We start with the top movers and shakers of the day with Hormaz Fatakia, and then we'll break down the sharp sell-off in the Indian IT stocks following Anthropic's latest AI plugin launch. We'll also put the spotlight on HCL, which slid more than 5% amid reports that it could be out of the race for the AMCA stealth fighter jet program. Last but not the least, we'll also take you through the key market events to watch out for in tomorrow's trading session. So on to our first segment of the day then, Mangalam.
Yes, let's go across to Hormaz, who's standing by the big wall to tell us about all the movers and the shakers of the day. There were far more gainers than losers. Hormaz.
They indeed were, and what a day it was. You look at the first plate and you would wonder that the markets would have had a bad day today. Because look at Infosys down 7, TCS down 7, Persistent, Coforge, HCLTech, all of them selling off. No IT stock today ending with gains. But if you look at the other plate, it will tell you why we had a good day. Despite this first plate and the recovery in the Nifty, the gains on the index, despite the sell-off in the IT names were led by all of them. ICICI Bank, Reliance, Bharti Airtel, HDFC Bank, L&T, the heavyweights putting their hand up in today's session and ensuring that the Nifty downside A is capped and then B recovering and then ending the day higher than what the market eventually feared. The earnings reactions continue to move in as we count down towards the end of the earnings season. Lloyds Metals was up 10, Sheela Foams 15, Carousel came out with results just a few minutes earlier, as did Imami. Imami at one point was up almost 7% and ended up giving up all of those gains, and Teamlease too, after that initial 10% pop, gave up some of those gains to end just 4.5% higher. The rebound in oil prices has again put ONGC and Oil India in the spotlight. ONGC gaining 4, Oil India also ending 4% higher today. And Siemens Energy did well, as did Indian Oil Corporation, despite the rise in oil prices. And lastly, some underperformers in today's session, barring IT. You spoke about HAL. We'll talk about that more as the show goes by. Triveni Turbine is an earnings reaction. Sai Life Sciences didn't do so well for itself, 8% lower, and Latent View too, seeing some bit of a selling pressure today, 8% lower on this stock as well.
Thanks, Harmas, for taking us through that exhaustive list. Let's go across to our guests then. Mayuresh Joshi, Director of Research at MarketSmith India, is with us, and so is Somil Mehta of Mirae Asset Sharekhan. Gentlemen, thanks very much for your time here. Mayuresh, let's get your view on the IT pack. That was, the story of the day. A bit of an underperformer all of last year. With the correction that we have now, do you see some pockets of opportunities to buy quality names?
Afternoon, Riti. I think we'll still wait and watch. I think what has happened yesterday night, I think, is just an example of what is expected to happen over the next few months and quarters as well. And therefore, I think as the processes evolve on the products and the platform side, as far as AI is concerned, not just in the US, you're seeing fabulous strides being taken in the China ecosystem as well. And therefore, I think competition is going to brew up pretty thick and fast. Having said that, our traditional IT businesses will need to cope up in terms of the AI ecosystem, the Substack ecosystem as well. And they have to gear up pretty fast because I think the entire world is probably gearing up on that front. Obviously, I think in terms of expectations on how results have been so far, results were very much in line with estimates as far as large cap players are concerned, whether it's constant currency, revenue growth expectations in terms of the EBIT guidance that has probably been given. And similar is the story for mid-cap IT companies. Therefore, I think the distinguishing factor in terms of valuations for large cap being a tad bit better than mid-cap, but the intensity, both in terms of AI, pricing related intensity, as well as competitive pressures, I think that might still continue to plague a significant amount of earnings growth as we head into the next few quarters. So I think we're maintaining a neutral view. On the sector, we've maintained that for a very, very long time, to be honest and honest.
Right, a couple of these consumer discretionary names did extremely well today. The top Nifty gainer was Eternal. The second one after that was Trent, ahead of numbers, up 5%. We saw some traction in Titan as well, up 2%. And from the broader markets, a lot of these QSR names, Devyani International did well, 6% higher post results. Following Devyani was Sapphire. These companies are on the path to merger. So because Devyani moved higher, Sapphire followed suit as well. Good time to welcome Somil Mehta as well. Somil, what do you make of the price action today? We had all the reason to go down, but the resilience kept it up. We were up around 50 points by the end of the day.
Absolutely. Good afternoon to everyone. We are holding to 40 and 20 daily moving average now. We've seen a very good bounce. We've seen a very good, breakout of a, consolidation, a sharp correction as well. So I think we will stay around these levels. We'll consolidate around these levels, but the overall structure still remains positive now. As we have gapped up above very crucial levels, 20 and 40 daily moving averages around 25,470 and 25,620. So these are the two levels which I'm looking for. And now there are stock specific action, like very beaten down stocks have started moving up, like Trent, Dixon, TI Industries, TI India, DLF. All of these stocks have started moving up, which is showing a lot of strength in the market now. So I'll be positive. Buy and decline should be the strategy, and my targets on the upside in a very short term would be 26,000, but I'll be looking for new highs very soon.
All right, you're looking for new highs very soon, and for those new highs to come, the IT index actually has to perk up as well, because that index fell almost 6% today after Anthropic released its latest AI plug, which spooked the IT stocks across the board, not only in India but globally as well. Rima joins in to tell us what was ailing these stocks and the impact that it could have on their earnings.
Indeed, it was a very sharp sell-off across the IT companies. Just to take a step back and understand what happened. Now, Anthropic released 11 new plugins for its Claude Co-work agent. This is basically agentic AI for different types of work, for legal work, CRM work, etc. And Claude is not sold as a standalone AI company. It's being built directly into the platforms enterprise already use. So the fear is of disintermediation. Now there are many companies which sit between an LLM and an enterprise. They use the intellectual abilities of the LLMs, their power, and help analyze enterprises' data because it sits in the middle and comes out with solutions. But this work can be done by an agentic AI. So the fear is that what happens to that middle layer? Is there a risk of disintermediation? If not completely replacing it, but can it pressurize their revenue pools? Can it cause higher than expected deflation? Then are the valuation multiples justified? And even Indian IT companies do earn a certain amount of revenues by implementing customization, integration and maintenance of this enterprise software. So which is why across the technology stack, yesterday they were sold off. Companies which provide legal services, tech companies which provide legal services like that by, Thomson Reuters, LegalSet sold off. Data analytics companies like Morningstar, FactSet sold off. SaaS companies like ServiceNow, SalesNow sold off. Global IT companies, Accenture, Cognizant under pressure, and now you can feel the ripple effect across the Indian IT companies, and it comes at a time when the sentiment surrounding the Indian technology majors has already been hit.
All right, Rima, thanks very much for that. Now, artificial intelligence firm Fractal Analytics is all set to make its market debut next week. Now, this is going to be India's first pure-play AI IPO. The company has, however, cut its IPO size by more than 40% to 2,834 crore rupees versus about 4,900 crore rupees that it had initially proposed. Now, the company has also set a price band of 857 rupees to 900 rupees a share. Speaking to CNBC TV 18 earlier, its management spoke about the disruptive force of AI. Take a look at that, and then we'll get our guests in to weigh in on this IPO.
We are the disintermediating or disruptive force that's saying that your existing technology stacks don't do a good job. Use AI to power decisions directly using these models. So we feel we are the disruptive force right now. They will see this is such an evolving space and such a large space. There'll be multiple players, multiple winners doing multiple things. And so Fractal's focus is enterprise AI, which is the hardest part of AI, is translating enterprise AI excitement into enterprise performance. The biggest companies in the world that have complex software structures and databases and so on, and hundreds of thousands of users driving decisions inside companies using AI. So that is a space that is currently not yet taken off in a very significant way. So that was also, in that terms, there are very few companies in the world that understand it.
All right, so that's about Fractal Analytics. Mayuresh has spoken about IT already. Mayuresh, your view on Hindustan Aeronautics. In fact, we'll get in RIA first and then get your view on Hindustan Aeronautics and all the defense stocks post the budgets for announcement of around 20% increase in defense capex. Hindustan Aeronautics tumbled nearly 6% today after it indicated that the company could be out of the race to bid for AMCA's 5th generation stealth fighter jet program. They had been widely expected to lead the project along with two smaller partners. But Riya Bhatia joins in to tell us whether that's a negative for the company or not. Them getting this could have been a positive, but them not getting this is not a negative because analysts are not factoring anything from this, is it?
Well, yes, Mangalam, as you rightly said, HCL has been knocked out of the bidding race for the AMCA jet program. Now, this is as per industry reports that have been confirmed by analysts, and up until now, HCL was expected to be the front runner for this program along with the two smaller firms with which it had bid for this project, and which is why the street is reacting so negatively to this, because up until now, they were expected to be the front runner for this, and this will also be the first time that HCL will not be involved in one of the country's most significant military projects. Now, in terms of the other companies that have bid for this, that includes Tata Advanced Systems, Adani Defence, along with MTAR Technologies, L&T and BEL, and even Bharat Forge, along with BEML and Data Patterns, among some other companies. And as per reports, 3 of these companies have been shortlisted, and within the next 3 months, a final winner is expected to be declared. Now, the AMCA project, for this, around 15,000 crores have been allocated for the prototype development phase of the project, and the total project has been valued at roughly 1.5 to 2 lakh crores. So this is a very significant project. But in terms of the impact for HCL, analysts believe that this is only sentimentally negative for the stock, and they do not expect any material significant impact on the financials of the company. Keep in mind that the order book of the company as of the end of FY25 stood at roughly 1.9 lakh crore rupees, and they are also expected to close this financial year with an order book of roughly 2.5 to 2.6 lakh crore rupees. So they do have a very strong, healthy order book that provides them with revenue visibility for the next several years. But nonetheless, the stock took a big hit in today's trading session, down nearly 6%.
All right. Thanks very much for bringing us that, Riya. Mayuresh Yoshi and Somil Mehta still with us. Mayuresh, any thoughts, before we get to the defense names, on Fractal, the first pure-play AI company coming to the market, and the fact that it had to cut its IPO size? What does it tell you about the kind of demand there could be?
So very interesting. In fact, we spoke about IT, and I think what Fractal Analytics probably does is it has this AI solutions bounded with specific domain-related applications, and therefore I think Fractal.ai is something that has its agentic AI platform by the name of Cogentic, which probably expects a lot of integration tools to probably come through with low-code capabilities. And the other product, which is Fractal Alpha, considering of getting deployed across markets, across geographies, and across applications. So in a time when Anthropic has played havoc yesterday, I think this is going to be a very interesting proposition. The size has been cut down. I don't know the reasons behind that. But yes, I think looking at AI, the AI dominance that is expected, I believe that this should receive a very good response as we head into the IPO.
Right, and the defense stocks, Mayuresh.
So largely, I think as a summary, I think order books are quite robust. The book to bill is spread over the next 4 to 5 years, to say the least, and therefore revenue visibility is a given. The new orders that are coming through are orders with decent margins and fixed time execution capabilities, which probably means that as they execute well within a definitive time period, the working capital needs probably go down that bit, which helps in improvement of cash flows and return ratios. So as a space structurally, I think the allocation of more than 20% in this budget, extremely positive. Export markets is a big thing that is opened up and is expected to open up for a large part of these players. And therefore, I think if you're holding qualitative stocks like a BEL as an example, BDL, Maska, Cochin, investors should continue.
All right, Mayuresh and Somil, thanks very much for joining us here today, and we'll see you hopefully bright and early over the next few days. Up next, we have SEBI Chairman Tuhin Kanta Pandey, who's called for deeper liquidity in the cash market, highlighting the importance for India's market structure. Now, he added that the STT hike has widened the gap between cash and derivatives trading. Take a look at what he had to say.
Liquidity improve करना हमारे जो मार्केट में कैश मार्केट में वो बहुत इम्पोर्टेंट ऑब्जेक्टिव है हमारे लिए, क्योंकि उससे बहुत सारी जो लिक्विडिटी की इश्यूज, लिक्विडिटी टर्नओवर बढ़ने से मार्केट की जो स्ट्रक्चर है वो इम्प्रूव होती है. कि जहां आप एसटीटी की बात कर रहे हैं उसमें भी थोड़ा सा ज़्यादा डिफरेंशियल भी क्रिएट हुआ है बिटवीन द कैश मार्केट एंड द डेरिवेटिव्स मार्केट.
All right, with that, we'll take a short break, come back, get you the top corporate voices that joined us on the channel, along with the key market events to watch out for tomorrow on the other side.
Welcome back. You're watching Markets Forward, and it's time for us to take stock of all the big corporate voices of the day, starting with IndusInd Bank's MD and CEO Rajiv Anand, who told us that it's, their gems and jewelry book has faced some strong headwind in the last 12 to 18 months. This was because of a sharp drop in post-COVID buying from China. He said the bank has not really seen any stress build-up in the segment, and the book has largely remained flat and not grown. He added that the risk on the MSME book because of tariffs was muted and expects going forward to improve post the US trade deal agreement.
We also had the management of Pidilite. The stock was higher post their numbers. They say they will continue to push for growth above 10% as it targets double-digit volume growth. Exports were impacted in the third quarter. They believe that it could have been about a 12% growth on a consolidated basis as against the reported 10%. They expect to maintain their margins at the higher end of that 20 to 24% range. And the construction chemicals business, ROF and Dr. Fixit were the standout performers in the third quarter.
And Hyundai Motor India's Tarun Garg expects the fourth quarter to be significantly better than the third one. A strong momentum continues. He says the company is confident of outperforming the industry growth of 5 to 6% in FY27. Now, while exports remain a key growth driver, Garg adds Hyundai is exploring opportunities in the EU following the recent FTA. This as it looks to raise export contribution to 30% by FY30 from the current 24%.
All right, and before we wrap, let's go across to Upasna, who's joining in with all the key events that you need to watch out for tomorrow. Upasna.
Well, first up, let us look at the important list of results for tomorrow. Companies like LIC, Hero MotoCorp, Mazgao Dog, Berger Paints, Bharti Airtel, Keynes Technology, PFC, RVNL, all these counters will be reporting their Q3 FY26 numbers tomorrow. Now, let us look at some of the key stocks that will be in focus on the back of corporate action. Stocks like PB Fintech will be in focus on the back of fundraise via QIP. JB Chemical and Pharma, RVNL and PFC will also be in focus as the board meeting is scheduled for tomorrow to declare interim dividend for FY25, FY26. Now, let us look at some of the key other important events. RBI OMO purchase will take place tomorrow, and the second tranche of 50,000 crores will be done tomorrow. Also, tomorrow marks as the second day of the RBI MPC meet, and the outcome will be out on Friday. Also, mind you that the 100% FDI and insurance sector will be effective tomorrow onwards. Now, let us look at some of the important global cues. US will be reporting its initial jobless claims data.
Well, and Upasna, thanks very much for prepping us for that power-packed day. Mangalam and I take your leave now. We'll see you tomorrow. But stay with CNBC TV 18. More news and updates will continue right here.
Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. What an absolute roller coaster week it has been in both global markets as well as, of course, local equities here. From the commodity crash to the Union Budget 2026 to finally the India-US trade deal getting done. The news flow has been hectic and the price action has been confusing. So how do you think about investing in this fast-changing landscape where traditional market correlation models are being challenged every day, where commodities are moving like micro-cap stocks and currencies are moving like mid-caps? Well, joining me today on the show are Axis Mutual Fund's Shreyas Devalkar and Ashish Nayak. Shreyas is, of course, the AMC's head of equity, and Ashish has been managing equity funds for many, many years now. Gentlemen, thank you so much for joining in. It's been an absolute crazy, hectic week, right? Not just a week, last couple of weeks, actually, right from maybe the start of this year. So let's begin there. I'm sure you all have been watching the volatility as well. So what thoughts so far into 2026? Shreyas?
Sure, it has been a really eventful year so far. It's just 1 month or so. But most importantly, it is more because of the trade deal finally getting signed. And that's where one of the key expectation for this year has been for the equity, because we have seen a lot of FI outflow in last year and a half or so. So this event definitely is most important from our point of view. We need to get into details as to what are the further contours of this deal. I think it will emerge eventually. But the good news is, yes, now we are almost at par with the peer country as far as tariff is concerned. It will actually lead to now the start of decision-making process. When someone from other countries, if they wanted to invest into India, set up plan, or do Make in India, in that process, there was a halt in that decision-making. I think this deal will definitely lead to the decision-making on that front.
Okay. Ashish, let's get your opening thoughts as well. So far, 2026, how's it going?
Yeah, I mean, so 2026 has been a year that is, I would say, started at a much better footing versus 2025, largely driven by domestic demand support, policy support. We had the GST rationalization, we had the tax cuts last year, and as such, the bottoming of the earnings cycle, which I think for the last 1.5 years before that was continuously seeing downgrades. In general, from the macro setup, inflation being benign, monetary policy being accommodative, fiscal measures that are supporting growth are also something that 2026 has seen as a positive. On the valuation side itself, we have seen a decent correction versus our emerging market peers. So that's something that really boosts India's chances of outperforming and moving in line with the earnings cycle, which can potentially be double-digit growth from here on for the next few years. So a decent support, I would say, from a 2026 versus 2025 that we saw.
So, gentlemen, let's start from the basics, right? The central point of all conversation on investing, which is, what is your goal? Where are you going? And therefore, what is your asset allocation? What is it that you're seeking? And I think that gets lost most of the time in our investing journey, right? Either people are all in equity, and then what we realized when the equity market was not doing well for 12 months, people decided that, okay, it's time to latch on to gold. And a lot of people did buy those ETFs as silver was surging, gold was surging, only to be very disappointed again when the crash happened just a couple of days back. So let's start with investing 101, Shreyas, because that question is going to be asked again. Now that there is a trade deal in place, let's go all in back to equities, right? It's just human investing psyche. How do you overcome it? And what would your opening message be to investors?
If you take last 2 decades more so, most of the money was made in the financial assets, right? And that's where the financialization of saving is what we was driven over last 2 decades or so. But now, if you think about the recent development worldwide, the important development being debasement trade, which is happening, which has led to the importance of real assets as well. And that started first with the gold, then that thought percolated to silver and then other basic materials, and then even there are thoughts around crude as well. So this real asset rally, which is at the core, in my opinion, of it is the debasement trade of dollar. So that has led to the opening up of other asset classes as well, in addition to the equity. So in my opinion, as an investor, and especially the investor based out of India, we need to have a balanced exposure to multiple asset classes. So if we start with Indian equity, obviously India being the fastest growing economy, Indian equity has to be the largest portion of your investment. But in addition to that, because of the global developments what we spoke about, there are opportunities as far as allocation is concerned by way of gold or any other dollar term asset class. It can be foreign equity as well. So the portfolio can be made complete by having exposure to all these 3 to 4 asset classes, including the fixed income. And to look at it that way is now more important in this the world the way it is shaping up.
Okay, fair point. So, gentlemen, okay, let's put the spotlight on equity, because that's what both of you look at very, very closely. And again, the opening thought is going to be whether, you know, I had some guests, and I look at day-to-day markets as well. So there was a guest who declared that the equity bear market is coming to an end. So I don't know if that's true or not. I don't know if you believe that. First of all, I don't know if it was really a bear market, because at an index level, the index still was up. In 1 year returns, index is still higher. It just depends on the kind of stocks you were in. And if people were in those small caps and mid caps that fell 30, 40, 50%, sure, it felt like a bear market. So Shreyas, first of all, let's qualify where you think we are in this market cycle. Bear market, mid market, normal market, neutral market, where are we?
I would not call it as a bear market of last 2 years what happened. Actually, last 2 years was more of the correction of valuation excesses. Actually, post-COVID, for multiple reasons, many businesses showed supernormal growth because of supply chain constraint, because of commodity prices, etc. So there are multiple reasons for multiple sectors. And because of that good growth, the market actually related the individual companies a lot. And that's where that reset of the valuation had to happen. So I would call it more as a consolidation, and I would call it as a reset of the valuation. Because if you compare the valuations, maybe 24 compared to the pre-COVID, in many cases it was upwards of 30, 40, 50, 60, even 100% premium compared to the pre-COVID valuations. So that had to get corrected. And in my opinion, that reset is happening either by way of absolute correction or by way of time correction, the way we are observing at the overall market level. So this, in my opinion, is a healthy valuation correction which we are undergoing. And because the long-term returns of any market is closer to nominal GDP growth, so if you assume now, as per budget, 10% nominal GDP growth, which we are expecting. So generally, the listed names gives you plus minus 2% return, and equity returns can be additional plus minus 2%. So that kind of return profile is what is return expectation is what is to be considered in mind while investing in equity. While if you just go back in 24, the 3-year CAGR returns were upwards of 20%. In mid and small cap, actually it were upwards of 20-25% also. So that kind of returns were very high. And from that standpoint, they had to get corrected. In my opinion, now that broadly that correction is getting closer to the end, especially in the large cap, definitely the valuations are reasonable now. In mid and small cap, I don't want to separate it out as a mid and small cap, but in there also segments are emerging now with a reasonable valuation. Though as a pack, in my judgment, still it is at a relatively high valuation.
So you're saying mid and small caps still look overvalued in some pockets. Ashish, just talk about just the market perspective from here on, and I think that is the biggest question in front of investors. Many people kept saying, as we got into this valuation correction zone, that look, large caps are better placed. But as a habit, we Indians have always loved our mid and small caps, right? Because we think that's where the money is, that's where the alpha is. Now, that whole theory was challenged throughout 2025. Now we're in 2026, and I think that's the starting point for a lot of people, because they realized they were wrong. If they didn't pivot back to large caps, they missed out. And then they felt it's like a bear market. So I think 26 starting, that is the question. What should my allocation be between large caps and SMIDs, as they're called, small and mid caps. Ashish, your thoughts?
Absolutely. So yes, I mean, we saw, as Shreyash also mentioned, valuations had to sort of take a correction. And that's what we really saw throughout the year in 2025. Because we had seen a great rally before that across large and especially mid and small caps, the valuations in the Nifty, if you see, were much more reasonable over the year, and hence the corrections in large caps, rather the movement in large cap was not as bad. But having said that, our premium to the AM peers was obviously much higher at the start of 2025. And that actually came down to the long-term average. So to that extent, even the large caps, from a global perspective, from a global investor's perspective, have become reasonable. On the other side, on the mid and small caps, they were expensive. And even now, the indices still trade at a much higher premium to their long-term valuation. And they're at a higher standard deviation also at this point of time. So obviously, there are valuation pockets which are still expensive. The expectations is where the disappointments have come in the last 12 to 18 months. And hence, we have seen more and more corrections in these pockets. Market being much more focused on near-term growth, on the fact that overall growth has been relatively lower, means that even good quality companies at various points of time have seen higher correction in their valuations if they have not been able to deliver the numbers that are expected out of them. And hence, this is something now things are getting better on an overall market basis. As I mentioned earlier, the bottoming of the earnings cut cycle is visible. And hence, from here on, one can look at large caps much more focused manner. And in the mid and small caps, there will be selective positions that one can take. There are beneficiaries of various events that have happened even in the last month, even in the last couple of weeks, where, let's say, helped by the budget from the capex allocation perspective, some sectors have become more attractive. Also, we have seen there are areas in consumption which have been helped by the GST cuts as well as the tax cuts that happened last year. So mid and small cap can be an area which can be looked at from a selective basis, and exposures can be added where the valuations, as we call it, growth at reasonable price, have come in, or reasonable valuations.
Okay. All right. We'll take a quick break on that note, gentlemen. We'll come back on the other side, and then we'll get the portfolio call, the portfolio queue, because the gentlemen on your screen are actually quite favorably inclined towards Indian equities in 2025. So we'll find out what makes them bullish, and also what should the overall portfolio construct be as we're looking at our plan for the remainder of this year and the next couple of years. Back with that in just a moment.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are getting the Axis Mutual Fund outlook on 2025 and why Axis Mutual Fund believes that this is going to be a good year for equity investors, and then therefore what should your strategy be? Well, we've got, of course, Shreyas Devalkar with us, along with Ashish. Shreyas, so let me actually start right there. And you mentioned a couple of points. Let's narrow them down. What makes you believe that 26 is going to be a good year for equities and that people should not keep chasing gold and silver and copper and everything else that they tried chasing towards the end of 2025?
Sure. So as far as equity is concerned, obviously always why equity asset class has been preferred more because of the inherent nature of companies and companies, the way they grow along with the nominal GDP growth. To start with, nominal GDP growth, if you look at the budget, last year's was 8% and next year's is expected to be 10%. The companies tend to grow higher than the nominal GDP growth for multiple reasons. And if you take even that view, then next year, obviously, the earning growth is expected to be higher than the last year. So general consensus earning growth for next year is somewhere around 13 to 15% YOY growth compared to a high single-digit growth in last year. So that to begin with. Second aspect is when you look at multiple actions taken by the government as well as the regulator, and we are now seeing its benefits. Already multiple action taken by the RBI on the liquidity front, the rate cut front, and already we are seeing good liquidity in the system. We have actually started noticing that credit growth for the system has started inching up. In last 3 to 4 fortnights, actually the credit growth has started moving up. That is also helped by liquidity in the system. And that actually is one of the large sector or the segment by weight in the market. So if that segment moves up, then definitely it is a good tailwind for the market. Apart from that, if you take other sectors like consumption. Now in consumption, for multiple reasons, many sectors have seen lull over last 2-3 years. In this case, GST along with tax cut, and that impact we have already seen in the auto sector. Other sectors, there could be some delay because there is no one-on-one correlation directly to the GST cut because of the ticket size and there are multiple things in that. But all in all, in my opinion, a good part of consumption is also expected to improve from here on. And more importantly, the recent cut in the tariff, the investment part or the capital goods part, as well as the manufacturing part of the stock market, that actually was facing some lull again in terms of performance in the last 1 year or so. Here, there are multiple companies, though the exposure to US may not be very high directly, but there are multiple companies that have said that they have a potential to export. And when there was uncertainty on these tariff issues, the decision making was not being made. And now with this easing of the process, I think more and more decision making will happen. So even that part of economy will open. So when you see the multiple part of economy, when they start doing well, so the exports, the consumption and investment, that is the time when equity generally tend to give good returns. So the construct of the economy is such that yes, there is a good possibility that this multiple part may start delivering a positivity. In certain cases, the timelines will be elongated. So like in case of investment or if FDI coming in exactly to set up a plant in India, it may take some time. But then one need to be patient with that because these are not decisions like the FII. The FII flows, one can expect that there can be, and especially we have seen now recently that there is a good number which we saw yesterday. But when it comes to FDI, it generally takes some time, and that's where that investment and that translating into the economic growth, it takes some time. So if we are patient with this, then I think we can get good returns from equity.
Sure. I mean, that makes a lot of sense, absolutely. Ashish, on this, so that's a strong case for equities. You gentlemen have also laid out that it probably is going to be wise to, keep, a significant part of your investment in large caps within equities. Now, I just want to, come to also the question of sectors, and we only have 2-3 minutes left on this conversation. And sectors are always tricky. I mean, if you want to play a theme, either through direct stocks or through sectoral funds, then would you want to call out anything specifically for 26? And also throw in a word on foreign equities. Because again, what the last couple of years have told us that diversification is always maybe a good idea. But now, given that everything's going on, question marks on AI, question marks on, larger tech companies, could that be a risky bet? Looking at just a diversified, S&P 500 sort of a play when it comes to global equities, advisable or not?
Absolutely. So on sectoral plays and especially thematic funds, we are clearly of the view that there is clearly a position in every investor's portfolio for these kind of funds. But one has to realize that these are plays, for instance, let's say a business cycles fund or an innovations fund. These are plays on specific themes that can take some time to sort of materialize in the portfolios. Even something like a consumption, manufacturing, or services. These are also themes which have various sectors into these funds, and one can clearly have positions in these thematic funds over a period of time. What is important is to know that these themes, because they are slightly more concentrated than diversified funds, they generally should be held for at least 5 years in the portfolio. At this point of time, as Shreyash also mentioned, consumption is something that also is seeing a boost by the policies that the government has come out in the last 12 months or so. Capex is something, or let's say manufacturing for that instance, is something that had done well till about 1.5 years back, has underperformed to some extent because of the higher valuations and also some of the higher expectations that the market had, which were not delivered. Now, with the signing of or reduction of the tariff, there is more clarity on that front, potentially FDI that can boost that area of the market, and hence manufacturing and capex-led theme also can be something as an interesting point, but with a slightly medium to long-term outlook. On services, we are still seeing good growth across the board, including the fact that banks and financials, especially lenders, are a bigger portion of that portion of the thematic market. And hence, there also one can actually keep holding for a steady returns at this point of time. So yes, I mean, thematics are interesting. They should be part of the portfolio, but with a slightly longer term outlook. On your question on the whether we should look at global funds at this point of time, yes, I mean in the last 12 months, Indian market valuations have corrected, and hence that makes India more attractive versus, let's say, 12 months back. But still, Indian markets and even the US markets are one of the most expensive in the world. At various points of time, because of various disappointments, let's say earnings-led disappointment, geopolitical-led events, we have seen some bit of correction in higher valuation sort of across the world. And then some of the lower valuation markets, especially on the emerging market side in the last 2 or 3 years, have given stupendous returns. So one can have a diversified outlook to these kind of peer sets where growth is reasonable,
so
valuations are much more profitable.
Ashish, sorry, I'm cutting in. I'm so sorry because we're out of time. But let me ask you this. I have 100 rupees to invest today. How much should come in Indian equities? How much US? And how much if you want to call out any other global equity market? Or all 100 in Indian market? Your call. 100 rupees.
Right. I think one of the interesting markets other than India and US, obviously US is US diversified market is very interesting. It is something where you can see growth being broad-based, which was not the case over the last few years. So US equity markets other than India would be a place I would go to. Maybe if I have to put 100 rupees as an Indian investor, I would look at maybe 60%, 70% in India, maybe another 10 to 15% in US. Another market that I really find interesting is China, where there are technology plays that are doing quite well. That as a market and as an economy is a challenger to US in various aspects. And there, I think another 15% can be looked at, where valuations are reasonable and their growth can be reasonably better.
Okay. All right, gentlemen, thank you very much. Very interesting conversation, and I'm sure it's going to be useful and helpful for all of our viewers. Thanks for joining in with your Outlook 2026. So it should be positive for equities, especially Indian equities. That is the big takeaway from this conversation. Well, with that, we're completely out of time. Thank you for being with us on the show this week. See you again with another theme in another few days.
Let's talk money.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Clean label health food brand The Whole Truth has raised about $51 million in a Series D round led by Sofina and SoftVC. The fresh capital will be deployed to expand in-house manufacturing capacity, strengthen working capital and build internal systems required for public market readiness.
Climate tech startup Varaha has raised $20 million in the first tranche of its Series B round, led by Westbridge Capital. Existing investors RTP Global and Omnivore also participated. The Series B round is sized at around $45 million.
AI disruption fears rattle tech and IT stocks worldwide. Anthropic releases a new plugin to automate specialized tasks and workflows for companies. Nifty IT index plunges over 6% to mark the worst fall in 6 years.
Embrace technology, don't run away from it, says Mukesh Ambani as he bets big on artificial intelligence. BlackRock chairman Larry Fink says there is no AI bubble and the real risk is not investing in artificial intelligence.
NVIDIA's Jensen Huang plays down reports of tensions between the chipmaker and ChatGPT creator OpenAI. Huang says everything is on track and NVIDIA will invest in the upcoming round of fundraising by OpenAI. That's a CNBC exclusive.
Those were the headlines that we're tracking for you this evening, but it's time now for a mega CNBC TV 18 exclusive. Two global business tycoons, Reliance CMD Mukesh Ambani and BlackRock chairman Larry Fink, came together on one platform to discuss the art of investing for a new era. In a 46-minute conversation with Shireen Bhan, the two industry stalwarts spoke on a broad range of topics from India's growth potential to the potential of artificial intelligence. Take a look.
Excites me the most is the startup industry. When I interact with startups and we see young 28, 30-year-olds starting up companies, and I can clearly see, right, 100 new Reliances in terms of where and the aspiration, the confidence that they have. And finally, it is the confidence that you see. Fortunately, we now operate across the length and breadth of India.
I don't believe there's an AI bubble.
You don't believe that?
Not at all. I believe the greatest risk we have is if we don't invest and continue to invest, China will win. And I believe the need to rapidly expand the AI opportunities is necessary. That doesn't mean we're not going to have some bankruptcies. We'll have some failures. That's capitalism. You're going to have some big successes and big failures. But the opportunity that companies have in utilizing AI is going to be present in everything we do. I mean, even yesterday you had Anthropic announce a new model, which is going to be threatening for some businesses, but it's going to be an opportunity for other businesses.
All right, that's the big voice of the day. But fintech player MobiKwik has returned to profitability in the December quarter, posting a net profit of 4 crore rupees compared to a loss of more than 55 crores in the same quarter last year. Their total income also rose 8% year on year. Their payments GMV has also touched an all-time high of 48,100 crore rupees. The user base is now 186.6 million, while the merchant network stands at 4.79 million. Upasana Taku, the co-founder, ED and CFO of MobiKwik, joins us now for the quarter that's gone by and the way ahead. Upasana, thanks very much for being here with us. Begin with the obvious question of what enabled you to get back to this profitability after quarter of a loss, and can you sustain this momentum from here on?
Firstly, it's a great pleasure to be here. Thanks so much for having me, Ritu. Yes, I think that, we always wanted to be a profitable company for the last few years. Few loss-making quarters we have had, but I can tell you that it is not because we ever wanted to be. There was a cycle in the consumer credit business which resulted in a huge sort of degrowth and loss in the financial services business that we have, and as a result the company had gone into losses. But we were determined and we were committed. We had said in our last 2 earnings calls that we will turn profitable in the second half of the year. And firstly, I'm very glad and delighted that we were able to turn both EBITDA and PAT profitable in Q3. And how we've achieved this? Well, Firstly, the financial services business that I was talking about has completely turned around. We have 4x'd our gross profit in this business. We have disbursed 900 crores in personal loans with our NBFC partners, which is an all-time high for us. The margins on this business have also come in strong in Q2 as well as Q3. So now we believe that the credit quality, the quality of the revenue in this business is amazing, and we will grow the business from here, both the disbursals in this product and other products.
Absolutely. And, if you could quickly tell us, revenue from payments grew 7% on a quarterly basis and 14% year on year, right? How do you sort of expect this to grow going ahead? And also revenue from financial services, while it grew 6% quarter on quarter, you saw some degrowth by 11% year on year. So why the degrowth in financial services revenue, and what's the expected contribution from the business going ahead?
Yeah, so firstly, I was going to talk about payments anyway. So our core business is payments. As you know, we've been one of the OGs in the digital payment sector, and it continues to be our strength. It has kept us, it has built the momentum for us. And this quarter, we've reported that yet again, this quarter, we are amongst the top 5 fastest growing apps. We've also moved up from number 17 to number 12 in terms of the consumer UPI transactions that we have processed, which have, by the way, 3x'd, more than 3x'd in this time frame. And this huge growth in UPI that we are seeing is definitely resulting in users then converting to our other payment businesses, which are wallet and bill payments, where again in wallet we are the number 1 player, in bill payments we are the number 7 player, and these are the payment categories where we actually make revenue. And to your point that GMV is growing at a very healthy clip, but revenue is not going so fast in payments. And the answer is very simple. Last year this time, UPI as a percentage of our overall GMV was about 30%, and now it is about 41%. And of course, there is zero revenue on UPI, so it's going to hit the overall growth of revenue. But
well, Upasana, I quickly, because you're talking about payments and UPI, I quickly wanted to ask you about the PIDF impact with the incentives ending on the 31st of December. We heard from Paytm, but what are you seeing on your end? How do you think what was the impact in this quarter firstly, and how do you expect to offset it going ahead? And also the budget allocating barely 2,000 crores for UPI incentives this year. What did you make of that?
So I'll answer the first question first. In terms of both the PIDF incentives as well as the UPI subsidy to third-party UPI apps, that in total is about 1.2 crore per quarter, which is about 0.4% of the total revenue of the company. So as you can see, it's not even 0.5% in our overall revenue pie. So therefore, any changes in terms of the PIDF or any UPI incentive or any government incentive has no bearing on our revenue growth, because it's not worth mentioning in terms of our overall revenue bucket. In terms of the incentives announced in the budget, of course, I welcome the finance minister's incentives for this year, and we do believe that a combination of MDR on some products or to larger merchants, or a format of incentive has to continue for digital payments and UPI to continue to grow at a fast clip in India. Otherwise, the pace at which payments is growing, the cost with zero revenue is killing not just fintechs, but also the bank.
All right. And if you could quickly, in 30 seconds, give us an outlook for FY27 across these parameters: profitability, revenue, user base, individual segments that will sort of lead growth. What is the upcoming year shaping up to look like?
Yeah, great. I think the current quarter numbers are showing the kind of momentum we have in terms of growth across all payment products, whether it is UPI, whether it is wallet, whether it is bill payments. And in addition to that, this year we are also now scaling up the merchant payment business, which we've been building for the last several years. And, we lose money in that business also. Up to 15 crores we lose in building those businesses. And yet, despite that, these are the PAT numbers that we have reported. Those businesses will also break even. So whether it's the offline merchant acquiring, which is devices, rentals, or whether it is the online payment gateway business, these are very small businesses in our revenue scheme. And we do expect that on a full year basis next year, they will also add to the revenue and the bottom line. Lending, of course, we have reached amazing position in terms of the stability of the revenue, the quality of the portfolio performance. And from here on, we continue to expand our growth in that. So next year is going to be a year of growth, but we will be very thoughtful in scaling. We will not chase growth at all costs. And it will be our intention to be in the green, or what is called in the black these days.
Okay, FY27 is going to be a year of growth. That is the message we end with Upasana. Thanks very much for joining us here. Always a pleasure having you. Thanks very much.
Thank you.
All right, moving on. Silicon Valley-based Gatik says it has shifted autonomous trucking into a higher gear, becoming the first company in North America to operate fully driverless trucks at commercial scale with no driver and no safety observer on board. Gatik's autonomous trucks are now clocking daily deliveries for Fortune 50 retailers across Texas, Arizona, and Arkansas, completing 60,000 driverless orders without incident and backed by $600 million in contracted revenue. So is autonomous trucking finally moving from promise to business? I'm now joined by Gautam Narang, the co-founder and CEO of Gatik. Gautam, you know, it's really early for you, so thank you for joining us on Startup Street. Gatik, like I mentioned earlier, is now running fully driverless trucks at commercial scale in the US. No driver, no safety observer. There are several players in autonomous driving, but very few at this stage of deployment. So what's different about the Gatik driver system that helped you move faster to commercial deployment?
Sure. Shruti, thank you so much for having me. Very excited to be here. I'll start by saying this, that Gatik is in the business of autonomous freight. And today we are providing daily revenue-generating commercial service. And this is not a pilot, not a demo. We are operating fully driverless trucks without a safety driver or a safety observer behind the wheel. And we have over 600 million in committed revenue from some of the largest companies in retail, CPG, grocery, to show for it.
Well, Gautam, you know, what you're telling us about 60,000 fully driverless orders, $600 million in revenue. For skeptics, skeptics who still see this as an experimental thing, what can you tell us as the single strongest proof point that, you know, this is commercially viable, it's a real business?
For sure. You said it yourself, which is, you know, our customers are making commitments that are hundreds of millions of dollars, adopting our solution, our technology in real world operations at scale. The fact that we have driverless trucks across multiple US markets in daily commercial operations with some of the largest customers are the proof points that are backing what we are doing.
Right. Gautam, you know, safety is always the biggest concern with driverless vehicles. What did regulators evaluate before clearing these operations, and how do you ensure safety when these trucks are running nearly 24/7 on public roads?
For sure. People should care about safety. We certainly do. And safety is foundational to everything that we do at Gatik. You know, every milestone, whether it's autonomy, hardware, operation, starts with safety for us. And we only went fully driverless after we underwent a very rigorous and comprehensive independent third-party safety assessment. And from a technology standpoint, we have designed the platform to ensure everything is redundant. There is no single point of failure. We have worked very closely with our OEM partners, this is Isuzu Motors, and our technology partners, NVIDIA, to ensure that the hardware is designed to be scalable. And we are proving safety in real-world operations on public roads across highways and surface streets on a daily basis.
Gautam, I'm just wondering if you ever plan on bringing this to India?
At some point, that will happen. And currently, like, you know, we are obviously focused on, meeting the demands from some of the largest customers in North America. Our technology has been proven out for both US and Canada. And obviously, India is a special place. It's close to my heart. That's where I grew up. So at the right time, we do intend to explore international markets.
Okay, and hopefully the roads will be feasible for you to do that, Gautam.
Absolutely. And, you know, Gautam, driverless trucks are changing. Tell us, how are they changing cost, delivery frequency, and shelf availability for large retailers that you work with?
For sure. So it comes down to three things, right? Reliability, economics, and capacity. From reliability standpoint, we are providing very predictable and reliable service on a daily basis for some of the largest customers. When it comes to economics, right, our solution is a core part of our customers' infrastructure, and that makes the return on investment very clear. And capacity is the most important thing, right? So in the US, the freight volume is projected to increase by 50% by 2050. And our customers, they want to move goods more frequently between the warehouses to the retail stores so that the end consumers have what they need. And that's basically where we come in.
Gautam,
yes.
Got that. Gautam, we understand you're in the US and Canada, and you said you hope to be in India. We don't know if that'll happen.
Yes.
But in the near term, in the next 12 months, are there new markets you've identified to enter? Are you looking to increase your fleet with deeper integration with retailers? What are the targets?
So for sure, today we are running 10 fully driverless trucks across 3 markets in Texas, Arkansas, and Arizona. And very soon we'll have a total of 60 trucks. And we expect to end the year with hundreds of trucks fully driverless on public roads in a revenue generating fashion. And that will also allow us to expand to multiple markets, both in the US and in Canada.
All right. Thank you for sharing your growth plans with us. But on that note, I'll have to wrap up our conversation. Many thanks, Gautam, for joining us today on Startup Street.
For sure. Thanks so much for having me.
Well, with that, it's time for us to head into a short break. But coming up, precision oncology company Care bags 90 crore rupees in the first close of its Series B round. We decode the fundraise and the firm's growth plans with the founder on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Precision oncology company 4Base Care has raised 90 crore rupees in the first close of its Series B round, co-led by marquee investors Ashish Kacholia and Lashit Sanghvi. The Bengaluru-based startup is scaling its AI-powered precision oncology platform, OncoTwin, while expanding its hospital-linked genomics labs across India and multiple global markets, with a focus on closing the data diversity gap in cancer care and making advanced diagnostics more accessible. We're joined now by Hitesh Goswami, the CEO of 4Base Care, to talk about the fundraise, growth plans, and what lies ahead. Hitesh, thank you so much for taking time out and being here with us on Startup Street. You know, precision oncology has long struggled with data diversity, right? How differentiated is your clinico-genomic data set today, and how does it sort of materially improve treatment outcomes compared to global benchmarks?
Great to be on the show. Firstly, thank you for having me. I tell you what, from 25 to 2035, we are going to see cancer in a very different way. From it being a mystery, it is going to become a solvable problem. And that is going to be driven by data. But the major challenge is that today, although 70% of the cancer diagnosis globally is from non-Caucasian population, only 5% of the global cancer research data is available from this population, right? And that's the big problem to solve. So it is very important to have local data sets so that we can make more informed decisions based on our own genomic information. And that's what 4Base Care as a company is working towards.
All right, Hitesh, let's now talk about the fundraise. You've raised 90 crore rupees in the first close of Series B. What does this round really unlock for 4Base Care? Take us through the fund deployment plans.
So basically, three parts to it. One is, of course, we want to scale up our hospital-embedded network of labs. We are looking at strengthening our clinical genomics data and AI stack, especially what we mentioned about OncoTwin, which is the world's first oncology digital twin platform, which has been validated not just on our data set, but also we've been selected by Memorial Sloan Kettering Cancer Center in US to validate on their data set, right? So we want to double down on the technology platform that we are building. And third would be accelerating our expansion into the international market.
Sure, and you know, just to take up from the point you just mentioned, right, you are looking at expanding across India, the Middle East, Southeast Asia, and Latin America. So which of these markets are you prioritizing first, and what kind of demand are you seeing outside India for population-specific genomics?
So of course, India would be our primary market. In fact, our plan is that in the next 12 to 18 months, set up 25 collaboration, basically 25 labs across India and outside India. 70% of those would be in India and 30% would be outside India. Now, when it comes to international markets, the way we look at the region is whether they have the same data gap problem that we have, whether they have similar clinical practices, right? So it's not just based on the number of cancer patients, but essentially associating or relating with the market, and also understand what kind of insurance coverages are there. Is the treatment available to patients over there? We are going to the markets which do not have access to technology, right? We want to go and give access to those patients so they get best in the world and they get better clinical outcomes for them. So currently we are already working with our partners in Latin America, in Central Asia, in Southeast Asia, where the samples were coming to India mostly. But with our expansion of labs locally, it allows us to manage logistical challenges in terms of the turnaround time on shipment of the samples, be close to the point of care of where the patients are, right? And that's what is defining our international market growth.
All right, Hitesh, if you can give us a sense of where your revenues stand today, what are the key revenue drivers? You know, is it genomic testing, hospital partnerships, or the OncoTwin AI platform?
So till now, majority of revenue has come from the genomic testing. In fact, for the last 5 years, so we started in 2019. The last 5 years, we have spent significant amount of time and funds on making our genomic technology very, very strong. Of course, with additional data, having a population-specific solution. And 80% of revenue has come there. But now with the OncoTwin Insight and the digital platform, we are going to see a shift where this revenue split would be around 60-40 and eventually 50-50 is what we are working towards. Today, we should be closing this year with more than 35 crore in terms of the revenue. And in terms of with the new funding, we are looking at in the next 12 to 18 months to go to 100 crore revenue, and eventually in the next 5 years to go close to 800 to 1,000 crores revenue.
So 800 to 1,000 crores is what you're targeting in a few years. All right, Hitesh, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much. And again, thanks for having me here.
And on that note, we're going to wrap up this edition of Startup Street from Shruti, Arundhati and me. It's a goodbye. Thanks for watching. Stay with us. More news and updates continue after this short break.
Welcome back to the Citizens Monetary Policy Committee discussions. We did have our discussion on Monday, but the massive US-India trade deal came on Tuesday morning or Monday night, and that's game-changing. The rupee itself went up by about 1.7% this week. And since our MPC members are top-rung economists, I thought we should ask them if the trade deal completely changes the ground for the Reserve Bank and for the Monetary Policy Committee. Let me welcome our members, Sonal Verma of Nomura, Sajid Chenoy of JP Morgan, Samiran Chakrabarti of Citi, Shaumika Ghosh of State Bank, and the chairman of the Citizens MPC, Dr. Pranab Sen. Gentlemen, and Sonal, I'm deeply grateful that you all have agreed to come again and oblige me. Let me start with the lady. Sonal, now that the deal is signed, two top things that change for the Reserve Bank.
Things change actually significantly and much for the better for the RBI. I would say there are mainly three ways things change. One is with this deal in place, it does add some upside risk to FY27 GDP growth projection. I think the biggest positive will be in terms of sentiment and flows into India, but also less trade policy uncertainty, improved exports. So there is some upside on growth. Second, this should actually enable better policy transmission because in the last few months, managing FX and rates has essentially, undone some of the policy transmission. So with an improvement in flows, better liquidity, this should enable policy transmission going forward. And third, inflation in India, of course, was already quite benign, but to the extent that we do not see further currency weakness, any upside risk to inflation from weaker currency should also be offset. So it does make the growth inflation dynamic much better and enable better policy transmission for RBI going forward.
Okay, that sounds like even more Goldilocks, Sonal. Let me get on the budget. Samiran, do you think the change for RBI in terms of managing this 17.2 lakh crore borrowing program gets any easier because of the trade deal and likely dollar flows, or is that still going to be a big point in the upcoming MPC?
I think I'll just extend the point that Sonal was making. I think the debate is between how much MPC will focus on being slightly hawkish because of the higher growth expectation versus how much dovish they can become now that there is less pressure on the currency and there is going to be better transmission of any future rate cuts. And that's where our bias is towards the latter, where we think that the MPC could turn a bit more dovish now compared to where they would have been if the deal was not in place. So from that perspective, the challenge for the bond market is twofold. One is that dovishness might, in the policy rate direction, might help the bond market. But on the other hand, these flows that are coming in would imply that RBI will have to do less amount of OMO, which is a negative for the bond market. So it will be a bit of a tussle on the policy day for RBI to balance this, that to what extent they're going to guide on the rate front versus to what extent they can still continue to signal a large amount of OMO. I think that's where the big debate is going to be, that can RBI on February 6th again announce a massive amount of OMO, or would they be now somewhat more, I would say, cautious in their announcements?
Okay, you suspect they may not announce such a big OMO. Actually, I'll come back to you, come back to the others on this, because after the budget, Samiran, I remember you telling me that it's not that 17.2 lakh crore, it is just that the demand side is very weak at this point in time. As you point out, let's discuss that later. But I'm even more worried about not just US trade deal. The thing that has changed this week, Sajid, is the global backdrop. I mean, the swings we have seen in dollar itself, in commodities, and now in the AI stocks, or even the next rung of IT stocks. It's volatile, I won't say chaotic, but volatile global scene. How does that impinge on the MPC?
Absolutely, Lata. Good morning. I think, even though the trade deal is very constructive for India's outlook, we must be very mindful that the global backdrop remains very precarious. I think there are at least two tensions that the global backdrop is seeing. The first is that, for the longest time, we've seen the threats on US exceptionism, and that's caused the dollar to weaken. And because of that, commodity prices have actually gone up because there's this inverse correlation between the dollar and commodities, which then also stokes inflation pressures in some economies. But what we've seen over the last week is the fact that underlying growth in the US, and in fact in large parts of the world, remain very resilient. And I think that's the tension, that US growth is holding up very nicely. Chairman Walsh, who was appointed by President Trump, is much more mainstream than was feared. And with this growth inflation, and inflation in the US is sticky, there is a growing belief that the 50 basis points of rate cuts that markets have priced in for the Fed will not happen in 2026. And so the longer that belief continues, the more the pressure on the dollar to regain some of its losses. And that's what we've seen in the last week, that the dollar has begun to rebound. And if that process continues, that will put more pressure on emerging market currencies. So we're not out of the woods just as yet. The second tension, as I mentioned, is the AI tension. Yes, technology is doing very well in December and Jan. Tech exports are still doing well. CapEx is doing well. But there is now a growing belief every month that has this rally been overdone? Are we approaching bubble territory? And as 2026 goes on, those questions will only get more acute. So I think we have to be mindful here that the global backdrop is very precarious. If those Fed rate cuts get priced out and the dollar were to strengthen, that will put more pressure on emerging market currencies. Conversely, if the dollar were to continue weakening, then commodity prices go up, and that creates pipeline inflation pressure. So, there is no free lunch here.
Oh, yes. I'll ask you about the Asian inflation or disinflation in a bit. Soumyakant Ghosh, I wanted your view on the currency. When we spoke on Monday, we were worrying whether it come to a point where the Reserve Bank has to announce even some NRI bonds or resurgent India bonds. Now, what is the view? Will RBI actually move to stop appreciation? This is not an MPC question; it's an RBI question. Do you think they will have to stop appreciation? Will it come to that?
No, thank you, Lata. I think the larger debate is that the US trade deal is very positive from the currency perspective. But I would just like to add one thing, that we have to be cautious enough, because the things actually globally has not changed anything fundamentally in the last 2 days, or not it is going to change in the next month or so. The global debt levels have been precarious. The movements in US dollar could be sideways. It could either appreciate or it could depreciate. And we have seen in the past that the rupee actually has been depreciating along with the dollar, which has been never happened. And while this news of US trade deal has actually created a positive sentiment in the market in terms of a rupee appreciation, but I think that given the precarious uncertainties, globally, the uncertain nature of the dollar movement, and also of the capital inflows, I think the central bank will get a very well-meant reprieve in terms of not thinking about the liquidity, that impossible trinity at this point of time. But my sense is that we have to be cautious, because the volatility in the market is not yet done yet. So if your specific question that the RBI should actually stop appreciating, I think the time has not come. Okay. Maybe the central bank could look through the data in the meanwhile and then take decisions accordingly.
I take your point. It's too early, but there is that expectation in the market whether Reserve Bank should stop appreciation. That changes the arithmetic even for how much currency, how much reserves are available in the system, the liquidity in the system. Dr. Sen, if you can bring all this together, sir, for the MPC member, post this deal, do the growth inflation dynamics become easier to manage? You would be less worried as a central banker.
Not necessarily, Lata. Let me just try. One thing that we seem to be not putting enough focus on, as far as the trade deal is concerned, is we've talked a fair amount about what it means about our exports. But there's going to be a huge amount of rejigging of our import.
Yes.
On the import side.
Yes.
Now, that is going to have monetary consequences. We don't know how large or how strong this is going to be, but given the fact that we've been running a large trade surplus vis-a-vis the US, what this is going to mean in essence is we're going to have to import a lot more from the US. And that means that we will be diversifying our basket of imports across the world. Now, this has consequences not just for the Indian economy, it has consequences for an already uncertain global economy. And that becomes problematic.
Yeah.
So as far as uncertainties are concerned, one major source of uncertainty is gone, which is what we had talked about the last time we met. But the uncertainty is still very much there, simply because now you're going to see us changing the way we trade with the rest of the world.
Yeah.
Now, this is something that one has to be a little careful about.
Yeah. I take your
And
point.
in the context, one has to keep in mind the movement that was happening towards moving to a BRICS currency kind of arrangement. That is going to be taking a bit of a setback as of now.
Yep.
Which means that, again, we really now need to, in a sense, batten down the hatches, look internally, because the rest of the world is still going to be volatile. We will not know how it's going to change.
Yeah.
And we have to look for internal sources of growth. And therefore, to my mind, at the moment, the trade-off is that growth imperatives have become more important than they were earlier.
Oh. So
Not the other way around.
Okay, sir, that's very, very interesting. Actually, we should invite you all for a separate discussion on this import rejig that we will have to do and the potential impact it can have on current account deficit. It's early days yet, we don't know. But, you know, we have a MPC coming up. And so first, lady and gentlemen, let's take up your pens and do the first vote. What will the MPC do to the repo rate on February 6th itself? Sonal, I'll start with you.
On hold.
On hold. Samiran?
On hold, but a bit more dovishness than expected before.
Okay. Dovish, pause. Soumya?
No change.
Sajid?
No change, on hold.
Okay, all of you are on the same page. Dr. Sen, you want to change your vote?
Hold.
Hold. Okay. So by a majority, by a unanimous vote, no change. But we will have to ask you a lot more questions about the new CPI basket, the new GDP number series that we will have, and you know, a host of other things that the MP that will bother the MPC. Those questions after the break. Welcome back to the deliberations of CNBC TV 18 Citizens Monetary Policy. I have been speaking with members of our committee, Sonal Verma, Sajid Chinoy, Samiran Chakrabarti, Soumyakanti Ghosh, and the chairman of our committee, Dr. Pranab Sen. Gentlemen, and Sonal, thank you very much for waiting on. Sajid, Dr. Sen referred to the global, the rejig of imports. What will global inflation be this time? There is a fear that even if the tariff fears die down somewhat, Chinese dumping is going to take its toll. So do you think core inflation may be less of a problem than some people fear.
So what you're seeing, Lata, actually is, there's no such thing as global inflation. Okay. We're seeing, a dual, dual economy or dual price pressures. Developed market inflation in some cases is still sticky, right? And so what you're seeing is a growing belief that with solid, resilient growth and sticky inflation, the Fed is going to remain on hold for the foreseeable future. What we're seeing is some developed market central banks actually begin to hike rates in 2026. Now, the situation is completely different for emerging markets and in particular what's happening in Asia. There's massive Chinese excess capacity. And if you look closely at where that excess capacity went, it was not consumed at home because domestic demand and consumption is weak. It was actually exported all around the world. Asia, of course, has been the recipient of a lot of Chinese imports over the last decade. But in 2025, you saw this widen to Africa, to Latin America, to the Middle East, to Europe. So what you're seeing in Asia actually is goods inflation remains very benign because Chinese disinflationary pressures are putting a lid on that. The thing to focus on, however, is that commodity prices have picked up. So I think the outlook for inflation in Asia is you've got the comfort that goods inflation will not spike, A, but you've begun to see some pipeline inflation pressures in terms of commodity prices. And three, despite Asian growth doing very well, India's currency was not the only currency under pressure. The Korean won and the Indonesian rupiah were under much more pressure, and that's translating into inflation pressure. So there are many moving parts at this point. In general, the sense is many countries in Asia will have the comfort to stay on hold because inflation will be benign. A couple of countries like Singapore and maybe Malaysia will be forced to hike because their economies have done better. They're part of the tech supply chain. So I think in 26, just to echo what Dr. Sen was saying, the concern for Asian central banks and policymakers will not so much be inflation. It's going to be how to navigate growth in what is still a turbulent global backdrop.
Fair point. Thanks for that, Sajid. Samiran, our inflation dynamics is not just queered by what may happen, Chinese dumping, but our own series on Feb 12th is going to change things a bit. And all of you have written reports that the new CPI will be about 20 to 50 basis points higher. What will the MPC do about that now? That unknown?
Yeah, on a lighter note, not just the future is uncertain, but even the past is uncertain for us because we will not know whether how much the previous inflation trends will go up. So our estimate is that the previous inflation trend, the FYTD 26 numbers might go up by about 40 to 50 basis points. But interestingly, that creates a favorable base for FY27. So just statistically speaking, the FY27 forecast might be lowered because of that by about 25-30 basis points is what our estimate is. Having said that, there is still a lot of uncertainty around how the price collection process will change in the new series and to what extent that can change the price indices also, not just the weighting pattern that is changing, but even the price indices might change. So it's going to be a tough call for the MPC, and that's why we are going with a pause in this MPC for the MPC to get a better chance to go through that data, go through their own FY27 1 year ahead forecast before finalizing how much space is there for further monetary easing. And that's why maybe this policy, it's only a dovish guidance and not an explicit rate cut.
Okay. Well, that was a very interesting way you put it, Samiran. I heard that from Y.V. Reddy once. Central bankers all over the world have a problem that the future is uncertain. In India, the past is also uncertain. Take your point. Well, Sonal, I'm getting two views on growth over here. Dr. Sen is worried about growth. Samiran, I think, alluded that maybe we have to, the policy may be dovish because it will be less worried about growth. Sonal, you tell me, does growth need any more help from RBI?
I think a lot has been done by the RBI, by the government. We are 1 year out from when the RBI first started cutting policy rates. So I think the foundations are quite solid. And the main objective of the RBI now should be to ensure that we transition to a much faster growth rate. So the enabling conditions are there. So the main focus, therefore, should be to, one, ensure that transmission continues. Whatever cuts have been delivered does feed through. And this will still require fairly active management on liquidity. So that job is still a work in progress. And second, I think in terms of communication, markets have been sort of running ahead, and the discussions have moved to whether rate hikes are next in India. Given we stand fairly comfortable on the inflation outlook, I think pushing back on any of such hike expectations, again, with the objective of ensuring transmission, because as I said, I think the building blocks are there. The focus now is to ensure we transition to a much faster cyclical growth outlook in 2025, 2026, 27.
Okay, so those are clearly varied views. Shaumya, I want to ask you about nominal GDP. The CPI series is getting recast, the GDP series is also getting recast, but the bane of this year has been the very low nominal GDP. What will be the trend for FY27? Higher nominal GDP, or can this lower nominal GDP continue to persist?
I think, Lata, you have posed a very interesting point over here. I think the nominal GDP growth rate has been surprisingly kept at the lower end of the spectrum at 10%. And the tax buoyancy has been kept at 0.8, possible to take into account the slower growth in GST because the compensation rate is going away.
But
having said that, I think once the GDP series and the CPI series are released, I think it will be a tale of two narratives. The first thing is that while the nominal GDP growth rate, there could be an absolute increase in the number in the GDP value. So that will actually help the government in terms of an percentage reduction in the deficit numbers possibly. But overall, I think the things will not change on the ground. So while it could actually help the fiscal math, because if you have a larger number in terms of a revision, possibly the GDP numbers could be a little higher in the new series because of the measurement issues. But that could help the percentage terms, but materially, I think things will not be much different. So this issue of nominal GDP growth rate getting higher could be actually a statistical artifact because of the new series. So my sense is that these tax collections and other things will continue to be a little bit of issue given the current global growth scenario and also in the Indian context.
Okay, let's move over to the second voting round. The question is, will there be any further rate cuts or hikes in 2026 from the MPC? Well, Sajid had to leave, and so he has given me what his vote is. His vote is no more rate cuts expected. Sonal Verma, what's yours?
We're expecting a final 25 cut in April.
Shaumya, yours?
We are for another 25, but we are now veering towards a no rate cut.
Okay. We are going to take it as one cut. Samiran?
No more cuts, but I'm going to see the new CPI and GDP to finally decide.
Okay, Dr. Sen, this is a divided house. What's your vote? Will there be more cuts?
At least one more cut. And there may be a second cut towards the end of the year. Now, whether it will be this year or next year is a question.
Okay, so the future is uncertain as far as our MPC members are concerned. Thank you very much, members of the Citizens Monetary Policy Committee, for your deliberations. That's it on this special show. Thanks for watching.
Cyril Amarchand Mangaldas presents CNBC TV 18, The Thought League Season 3, A Glorious Decade, A Century of Service.
Hello and welcome to Cyril Amarchand Mangaldas presents CNBC TV 18, The Thought League Season 3, a platform where pioneering minds come together to shape the future of law, business and society. In this edition, we turn our lens to a defining question for the coming decade. How can India fully realize its digital transformation opportunity? As artificial intelligence, platform economics and new business models reshape the world, India stands at an inflection point where imagination, regulatory design and institutional capacity will determine whether we build global-scale digital champions from the country. Joining us today is Mr. Uday Shankar, a media industry pioneer, entrepreneur and institution builder whose work has helped redefine broadcasting, digital platforms and entertainment in this country. His perspective on technology, creativity and market design offers a unique window into how India can lead in the digital age. Alongside him is Mr. Cyril Shroff, managing partner at Cyril Amarchand Mangaldas, one of India's foremost legal minds who has been at the forefront of conversations on governance, regulation, technology policy, and the institutions required to sustain trust in a rapidly changing economy. Together, they explore three powerful themes: India's digital transformation opportunity and the imagination constraints we must break, how AI will reshape media and entertainment, and what it truly takes to build global institutions from India anchored in values and excellence. Let's begin. Mr. Uday Shankar, if I can start with you, sir. We are perhaps at an existential moment for our species given developments for artificial intelligence. It is also compelling countries to think about their respective competitive advantages. I mean, in the West, for example, with all the spend into physical AI, data centers and whatnot, I mean, the question is around the return on investment that you can expect from all those investments going in. What do you think AI means in the Indian context, growth and development-wise? What advantages do you think we have, and how can we develop further in this area, sir?
First of all, thank you for having me here. And to your question, I think, you're right. West is making a lot of investments in digital or AI infrastructure, whether it is in data centers, in platform capabilities, etc. We are not there, but I don't think that is what is going to define the benefits of AI going forward, because it's important that the infrastructure for AI has to be created. And we should appreciate the fact that the developed world is heavily investing in that. What is required is for us to have a very clear-headed strategy about how we will leverage the benefits of AI. Because in a world where technology, India is very familiar with technology, and it offers us a huge opportunity to leap to the next level. When the first wave of digital revolution started in the world in 1990s and early 2000s, we were still in a very different phase of social, economic, and technology, mindset. And we were able to take advantage of it in subsectors, but we were not able to take advantage of it comprehensively. AI is resetting pretty much the baseline for every business, and it is bringing down the cost of doing business, cost of getting to the next level, scaling up, accessing the market, all of those things. And that is a huge opportunity for a capital-conscious country like India. How do we create a strategy? How do we create a framework which is comprehensive, at regulatory, legislative, capability, and strategic levels, to be able to take advantage of that? And so that it's a force for leaping forward and not just a force for competing with the others.
Mr. Shroff, come in there, sir. I mean, it's often kind of sort of framed as a black and white debate, right? Is AI good, bad? But I guess there's more to it and more nuance there. So for India, I mean, it's the same question to you as well. What does it mean?
So I think great question, Prashant. And let me build on top of what Uday said. In terms of what does it mean for India. So firstly, it's not binary. I think we all know that. I think it's a very plural subject where there are so many policy themes that are often in conflict with each other. So it's just different shades of gray. And you have to balance a variety of interests, and for which You actually need to make sure that your institutional and policy infrastructure is adequate, is sufficiently flexible, sufficiently attuned towards innovation and safety. And you have to devise it in a very conscious way and have periodic updates and revisions to it. So 3 things which I think are big items which flow from this thought. Firstly, that for India to grow on the back of AI, I think the institutional framework is going to be more important than just slogans. So what do we need? I think what we need is a very strong trust infrastructure. The AI has to be trusted. So what you need is not only strong technology, but you need clear rules, you need enforceability, you need the ability to ensure that that there is a secure framework that is created. So that is point number 1. The second, I think, is being clear about what you want from it. So if you're doing this only for cheap labor and eliminating jobs, that's not the right way to look at it. And I think India, given its sort of size, has the option of looking at it from a point of view of what insights and what outcomes do you create from it. Are you able to create effective learning? And I think the third is and again, I know Uday will resonate with this, is how much inclusion are we able to create? It's not just about efficiency, because at some level they work opposite each other. Efficiency would theoretically mean that you eliminate a lot of jobs. But I think we also need to create more inclusive applications. So the trick, I think, lies in application. I think at some point the AI infrastructure will become adequate. And then I think we'll have to really move for differentiated applications and use cases, which is where I think India offers a great advantage, because we're able to try anything at population scale. Not many markets can do that. And the starting point is also that you have fundamentally technology, comfortable, fluent population, thanks to just the way India has evolved its education system. So when you have that kind of ability at scale and to have diversity, I think applications become, and we have the source, we have the data lakes for it. I genuinely think that while we may seem to be behind the race compared to US or China, there is clearly a lot of factors which are in favor of India, and I think we can create something really powerful.
And that familiarity with technology, with which both you and Mr. Shankar mentioned, I think is a big plus. So good to hear that. That sets us up nicely. Mr. Shankar, if I can come to you, at the CII Big Picture Summit, December last year, you argued the industry's prospects are, and I quote, limited by our own imagination, your words, and that we've artificially constrained our own industry, calling for more experimentation. If you translate that into India's broader digital transformation, what are the 2 or 3, these imagination constraints which we must break to create globally scaled digital champions, sir?
Look, first and foremost, I'm a big believer in opening the gates of talent as wide and diverse as possible. What Cyril said earlier, make it inclusive. Our biggest, it's sometimes ironical that I hear everybody talk about the huge population advantage that we have, and yet we do not open our talent funnel wide enough to take the fullest advantage of that population funnel. And I think that is the most important thing. I'm talking especially about my business. It's a business of creativity, imagination. And for that, everyone in this country has something or the other to contribute. And how deep and wide we can go to harvest that talent is going to be a very important factor. 2, this whole discussion about whether AI is good or not is somewhat meaningless, because it's here in the middle of us and it's going to become more and more fundamental to all of us. So let's put our heads together about how we will take advantage of that, how we will harness it to overcome some of our traditional hurdles and take advantage of more accelerated growth in the world. So I think there is if you have the best minds, most creative minds who are not saddled by legacy learning, legacy values, and legacy business models, you use them to use you bring them together and use this new technology, which allows you to bring down the cost of creating content, cost of distributing content, cost of discovery, it allows you to completely transform consumer experience. It allows you to access more consumers, at more economical scales. Then there is a huge opportunity. All of these years, the point that I've made now many times is that all these years we've been very satisfied about servicing the Indian consumer as far as content is concerned. Not because competing globally, we had technology disadvantages, we had hugely capital disadvantage, and we had other disadvantages, primarily because we started late in the media revolution. Now it's getting reset, and we have an opportunity to just crash all the markets and go there and start competing, because technology is on our side, and the cost of creating a good movie is getting reset. So I think this whole reset is a hugely transformational force for a country like India if we really want to participate in this soft power global business.
Well, that's very interesting. But allow me to take a quick commercial break, gentlemen. When we return, Uday Shankar and Cyril Shroff will dive into how AI is transforming media and entertainment, where it will change the value chain most dramatically, and which human capabilities must never be automated. Stay with us.
Cyril Amarchand Mangaldas presents CNBC TV 18, The Thought League Season 3, A Glorious Decade, A Century of Service. Cyril Amarchand Mangaldas presents CNBC TV 18, The Thought League Season 3, A Glorious Decade, A Century of Service.
Welcome back. You're watching Cyril Amarchand Mangaldas present CNBC TV 18, The Thought League Season 3. We're in conversation with Uday Shankar and Cyril Shroff. Let's continue this very interesting conversation. Mr. Shroff, from a rule of law and institutional building lens, what are the regulatory design principles that let experimentation in emerging areas such as AI flourish without eroding trust? Something you and I discussed earlier as well, especially when digital services become critical infrastructure.
Oh, absolutely. And, first I just want to echo what Uday said in terms of, we are constrained only by our own imagination, and where there is so much opportunity for creativity, I think that truly holds true. So just few thoughts on this. So firstly, I think pluralism, is one idea, which is exactly as when in my opening comments talked about, it's not binary. There are so many nuances to, most content that is generated and the technology that you have to balance a lot of interests. So the ability to have, plural inputs in terms of, we have so many contradictions in India, what sort of good for different types of stakeholders, creative, people who want to have the pride of ownership. We also need to make sure that your stakeholders, your shareholders are happy, things like that. So pluralism is one idea. The second is that we also need to have clarity in terms of processes and not just outcomes. So regulation should also take into account that not only is the outcomes correct, but also that the process that is followed to get to that outcome is properly measurable and is also something which you can evaluate from time to time. And traditionally, in any regulation, you have almost a pre-ex ante and a ex post assessment requirement. So you should be able to anticipate what the impact of this regulation is going to be. Then I think a third design principle can be participation. So are you taking all the right input from the right stakeholders, or is it only a unidimensional view? Is it only somebody sitting in a kind of a black box in Delhi somewhere who is coming up with this policy, or have you had wide consultation? The regulation and policy should be proportional. Lastly, I think proactiveness in terms of being always in that little bit of a chore police game. You have to at least keep being proactive, have an eye on what is going on in the market, and being able to adapt very flexibly. If something new is happening, you don't have to wait for 2 years to change it. It should be instant. And I think markets where innovation thrives, this is always the case. So that there is a kind of a relationship of trust between the regulator and the regulatee, as opposed to, we live on different planets. So I think these could be some design ideas. Personally, I think India's started a little late, but is doing okay now.
This is well put, Mr. Shroff. Mr. Shankar, if I can come to you, sir. You've said that you're incredibly excited about AI and described it as a way to democratize creativity and overcome talent cost bottlenecks, which you kind of sort of referred to earlier in this conversation as well. In practical terms, where do you expect AI to be most effective in terms of transforming media and entertainment in India in the next, say, 24 months? Is it development, production, personalization, dubbing, localization, advertising, sports broadcast innovation? And what's the hardest human moat that will still matter according to you?
So look, I think all these areas that you talked about, interestingly, all of those have an opportunity to reinvent themselves with AI. And that's exactly the opportunity. You can bring down the cost of, scripting. You can bring down the cost of, production. You can bring down the cost of animation. You can bring down all of these costs, whether it is in entertainment, in sports, or anywhere else. But the real moat will continue to be, and the real challenge continues to be, who comes up with a great idea, and at least who comes up with the most breathtaking or disruptive story idea, who comes up with the most interesting music idea, who comes up with the most interesting lyrics. If you have all of those, because AI, there is a lot of promise, and we keep hearing that when we get to the next level of AI, which is agentic, etc., the agents will become so smart that they will keep getting better. But we are not there yet. And that is a real moat. And that's why I keep saying that the real issue is talent. How much we can democratize our talent access, how wide we can make it, broad-based. And if you have a great idea, so far, having been in this industry for 3 decades or more, I know that when you start creating something, the biggest challenge has always been, how do we do this? Do we have the money for it? Do we have enough people for it? Do we have enough talent for it? And all those hurdles are coming down very rapidly, very successfully to the advantage of a country like India. So we can start making content. And earlier we were making content, the industry term for that used to be cheap and chirpy content, which could satisfy our consumers. But consumers who were accustomed to global standards, they would not like that. But now, purely with the help of this technology, we can overcome that barrier without having to invest hundreds of millions of dollars in making a new movie or a new show. So that is where the real advantage is across the board.
Mr. Shroff, if you had to pick 3 policy imperatives for AI in the sector, media and entertainment, what would they be and why?
So 3 is, okay, let me think. So 1, I think, is copyright. I think there should be clarity in terms of, how do you protect the rights of creators? And this is a very gray area. There's so many, disputes that are going on as well. But I think that at some stage there needs to be clarity on copyright. Who does the IP belong to? Secondly, I think should be safety, because along with AI comes a kind of a dark side to it as well in terms of, who can be harmed, how are you going to protect children, how are you going to protect, the misuse of this technology as well. So safety would be the second. And I think that this also sometimes gets subjective, because our own views on what is socially acceptable, on the safety standards or the standards of the day keeps changing. And linked with that, I think, is a balanced approach to misinformation. So the problem of deep fake, stealing of identity. I don't think we want to suffocate this industry by excessive regulation or by putting kind of a babu mindset on top of it. I think it should fundamentally be driven by safe innovation. That should be the approach towards this.
I think it's a pretty comprehensive way to look at it. Mr. Shankar, we want to sort of draw on your vast experience. I mean, as you said, over 3 decades now in the industry. And you've been a serial institution builder, Mr. Shankar. What are the management and cultural attributes that builds a globally competitive institution, but one that is rooted here in India?
Look, I think Cyril said it in the beginning, that we are entrepreneurial, and we are we are solution oriented, because we know that we have huge challenges. We are competing with people who are much better resourced. So when we have to do something, we know we have to overcome many of those challenges that are not really part of the challenge slate for the developed world. So that, I think, is a huge asset. Our imagination, our creativity, and our understanding that we have to be smarter than everybody else to deal with that, to solve the same problem. The second thing I also think is very important, that we are Indians as a community are very aware of the imperfections in which we operate. Whether it is in our infrastructure setup, whichever industry you're talking about, the regulatory setup, the market access, all of those, and we find ways to get around those problems and still manage to build businesses. So I think those 2 are really important ones. I do think, given where we are and given how big the opportunity is, we need to be mindful that regulation needs to be, we must regulate for all the reasons that Cyril just mentioned. However, we have to also understand that it's a new baby. The regulation should not be made forever. It should be made for today. We have to be nimble, responsive, and be prepared to tweak the regulation as we go along. Because it's early days. Right now, we need to regulate in order to enable growth with all the safety concerns that need to be addressed. And once it matures, then there is a different kind of regulation that will be required. And if we don't do that, we will either over-regulate in some areas or we will under-regulate in some areas, and neither of which is going to deliver a good outcome.
Mr. Shroff, you've described institution building as creating an intangible balance sheet, values, philosophy, and knowledge that outlasts physical assets and even people. I mean, if you were advising a media tech giant trying to become global from India, again, what are these 2 or 3 intangible assets you deliberately build over a decade?
I think for building such a media giant or a presence from India, I think we should be conscious of who we are, and I think we should use our advantage. I think the first is I think we should use our cultural identity. I mean, as a country, we have so many stories, starting from, Ramayana, Mahabharata, Panchatantra, Vikram Betal. There are so many of these. These are all original stories which have withstood the test of decades and centuries, actually. So that's point number one. Secondly, I think I would also use, and I think again, Uday has done it, is to use sports. Because sports is again part of cultural identity as well. For example, cricket and the various narratives around that. That itself is another. I mean, not many nations can or societies can boast of such a large pool of talent where they are sort of equating sports and cultural capital. Third, I think what we can build again, and our population size allows this, is we can build a lot of trust around the various narratives and how they are told. And I mean, if we can kind of get the right, we can get the right pitch on some of these themes, I think India can create tremendous intellectual capital.
Well, I could go on. It's such a fascinating conversation to have with the both of you. But for now, I'll say thank you. It's all that we have on this edition of the Thought League. A big thank you to Mr. Uday Shankar. Thank you for being here, sir. And of course, Mr. Cyril Shroff, for your insights on India's digital transformation, the role of AI in media and entertainment, and the deeper challenge of building global institutions from India. Thank you for watching. Stay tuned for more conversation shaping the future of business, technology, and society.
Cyril Amarchand Mangaldas presents CNBC TV 18, The Thought League Season 3.